Poverty for Profit: How Corporations Get Rich Off America's Poor, by Ann Kim. Introduction. District Heights, Maryland is a suburb of Washington, D.C., 9 miles southeast of the U.S. Capitol, across the Anacostia River. It's one of the most segregated communities in the United States, the result of decades of redlining and housing discrimination. 9 in 10 of its roughly 6,000 residents are black. Less than 3% are white. Though the city's median household income is a hair below the national median, $69,099 versus $70,784 in 2021, the community is far less prosperous than other D.C. area suburbs. Its poverty rate is more than double that of affluent Arlington, Virginia, and nearly 5 times that of its northern Maryland neighbor, Bethesda. At nearby Suitland High School, part of the Prince George's County school system, 2/3 of students qualify for free or reduced price lunch. The city's main commercial thoroughfare is Pennsylvania Avenue. You can follow it north straight to the Capitol, which culminates in Penn Station, a massive collection of strip malls at the corner of Pennsylvania and Silver Hill Road. But this is not the kind of shopping center you'd find in mostly white suburbs, with a Panera next to Starbucks and big box stores like Target and Old Navy. Instead, you'll find an Ace Cash Express, Penn Station Liquors, Dee Dee's Discount Clothing Store, and Ashley Outlet, which sells rent-to-own furniture. You'll also find dialysis centers, bail bondsmen, and predatory tax preparers nearby. Within a 10-minute drive of this intersection is a microcosm of Poverty, Inc., the vast ecosystem of industries that owe their profits and existence to the exploitation of low-income, often minority Americans, and government programs for the poor. Across from Penn Station and visible to traffic from all directions is a DaVita Dialysis Center, a low-slung, gray-white one-story building with a blue roof. A drive-through liquor store, open 7 days, as its signage announces, sits next door. The DaVita Center is one of at least 4 dialysis centers in and around District Heights. U.S. Renal Care runs a clinic inside Penn Station, and there is another DaVita less than 10 minutes away in nearby Coral Hills. 3 minutes up Silver Hill Road in Suitland, Maryland, is yet another facility, Fresenius Kidney Care. Because of the wildly inequitable toll that kidney disease takes on black and low-income Americans, dialysis is big business in places like District Heights, especially when Medicare foots the bill. The vast majority of dialysis services in America are provided by just 2 companies, whose centers are disproportionately located in low-income neighborhoods, such as District Heights, Maryland, hardest hit by diabetes and kidney disease. Tax prep is another popular business in District Heights, given the concentration of low-income residents, many of whom are eligible for the Federal Earned Income Tax Credit, or EITC, for low-wage earners. On busy Marlboro Pike, about a mile away, is an outpost of the tax preparation franchise, Liberty Tax. Known for its costume-clad sign spinners, the company earns much of its revenues from low-income taxpayers claiming the EITC. It charges hundreds of dollars in preparation fees for every return filed, plus hundreds more in fees for instant cash refund advances. This particular office is in a faded strip mall, sharing space with a boarded-up barbershop, a tattoo parlor, and the Pretty Girl intimate venue. On one drizzly morning in March 2022, a sign holder dressed as a gray-green Statue of Liberty sat huddled on the curb, occasionally flicking his sign toward passing cars, though on this day no one stops. More than 20 tax prep firms dot the area, ranging from big franchises such as Liberty Tax, Jackson Hewitt, located inside Penn Station, and H&R Block, to smaller outfits such as Assiduous Tax and Accounting and Nubian Tax Express in nearby Capitol Heights. In 2020, Maryland taxpayers claiming the EITC lost at least $50 million to tax preparation fees, according to the nonprofit Cash Campaign of Maryland. Businesses dependent on the combination of poverty and government intervention permeate nearly every aspect of life in District Heights. Need to visit a dentist? There's Pine Dentistry, a chain of offices heavily reliant on Medicaid patients, especially children. It was formerly known as Cool Smiles before federal fraud charges prompted a rebranding. More on this in Chapter 4. Its District Heights office is not far from Penn Station, in a mostly empty strip mall whose other principal tenants are a liquor store, a beauty parlor, and a storefront church. If you need a place to live, there's the Woodland Springs Apartments, a complex of 3-story red brick buildings with about 500 units, a 3-mile drive from Pine Dentistry. Originally built in the 1940s, the complex was renovated in the 1990s through a mix of government subsidies, including the Low-Income Housing Tax Credit, LIHTC. Its current manager is Reliant Realty Services, which specializes in low-income properties and manages 10,000 units in 6 states, according to its website. In the fall of 2023, the rent for a 2-bedroom, 1-bath at Woodland Springs was $1,009, well below the average rent for a 2-bedroom apartment in District Heights. Many residents also receive rental assistance through the Housing Choice Voucher Program, formerly Section 8. The discount rent, however, comes with other costs. In May 2022, a drive-by shooting at the complex injured 2 boys, one of them a 4-year-old. In 2017, 2 men were found fatally shot in one of the complex's parking lots. Online reviews by current and former tenants complain of roaches, flooding, and safety issues. If you're not ready to be getting shot while walking out of your building, then don't move to Woodland Springs, one reviewer wrote in 2021. Horrible place, roaches everywhere. Then, when it rains or thunderstorms, water comes in from the windows. I'm ready to pack up and leave, wrote another tenant. The federal government spends about $900 billion a year on programs that directly or disproportionately impact poor Americans. This includes about $857 billion a year on anti-poverty programs, such as the EITC, Medicaid, affordable housing vouchers and subsidies, homeless shelters, the Supplemental Nutrition Assistance Program, SNAP, formerly food stamps, school lunch, job training programs, and cash benefits for welfare. It also includes about $12 billion for child welfare and $7.8 billion for prisons. States and local governments spend tens of billions more, including $80 billion a year, on jails and prisons alone. These enormous sums fuel Poverty, Inc., the vast collection of industries that make their living off the poor. Collectively, these profiteers pose formidable structural obstacles to reducing poverty. Their business models depend on their ability to exploit low-income Americans, and their political influence ensures a thriving set of industries where everyone profits except the poor, and U.S. taxpayers foot the bill. Many of these private interests are third-party contractors directly deputized by federal, state, and local governments to administer public programs and services. These include the myriad job training firms that work with unemployed workers and welfare recipients, the major banks that process food stamp benefits, and private prisons. President Ronald Reagan's push to privatize government during the 1980s led to an explosion of both nonprofit and for-profit firms that have taken on quasi-governmental duties as social service providers. Private contractors, in fact, now deliver much of the social services poor Americans receive. Companies enjoy multi-million-dollar contracts to act as government agents, determining eligibility, denying or granting benefits, and enforcing sanctions against those who don't comply with work requirements and program rules. Other firms participate in lucrative public-private partnerships, such as to build public housing that benefit them more than low-income Americans. Other industries enmeshed in the corporate poverty complex are ancillary to public systems, such as criminal justice, and exploit the opportunities created by legislation or regulation to make markets for themselves. Bail bondsmen, for instance, offer high-interest loans to those who can't afford to make bail and collect debts even after an acquittal. Debt collectors pursue unpaid fines and fees and child support on behalf of states and cities, collecting fat commissions. Towing companies profit from impoundments. Dialysis providers rely on a steady stream of low-income, minority patients whose treatment is paid for by Medicare. The result is a coterie of cottage industries dependent on government largesse and determined to keep their niche. These businesses profit mightily at the expense of poor Americans. The malign impacts of these corporate interests help explain poverty's seeming intractability. Nearly 6 years after President Lyndon B. Johnson declared unconditional war on poverty, poverty remains stubbornly persistent, to the frustration of both policymakers and the public. At the end of 2022, the official national poverty rate was 11.5%, half of what it was in 1959, but far from LBJ's goal, not only to relieve the symptom of poverty, but to cure it, and above all, to prevent it, especially among the Americans most likely to be poor. Despite nearly $2 trillion in federal aid deployed during the coronavirus pandemic, roughly 1 in 4 households headed by single women, 24.7%, lived in poverty in 2022. The overall black poverty rate was more than half again that of whites, 17.1% versus 10.5%, while Hispanic poverty stood at 16.9%. Children under 18 were also half again as likely to be in poverty compared to seniors over age 65, 15% versus 10.2%. Black children were more than twice as likely to be impoverished compared to whites, 21.6% versus 9.7%. What many Americans think of as the American dream, the ability to rise into the middle class and beyond, is also fading. Twice as many Americans today live in neighborhoods with a poverty rate of 30% or more, compared to a generation ago. Children born in the poorest fifth of households have a less than 10% shot at reaching the top 20%, according to Harvard University researcher Raj Chetty, and only about half of sons can expect to earn more than their fathers. Downward mobility is a threat. A black child born in the top fifth of households, finds Chetty, is as likely to fall to the bottom as they are likely to remain at the top. Too many Americans face structural barriers such as low-quality schools, housing segregation, mass incarceration, and lack of access to good jobs. The nation has yet to undertake systemic reforms that recognize and rectify these historic inequities. Government anti-poverty programs could also be more generous. In 2017, for instance, government benefits and tax relief lifted more than 39 million Americans out of poverty, according to one analysis, and lowered the poverty rate by 12 percentage points. Bigger investments could certainly mean greater impacts. But while federal underinvestment is one reason the war on poverty has stalled, more money isn't going to fix what's gone wrong with U.S. social policy. Poverty profiteers undercut the efficacy of federal anti-poverty programs by diverting desperately needed dollars from poor families and subverting federal policies to their own benefit. Low-income Americans pay the price of keeping these businesses afloat, while taxpayers wonder why government programs don't work. These entrenched for-profit interests contribute to persistent poverty in multiple ways. 1. They are often ineffective, failing to deliver services that will improve low-income Americans' lives, or they are actively harmful. 2. They are often wasteful and inefficient, diverting needed resources from the populations they are charged to assist. And 3. They are resistant to reform, blocking efforts to improve programs that could also endanger their revenue streams. Bail bondsmen have organized to oppose bail reform and the abolition of cash bail, while the dialysis industry has spent hundreds of millions to shape federal and state policy. In California, dialysis companies poured $233 million into political campaigns from 2017 to 2020 to defeat regulatory measures aimed at their industry. The failure of the war on poverty is a failure of investment. But as this book argues, it's also a failure of governance that demands reckoning if U.S. social policy is to succeed. The chapters that follow describe the multiple industries that are infiltrating almost every aspect of the lives of the poor: healthcare, housing, justice, job training, and nutrition. They also explain how these businesses are aided and abetted by public policies, such as the wholesale privatization of government services and the political influence these industries wield on lawmakers and regulators. In the many years I've spent writing about social policy, I've seen that much of the political conversation around poverty is binary, focused either on individual behavior or on the adequacy of government programs. Many conservatives, for instance, favor policies to incentivize personal responsibility, like work requirements for people on welfare. Many liberals, however, want to boost federal funding or create new programs, like a universal basic income guaranteed to all households as a monthly stipend. This book, however, seeks to open new ground by spotlighting the often pivotal role of private industry as intermediaries between government and people in poverty. As I argue in this book, these companies are not neutral administrators of government programs. They're a silent but powerful pillar of the poverty bureaucracy, with interests often at odds with both the government and the people they purport to serve. The corporate colonization of U.S. social policy, moreover, didn't occur in a vacuum, but rather in the confluence of history, politics, ideology, and opportunism. It's a context that helps explain how the business of poverty has become so entrenched and why it ultimately may prove hard to unravel without a sincere commitment to the reform of governance. But by showing how the current political and policy logjam on poverty has enabled the rise of the industries I describe, I hope that liberals, conservatives, and centrists alike can find common ground in the pursuit of better and more accountable governance, the more efficient use of taxpayer dollars, and the elimination of blatant corporate abuses. Though a breakthrough might be unlikely given the current state of U.S. politics, consensus-driven incremental change can still ultimately lead to larger reforms. I do not come to this book as a dispassionate observer. As the child of Korean immigrants who struggled to establish themselves in this country, I've benefited personally from some of the programs I write about here. Medicaid helped care for my grandmother in the last few years of her life. Free school lunches kept me fed when our family's grocery budget was $30 a week. I don't doubt the support these programs provided, as my parents worked to secure a place for us in the middle class. My goal with this book is to help ensure that the nation's safety net programs are as effective as they can be. The infrastructure of poverty is big business, and as such, it is a major component of the systemic barriers low-income Americans face. No systemic understanding of poverty can be complete without a hard look at the businesses that profit from and perpetuate the structural disadvantages that hold back so many Americans. 1. The price of paying taxes. At the Rogers Car Mart in Rogers, Arkansas, you can both buy a used car and get your taxes done, a combination not uncommon in many low-income neighborhoods. The Buy Here, Pay Here dealership offers financing, regardless of your past credit history, bad credit and or no credit, previous repossession, or bankruptcy. It's one of the 151 Car Mart locations nationwide that offers on-site tax preparation through TaxMax, a Tampa-based company that works with 3,000 car dealerships across the country. Preparing a federal Form 1040 at the Rogers Car Mart costs $149, according to the salesperson I spoke with in the spring of 2022. A state return costs an additional $49. I'd also pay a $93 bank fee if I got a refund, plus a $27 check printing fee if I wanted the dealership to loan me an advance on my money instead of waiting for the IRS to cut the check. The grand total would be $318, or about 15% of the average federal refund in 2022 of $2,201. The remainder, the salesperson told me, could go toward the down payment on a car, such as the 2017 Chevy Trax with 114,000 miles, or the 2020 Kia Soul with 67,000 miles in the Car Mart inventory that day. I could get my taxes done, qualify for a refund, and walk out with every penny due to me going to the dealership instead. That, of course, is the idea. In addition to places like Car Mart, TaxMax works with money services businesses, such as check cashers, collections companies, and even mobile home dealers, all with the goal of helping these companies capture a chunk of their customers' tax refunds each spring. You can send your customer down the street to file their taxes, but that refund can take 7 days, or as much as 7 weeks to arrive, says the company's pitch to prospective partners on LinkedIn. That's 7 to 50 days for them to continue shopping and change their mind. TaxMax allows you to capture that sale on the spot and print the customer's tax refund on site in your printer. TaxMax's CEO is a gray-haired 50-something Florida-based entrepreneur named Bill Nealon. According to his LinkedIn bio, Nealon founded his first tax prep firm in 1995, 2 years after graduating from the University of South Florida with a degree in accounting. After starting out with a handful of dealerships in Florida, his bio says, his firm bought TaxMax, along with another company called Tax Deals for Wheels. Today, he's something of an industry impresario. In 2021, he helped launch BHPH United, a new trade association for buy here, pay here car dealers that holds its annual summit in Las Vegas. At the end of a short YouTube video promoting the organization's inaugural event, which attracted nearly 400 attendees according to its website, Nealon yanks down the lever of a giant neon-bordered slot machine, signifying the jackpots to be had in his business. "Are you in? I'm in. I'm definitely in," he says. What companies like TaxMax and its brethren are after is a cut of the Earned Income Tax Credit, or EITC, the federal government's most generous tax benefit for low-income workers. In tax year 2022, the federal government refunded about $64 billion to workers and families through the EITC, according to the Internal Revenue Service, IRS. The amount of the refund depends on the amount of earnings and the number of children in a taxpayer's household, with the largest benefits going to households earning about $25,000 a year. Benefits diminish or phase out as workers' earnings increase. The EITC is also a refundable credit, which means taxpayers can receive it even if they don't otherwise have tax liabilities. While the average EITC refund was $2,043 in 2022, according to the IRS, many families qualify for much more. The maximum EITC for a family with 3 children, for instance, was $6,935 for tax year 2023, while families with 2 children qualified for up to $6,164. For many households, an EITC refund is the biggest chunk of money they see all year. For some families, according to one federally funded analysis, it accounts for as much as a quarter of their annual income. It's sums like these that are irresistible to tax time predators, who skim tens of millions of dollars each year from refunds intended for low-income families, blunting the benefit's impact while keeping themselves rolling in profits. In Maryland, for instance, where 492,000 taxpayers received an average EITC refund of $1,950 in 2022, at least $50 million was diverted to tax preparers, says Robin McKinney, co-founder and CEO of the nonprofit Cash Campaign of Maryland. That's $50 million not going to groceries, rent, to pay down student debt, or to meet other pressing needs. It's epic bleeding, McKinney says. It doesn't have to be this way. The tax prep industry's birth and growth are the direct, if unintended, result of misguided public policies. Convoluted tax laws, for instance, drive taxpayers into the arms of paid preparers who promise to ease the hassle of filing returns. The EITC is especially complex, with plentiful traps for the unwary. Though intended to ensure that only deserving or working taxpayers receive the benefit, the credit's complicated provisions create abundant confusion and a perfect business opportunity for paid preparers. Other aspects of the law specifically burden EITC claimants, such as legislation passed by Congress that delays EITC refunds, and only EITC refunds, until at least February 15th. More on this to come. While the stated purpose of this provision is to allow the IRS more time to check for errors or fraud, its impact has been to buoy the market for refund advance loans and other fast cash products for cash-strapped customers eager for their refunds. Meanwhile, the industry has battled hard to preserve the status quo. It's fought efforts to ensure minimum competency and licensing standards for tax preparers and resisted efforts to simplify the tax code or the process of filing returns. Tax prep giants H&R Block and Intuit have spent millions to block the government's efforts to experiment with automatic return-free filing. In 2016 alone, according to a 2017 ProPublica report, the company spent as much as $5 million to advance legislation prohibiting the federal government from offering taxpayers this service. What's happened with the commercial tax prep industry is a perfect example of how Poverty Inc. has come to be across multiple sectors of social policy. An otherwise well-intentioned and potentially effective program gets subverted by and then becomes subservient to an industry it creates and to which it becomes captive. The result is an abdication of governmental responsibility toward the nation's most vulnerable citizens, whom profiteers are only too happy to exploit. Cashing in on complexity. More than half of U.S. taxpayers rely on paid help to file their taxes, including a majority, or 54%, of those earning less than $40,000 a year. Tax prep is big business. In 2023, the industry was worth $13.9 billion, according to an estimate by market research firm IBISWorld. While on the one hand are mainstream firms like H&R Block and Intuit, the makers of TurboTax, the industry also includes outfits like TaxMax and other businesses that target lower-income taxpayers. One government study uncovered a wide array of low-rent enterprises touting tax prep services at tax time, including a discount shoe store in Maryland, a free pair of shoes with tax preparation, a pawn shop in New Hampshire, $5 to $10 discounts on buying back previously pawned item, a rent-to-own store in Mississippi, willing to negotiate a discount on rental items, and, of course, used car dealers, free tax preparation with purchase of car. Less income should mean simpler taxes. Lower-income taxpayers don't typically qualify for the mortgage interest deduction or other tax breaks that complicate the returns of middle-class filers. The EITC, however, is excessively convoluted. As a social program disguised as a tax benefit, the EITC's structure reflects the bureaucratic complexity of a government program, including Congress's exacting preferences for eligibility. For example, who is deserving? That's why so many lower-income taxpayers seek paid help at tax time. One Urban Institute study, for instance, found that among low-income parents, 66.8% sought help from tax preparers, including 73.4% of those who didn't finish high school, 71.5% of Hispanics, and 73.2% of blacks. The IRS's current instructions for the EITC involve a 44-page booklet with a 12-step checklist and 10 pages of tax tables. In a 2020 special report on the EITC, the IRS's National Taxpayer Advocate noted 8 different formulas for calculating the benefit. Depending upon the presence and number of qualifying children, the taxpayer's earned income, adjusted gross income, or AGI, investment income, and marital status. As the Center on Budget and Policy Priorities points out, the IRS instructions for the EITC are nearly 3 times as long as the 15 pages of instructions for the alternative minimum tax, which almost exclusively applies to wealthier taxpayers. One especially confusing provision is the definition of a qualifying child, the most important factor determining the generosity of a refund. Here's how the taxpayer advocate describes what it takes to be a qualifying child. First, the individual must have a specific relationship to the tax filer: son, daughter, adopted child, stepchild, foster child, brother, sister, half-brother, half-sister, stepbrother, stepsister, or descendant of such a relative such as a grandchild, niece, or nephew. Second, the individual must share a residence with the taxpayer for more than half the year in the United States. Third, the individual must be under the age of 19, or age 24 if a full-time student, or be permanently and totally disabled. Aside from the arbitrariness of its requirements, why 6 months? Why age 19? These criteria differ from what's required for the child tax credit, for which many families also qualify. The child tax credit, for instance, can only be claimed for children under age 17 versus 19 or 24 under the EITC, and the child must be a U.S. citizen or legal immigrant, which the EITC does not require. The EITC's three-part test also does not align with the shifting realities and living arrangements of modern families, leading to bizarre and irrational outcomes. Because of the shared residency requirement, for instance, a mother who separates from her husband may or may not qualify for the credit, depending on when during the year the separation occurred. This kind of complexity has made millionaires of people like John Hewitt, the founder of the best-known chains in the low-income tax prep business, Jackson Hewitt and Liberty Tax. Now in his 70s, Hewitt grew up in Hamburg, New York, a suburb just south of Buffalo, and got his start in the tax business at age 19. A graduate of Hamburg High, he went to the University of Buffalo, but didn't finish, according to an interview he gave the Buffalo News on the eve of his 40th high school reunion in 2007. Instead, he took a job with H&R Block, where he became an assistant district manager for Western New York in 1971, and then district manager in 1975. In 1981, he and his father built what he said was the first tax prep software for Apple computers, which would prove essential to growing his empire. The philosophy was to have a decision tree software that made the first-year tax preparer as good as a 20-year tax preparer. Hewitt recalls in an episode of his podcast, I Compete, in which he touts the advantages of running a tax prep franchise. His goal was to democratize the tax business, which he did with extraordinary success. In 1982, Hewitt and his father bought the Mel Jackson Tax Service, a small tax prep franchise that at that point had only 6 offices, and renamed it Jackson Hewitt. Jackson had died, and his widow was running it, Hewitt told the Buffalo News. 15 years later, the business had exploded to 1,300 offices across the country, all of them franchises licensing his proprietary software. In 1997, the financial services firm HFS Inc., now Cendant, bought Jackson Hewitt for $483 million. Hewitt then promptly launched Liberty Tax Service in Canada, which eventually expanded to more than 2,500 locations in the United States, went public in 2011, and is now one of Jackson Hewitt's principal competitors. Today, Jackson Hewitt and Liberty Tax Service together operate more than 8,000 offices nationwide. In 2018, Jackson Hewitt was acquired by the private equity firm Corsair Capital, which held $10 billion in assets as of June 2023. In 2021, Liberty Tax was bought by NextPoint Financial, a special purpose acquisition company, or SPAC, based in Canada. In its final annual report as a U.S.-based public company, Liberty Tax reported total revenues of $132 million in fiscal 2019. Hewitt has since focused on a third tax prep franchise, A-Tax, which caters to Hispanic and non-English-speaking taxpayers. He announced this effort on March 6, 2019, one day after the expiration of a non-compete agreement between Hewitt and Liberty Tax, according to a 2020 interview Hewitt gave the Franchise Times. A-Tax is actually one of a suite of franchise opportunities Hewitt is now offering under his current venture, Loyalty Brands. In addition to tax prep, potential franchisees can also invest in Zoomin' Groomin', a custom mobile grooming franchise for pets, or open up a local branch of the Inspection Boys, which offers honest and authentic home inspection. As of the fall of 2023, A-Tax had 63 offices nationwide, but its growth, the site predicts, is going to be exponential. As Hewitt himself tells it, the secret of his success is simple. The tax code is complex, and taxpayers are fearful. Thousands of people have told me they're afraid of the IRS, he says in his podcast. Guess how many people have told me they were afraid of the CIA or FBI? Very few or none. So I say, thank you, IRS. That fear of the IRS drives people to have someone prepare their return. How a tax break for the deserving poor became an industry cash cow. For low-income taxpayers, the tax time anxiety that benefits people like Hewitt isn't accidental. The 44 pages of instructions for the EITC are the result of deliberate policy choices intended to limit access. Like so much of modern U.S. social policy, the EITC was crafted to reward the deserving poor, an idea with deep roots that has fundamentally shaped the politics of poverty in America. More on this in Chapter 3. The credit is available only to working taxpayers with earned income to report, and the most generous benefits are reserved for those with children to support. It is only because of its design to make work pay that the EITC has enjoyed enduring bipartisan support since its enactment nearly 50 years ago. At the same time, the statutory and regulatory contortions necessary to ensure that the credit only goes to those deserving of it are responsible for the complexity that spawned the likes of Jackson Hewitt, TaxMax, and its competitors. As the credit has grown over the years, additional legislative and administrative changes, including fixes that have gone awry, have only served to entrench the tax prep industry. The father of the EITC was Louisiana Senator Russell B. Long, son of legendary Louisiana Governor and U.S. Senator Huey Long, whose life inspired the book and the movie All the King's Men. First elected to the Senate in 1948, days shy of his 30th birthday, Russell Long eventually rose to the chairmanship of the powerful Senate Finance Committee, which he ruled from 1965 to 1981. From that perch, he exercised such profound influence over the nation's tax laws that the Wall Street Journal reportedly dubbed him the fourth branch of government. That legacy would come to include the EITC, which Long framed as tax relief for the working poor. What Long originally proposed in 1972 was a work bonus equal to 10% of wages for low-income workers earning less than $4,000 per year. Speaking on the floor of the Senate, Long described the idea as a dignified way to provide help to a low-income working person, whereby the more he works, the more he gets. And, he added, this way will benefit many working poor, many of whom are not on public welfare, and many of whom we hope will not be. By then, welfare reform was already in the crosshairs of conservative policymakers, including President Richard M. Nixon. Between 1960 and 1970, the number of people on Aid to Families with Dependent Children, or AFDC, nearly tripled, from 3.1 million to 9 million. If poverty was the pressing social problem of the 1960s, welfare dependency became the social problem of the 1970s, as legal historian Dennis J. Ventry Jr. writes in his political history of the EITC. Long's work bonus was an alternative to Richard Nixon's welfare reform plan, which aimed to replace the federal welfare program with a negative income tax, modeled after a 1962 proposal by economist Milton Friedman. Though Nixon's Family Assistance Plan, or FAP, included a work requirement as a condition of receiving benefits, Long and other lawmakers disliked the idea of a guaranteed income on the grounds it would discourage work. At one Senate hearing in 1973, Long showed how a father could get more in benefits under FAP if he were unemployed than if he were working. In other words, he can increase his family's income by quitting work entirely, Long said. Despite, or perhaps because of, his image as a populist champion of the working class, Long was deeply critical of the federal welfare program, AFDC. In March 1972, Long presided over a Senate Finance Committee hearing titled Welfare Cheating, in which he condemned AFDC as being manipulated and abused by malingerers, cheats, and outright frauds. Welfare cheats, he argued, included not just those who lied about their circumstances to qualify for benefits, but also the able-bodied who did not work. Particularly irritating to Long were the men he imagined to be living with the mothers of their children receiving AFDC, who were allowed to sponge off the welfare check, thus depriving the dependent children on whose behalf the check was provided in the first place of their food and clothing. Why should that be permitted? He railed. If he's there acting like the man of the house and enjoying the privileges of the man in the house, why shouldn't he be obligated to bear the burdens of the man of the house? Nixon's plan faltered and ultimately failed, but it wasn't until 1975 that Long's proposal passed Congress. By that point, Long's work bonus was renamed the Earned Income Credit and cast as a temporary offset to payroll taxes for low-income families then struggling in recession. Once ensconced in the tax code, the EITC quickly became the anti-poverty program of choice for many, as the Wall Street Journal once declared. Beginning with the Revenue Act of 1978, which increased the maximum credit to $500 and made it permanent, Congress has expanded or modified the EITC more than half a dozen times. In 1993, President Bill Clinton signed legislation doubling the size of the benefit, which his administration proclaimed to be the largest EITC expansion ever. By 1998, the credit was lifting 4.6 million people out of poverty, and studies showed significant gains in the share of low-income mothers joining the workforce, thereby validating proponents' claims of its work incentives. Today, the credit pulls at least 5.6 million Americans out of poverty every year, says the Center on Budget and Policy Priorities, including 3 million children. Its $64 billion in annual cost is more than triple the federal spending on temporary assistance for needy families, or TANF, the successor to AFDC, making it the nation's largest anti-poverty program by far. The EITC's growth and impact, however, has also elevated the role and fortunes of tax-time profiteers, who essentially now serve as brokers for the EITC and exact an exorbitant toll for access to this vital benefit. Low standards, high prices, and predatory products. Low-income taxpayers often don't get the expertise or peace of mind they want from paid preparers, whose principal goal is often diverting as many dollars as possible away from taxpayers and toward themselves. Services can be shoddy and the practice is predatory. It's an industry that's been built up to suck money out of people, says David Langley, outreach coordinator at Prepare and Prosper, a nonprofit that offers free tax preparation services in the Minneapolis metro area. In the D.C. metro area, for instance, tax prep fees charged to EITC filers run from $400 to $1,200, according to Joseph Laitman Santa Cruz, who is CEO and executive director of the Washington, D.C.-based Capital Area Asset Builders, or CAAB, making the Arkansas car mart I mentioned at the start of this chapter a relative bargain. There is so much money to be extracted from the people facing poverty, he says. National data on the average cost of tax preparation doesn't exist, in part because the industry's fee structure is a black box, says the National Consumer Law Center, NCLC. The near-uniform refusal to provide upfront price information has long allowed tax preparers to ignore consumers' demands for pricing clarity, says a 2021 NCLC report. As a result, abusive pricing schemes proliferate. Frequently, tax preparers don't disclose the cost until after they've gathered all the taxpayers' information, arguing that the complexity of the return determines the price. By that point, taxpayers might be invested in the process and reluctant to start over again elsewhere for the sake of comparison shopping. This is what happened to Baltimore resident Carly S., who relied on paid preparers before becoming a client of the free tax prep services provided by the nonprofit Cash Campaign of Maryland. They said, well, we can't really tell you how much it's going to cost because we don't know what your taxes look like right now, she said of the commercial tax preparer she used to use. That was always the line that was fed to me. The bottom line, when revealed, was also always higher than she expected. There were always hidden fees, she said. When I called the Nubian Tax Express, one of the many tax preparers that dot the low-income neighborhoods of District Heights, Maryland, the man who answered the phone also told me he could not quote a specific price for filing a 1040. But he told me that if I emailed over my documentation, a photo of my W-2, social security number, etc., he'd be happy to come up with an estimate. I did not take him up on his offer. Some firms prey on immigrant taxpayers, charging astonishingly high fees for the ministerial task of renewing an individual tax identification number, what the IRS uses for non-citizens who don't have a social security number. Those fees can run $150 per taxpayer, says Alejandro Valenzuela Jr., Tax and Financial Services Director at Minnesota's Prepare and Prosper. If it's a married couple, and they both need to be renewed, that's $150 each, plus the returns. and now you're looking at over $500 in fees. Sometimes the price gouging veers into outright fraud. The U.S. Department of Justice's Tax Division maintains a roster of hundreds of preparers barred from business for committing tax crimes. Preparer fraud is also perennially on the IRS's annual list of dirty dozen tax scams. Many of the enforcement actions brought by prosecutors involve low-income taxpayers in the EITC, such as the one brought against the Nubian Tax Express, the same firm that wanted me to email over my personal information. In that instance, the owner of the firm was sentenced to jail time and 6 months home detention in 2011 for submitting income tax returns that falsely claimed credits to which Nubian clients were not entitled, thereby generating fraudulent income tax refunds, according to the U.S. Attorney's Office for the District of Columbia. Among his victims were welfare recipients, whose returns were altered so that Nubian could claim larger refunds. Unbeknownst to the taxpayers, the defendant was keeping a larger part of the money than the Nubian clients were aware he had obtained from the IRS as a result of the fraudulently filed income tax returns, prosecutors said. The nation's largest tax chains aren't above those behaviors either. In 2007, the Department of Justice, DOJ, sued 5 Jackson Hewitt franchisees operating more than 125 outlets in Chicago, Atlanta, Detroit, and Raleigh-Durham, North Carolina, charging them with tax fraud. The DOJ alleged that these businesses created and fostered a business environment at the Jackson Hewitt franchises in which fraudulent tax return preparation is encouraged and flourishes. Among other things, the DOJ accused the stores of filing false returns, claiming refunds based on phony W-2 forms, using fabricated businesses and business expenses on returns to claim bogus deductions, claiming fuel tax credits in absurd amounts for customers clearly not entitled to any credits, and massive fraud related to claiming the federal earned income tax credit. The DOJ's later settlement with the franchisees included restrictions, monitoring, and in some cases, temporarily barring some of the franchise owners from the industry. In 2019, the DOJ announced the settlement of 10 separate suits filed between 2013 and 2018 against a dozen Liberty Tax Service franchisees, also for fraud. In its complaint, the DOJ alleged that these franchisees had claimed over $28 billion in federal tax refunds, including more than $12 billion from the EITC. Some franchisees recruited customers, including homeless individuals, and then prepared fraudulent federal income tax returns on their behalf to claim the EITC, said the DOJ. The government also alleged that Liberty Tax encouraged this behavior by recognizing 6 of the 12 franchisees sued by the DOJ as members of the Elite 18 of the Liberty Tax Service System, a status reserved for top franchisees to recognize a special category of franchisees whose performance and attitude have set the standard for the Liberty Tax Service organization. As part of its settlement, Liberty Tax agreed to enhanced compliance measures and independent monitoring. High tax prep fees aren't the only scam tax preparers perpetuate. Many firms further gouge their customers with fast cash refund advance products, such as refund anticipation loans, or RALs, refund transfers, and refund anticipation checks, or RACs, for customers who want or need their refund money right away. RALs work like payday loans. Taxpayers borrow against their refund for a cash advance, which gets paid back once the IRS sends the refund. When they first hit the market in the 1990s, annualized interest rates for these loans, which sometimes lasted only a week, ranged from 67% to 774%, according to the NCLC. At the height of the RAL boom, around 2000, the NCLC estimated consumers spent $810 million in RAL fees, with much of this money coming from the EITC recipients. At Jackson Hewitt, customers can start borrowing against their refunds as early as mid-December. Need money for the holidays? Asked the Jackson Hewitt site in late 2021. Early refund advance is here. Book your appointment now. Spaces fill up fast. The site went on to promise fast, easy money. You could get up to $1,000 in minutes on a prepaid card. No one offers a tax refund advance loan this big, this early. Get started with just your pay stub or proof of income. The fee for this loan, the site disclosed, was $70, or a 35.9% APR. At H&R Block, customers can apply for Emerald Advance, a fixed-rate term loan of up to $1,300, secured by their anticipated refund. Taxpayers can apply for Emerald Advance as early as November 1st, according to the H&R Block site, and funds are loaded onto an H&R Block Emerald card or to an account through the banking app Spruce. Customers must pay the balance down to zero by March 31st, and the interest rate is 35.9%, along with additional fees that may apply according to the site. Alternatively, taxpayers can opt for refund anticipation checks or RACs, or refund transfers, which are technically not loans. Instead, they're a mechanism for taxpayers who don't have bank accounts to receive their refunds by direct deposit from the IRS instead of waiting weeks for a paper check. Companies selling RACs and refund transfers partner with a bank to create short-term bank accounts expressly for this purpose. The accounts typically exist for about 3 weeks. When the refund arrives, the company deducts whatever fees the taxpayer owes for tax prep and for the RAC itself, and then issues a debit card, which carries its own fees for the balance. While the fees charged for a RAC appear to be relatively reasonable, between $32.95 and $34.95, according to a 2019 Government Accountability Office or GAO study, taxpayers also often face an onslaught of junk fees that drive up the final price tag, in addition to inflated fees for tax prep. It's a bank account, so it's not a loan, and the APR rules don't apply, says CAAB's Laitman Santa Cruz. But it just so happens that the amount of fees that get charged over 3 weeks ends up being pretty exactly about a 300% interest rate. GAO's study found that the prepaid bank cards used to disperse refunds often carried monthly fees of about $5, along with additional charges every time consumers visited the ATM, deposited more money on the card, or if they didn't use the card for a certain period of time. In addition, tax preparers pile on software fees, technology fees, and processing fees to run up the bill even more. One reason tax prep firms can get away with these practices is that customers don't pay fees up front. They always said, "Don't worry about it. We'll just take it out of your refund and you're not even going to notice," as cash client Carly S. said of her former experiences with paid preparers. Another reason so many EITC recipients use these products is that they can't afford tax prep otherwise. One firm interviewed by the Urban Institute indicated that at least 90% of those requesting RALs at his firm cannot pay for tax preparation fees, so they turn to a RAL or a RAC as a way to pay for tax preparation. Though companies argue that taxpayers of all income levels take advantage of these services, lower-income households, many of them EITC eligible, are much more likely to purchase RACs, RALs, and other tax-time financial products. One study by the Urban Institute, for instance, estimates that EITC recipients buy 64% of RALs and of RACs. Households with incomes between $30,000 and $39,000 were 61% more likely to buy a tax-time product than households earning $60,000 or more, according to the GAO. Black-headed households were also more likely to rely on these products than households headed by whites. The result is fat profits for tax prep firms. In 2018, according to the NCLC, Liberty Tax earned more than a quarter of its revenues from refund anticipation loans and refund anticipation checks. It sold these products to a little less than half of all its clients, collecting $42 million in fees that year. In 2014, the most recent year for which figures are available, more than 21 million consumers bought RACs for a combined cost of at least $648 million, according to the NCLC and the Consumer Federation of America. The banks that lend money for RALs and set up the accounts for RACs and refund transfers profit handsomely, too. For instance, H&R Block's financial partner MetaBank, now Pathward, reported $1.84 billion in loan originations for tax services in fiscal 2021 and $1.9 billion in fiscal 2022. Republic Bancorp, which offers easy advance loans through the tax prep firms it works with, reported $250 million in loan originations in fiscal 2021, a sum that the company admits is dependent on the business of EITC recipients. A substantial number of clients utilizing Easy Advance and Refunds Transfer products are consumers that are eligible for the EITC when filing their income tax returns. The company acknowledges among the risk factors disclosed in its 2021 annual report. Losing these customers, the company warns, could lead to a significant decline in usage of the company's tax products and, in consequence, revenues. Federal policy failures help tax prep firms flourish. Despite the abuses rife within the tax prep industry, policymakers have largely failed to act. If anything, some spectacularly misguided policies, in addition to the overall complexity of the tax code that created the industry in the first place, have helped paid preparers maintain their grip on the EITC and the financial fortunes of low-income taxpayers. These policies warrant a closer look. The IRS gave free underwriting for predatory tax time products. Instead of regulating RALs and other toxic tax time products, the federal government for years has actually encouraged their use by offering a service that helped tax time lenders assess the risk of making a loan. Banks typically underwrite a loan before they issue it. They might verify a potential borrower's income and assets and determine the risk of non-payment. Interest rates charged to riskier borrowers are often higher than for other consumers, ostensibly to compensate lenders for the greater possibility of default. In the case of RALs and other tax time loans, the risk of non-payment is low to begin with because the lender pays itself from borrowers' refunds. This fact alone is an argument against the usurious fees charged for these products. The IRS's Debt Indicator program reduced lenders' risks even further by alerting preparers if customers filing electronically had outstanding tax liabilities. If a taxpayer already owed the IRS, the lender could refuse to make a loan. Conversely, no outstanding tax debts meant that preparers could collect their full fees when a refund was issued without fear of non-payment. The bottom line benefit of this service was to give banks and tax prep firms free underwriting for refund loans. The Debt Indicator promotes RALs by assuring lenders that the taxpayer's refunds will be issued, and thus the loan will be repaid, as the National Consumer Law Center wrote in a 2005 critique. As one IRS employee stated, the Debt Indicator was a federally supplied security blanket, and we were doing their credit check for them. The IRS had begun providing the Debt Indicator in the early 1990s, then called the Direct Deposit Indicator, to encourage electronic filing, then just getting off the ground. But the service was discontinued in 1994 because it was thought to be a contributing factor to fraudulent claims for the Earned Income Tax Credit, as the IRS acknowledged in a regulatory notice about the program. The relatively quick turnaround on electronic returns meant that unscrupulous preparers could overclaim refunds and grab their fees before the fraud was even detected, at which point the taxpayer would be on the hook. But after its elimination elicited screams of rage by the RAL industry. As the NCLC put it, citing industry sources, the IRS reinstated the Debt Indicator in 1999. While the IRS justified this service as useful to taxpayers who wish to use their anticipated individual income tax return refunds to apply for bank products, for example, refund anticipation loans, it's clear the RAL industry benefited the most. After the IRS ended the Debt Indicator for the first time in 1994, RAL volume dropped from 9.5 million loans in 1994 to 6 million in 1999. But when the service resumed that year, RAL volume skyrocketed, reaching 12.7 million loans by 2002, according to the NCLC. Sustained outcry from consumer advocates, including the NCLC, finally led the IRS to end the debt indicator for good in 2010, at which point the RAL industry promptly collapsed. In fact, the loss of the debt indicator contributed to the 2011 bankruptcy of Jackson Hewitt, after banks supplying the funds for RALs pulled out of the business. Jackson Hewitt eventually emerged from bankruptcy before it was bought by its current owner, Corsair Capital. But by then, the damage had been done. In 2008 alone, for instance, NCLC estimated RALs skimmed $738 million from the refunds of 8.4 million American taxpayers, with fees running as high as 500% APR. As noted earlier, RALs still survive today, though they've declined in popularity compared to their upstart cousins, refund transfers, and refund anticipation checks. One can only imagine, however, the billions of dollars taxpayers could have saved had the IRS not facilitated the RAL industry for nearly a decade. Congress singles out EITC taxpayers for refund delays. Congress gave the tax time products industry yet another assist, though perhaps unwittingly, when it passed the Protecting Americans from Tax Hikes Act of 2015, or the PATH Act. This legislation includes a provision requiring the IRS to withhold funds from any taxpayer claiming the EITC or the additional child tax credit until at least February 15th. Many taxpayers do refunds file early. Though intended to give the IRS additional time to prevent revenue lost due to identity theft and refund fraud, its biggest impact, advocates say, has been to give cash-strapped taxpayers yet more reason to buy RALs or RACs. People are being incentivized to get whatever mechanism gives them money faster, says the Capital Area Asset Builders Joseph Lightman Santa Cruz. Moreover, these mandated delays discourage taxpayers from opting for the free and federally funded tax preparation service CAAB offers through the Volunteer Income Tax Assistance or VITA program. There is no way to compete with the private sector, says Lightman Santa Cruz. If I have a family of 4 with adjusted gross income below $25,000, they could be receiving as much as $9,400 from the EITC and child tax credits in 1 year alone. But when we inform them that the money will not be received by the family until potentially the middle of March, it behooves them to go to a paid preparer so they'll have access to the money faster, depending on their short-term financial needs at that point. This is how the federal government is undermining its own programs with counterproductive policies. Tax preparers don't have to be competent to ply their trade. Unlike most professions, from barbering to cosmetology to home inspection, tax preparation is utterly unregulated. While the IRS offers tax preparers the opportunity to become enrolled agents who pass a credentialing exam and can represent taxpayers before the IRS, this program is entirely voluntary. 4 states, California, New York, Maryland, and Oregon, regulate tax preparers, but standards vary widely. California and New York, for instance, require preparers to register and take a qualifying class, but do not require a qualifying exam. For some reason, New York also mandates that preparers must certify that they're not 4 months or more in arrears on child support. Maryland and Oregon, however, do require preparers to pass a state test. There are, however, no federal minimum competency standards for paid preparers, and most paid preparers have no credential of any kind, as a coalition of consumer advocates pointed out in a 2016 letter to the Senate Finance Committee. At H&R Block, for instance, about 85% of tax preparers are uncredentialed or unenrolled, according to the NCLC. Becoming a tax prep franchisee is, in fact, ridiculously easy, provided you have the capital to invest and access to tax prep software. Anyone can hold herself or himself out as a return preparer with almost no knowledge or skill by simply sitting with a taxpayer and working through the tax return preparation software's question and answer format, as the National Taxpayer Advocate noted in a 2021 blog post calling for the tax prep industry to be professionalized. At Liberty Tax, which franchises more than 2,500 offices nationwide, its webpage for potential franchisees promises that, contrary to popular belief, you don't need to be a CPA to be a franchisee with us. No prior tax experience necessary, the site continues. What potential franchisees do need, however, is about $75,000 to invest in a storefront, including up to $60,000 in capital costs and $15,000 in franchise fees. Unregulated preparers submit the vast majority of returns claiming the EITC, resulting, predictably, in high error rates. As many as 1 in 4 EITC dollars, between $14.9 billion and $17.6 billion, was issued improperly in fiscal 2017, according to the Treasury Department. About half of the EITC returns prepared by unenrolled or uncredentialed preparers, between 49% and 54%, involved overclaims of the credit. Unenrolled or uncredentialed preparers submit more EITC returns than all credentialed paid preparers combined, writes tax policy expert John Wanchek of the Center on Budget and Policy Priorities. In fact, about 400,000 preparers who prepare more than 13 million EITC claims each year never have to pass any test to certify that they know the tax rules or to take any training on changes in tax rules. In a 2014 investigation by the Government Accountability Office, or GAO, 19 mystery shoppers fanned out across a major metro area, visiting paid tax preparers to ask for help with their returns. Investigators posed as waitresses or mechanics, in both instances with imaginary dependents at home and relatively simple finances, including, for the waitress, wages low enough to qualify for the EITC. Just 2 of the 19 tax professionals scouted by GAO investigators prepared a return correctly, and errors in the refunds due ranged from $52 less to $3,718 more than the correct amount. But because unenrolled preparers are also not authorized to represent taxpayers before the IRS, they don't bear liability for these faulty returns. Instead, they're able to shift the risk of their inexperience or incompetence onto taxpayers, who face the risk of audits, enforcement, and penalties. The IRS audits low-income families at 5 times the rate of everyone else, according to researchers at Syracuse University. In fact, 54% of the audit letters sent by the IRS in tax year 2021 targeted taxpayers earning less than $25,000 and claiming the EITC. This is despite abundant research showing tax evasion to be much more common among high earners, who have far more to gain by cheating on their taxes. Free and return-free filing fail. The industry's biggest wins, however, have been in blocking federal efforts to simplify the tax filing process or to expand access to free filing options for low and moderate income taxpayers, both of which the industry sees as existential threats. In its fiscal 2022 annual report, filed with the Securities Exchange Commission, H&R Block made clear what's at stake. The adoption or expansion of any measures that significantly simplify tax return preparation or otherwise reduce the need for third-party tax return preparation services or financial products could have a material adverse effect on our business and our consolidated financial position, results of operations, and cash flows, the company says in the risk factors it discloses to investors. Offers of free services or products could adversely affect our revenues and profitability, the company goes on to warn. From 1998 to 2013, tax preparation companies spent $28 million lobbying Congress, reports the Sunlight Foundation, with most of that money going toward fighting proposals for return-free filing. In 2020, H&R Block spent $3.5 million on lobbying expenses, while Intuit spent $3.4 million, and affiliates of both companies donated generously to politicians, according to Open Secrets. Donations attributable to H&R Block totaled $870,646 in 2020, including $83,529 to President Joe Biden and $41,139 to former President Donald Trump. Election year contributions attributable to Intuit, meanwhile, totaled $1.1 million, including $146,211 to Biden and $31,852 to Senator Bernie Sanders, Democrat of Vermont. Interestingly, there were no contributions to Trump. As described by economist and former chairman of the Council of Economic Advisors, Austin Goolsbee, return-free filing would allow the IRS to pre-fill tax returns using data already available to it from former employee withholdings and other sources. Filing a tax return would entail nothing more than checking the numbers, signing the return, and then either sending a check or getting a refund, Goolsbee writes in a 2006 report for the Brookings Institution. Such a system, Goolsbee argues, could benefit up to 40% of taxpayers and save up to 225 million hours of time and more than $2 billion a year in tax preparation fees, with much of that benefit flowing toward lower-income taxpayers. According to the Tax Policy Center, 36 countries already offer their citizens some sort of return-free filing. In a series of exposés, the nonprofit news organization ProPublica documented just how thoroughly H&R Block and Intuit have worked to stymie any IRS or congressional efforts to pursue this idea. Both companies have, for instance, advanced legislation effectively prohibiting the IRS from offering taxpayers its own free filing alternative. And to further forestall IRS competition, both firms have worked industriously to promote the Free File Alliance, an industry-led effort that purports to offer free filing options to low and moderate income filers. Under an agreement first negotiated with the IRS in 2002, the alliance commits to offer a free electronic tax filing option for all filers earning less than about $66,000 a year. According to the Alliance's website, up to 70% of taxpayers could qualify for this service. The Alliance has, however, proved to be something of a Potemkin village, far more show than substance. In a 2020 audit, the IRS's Inspector General, or IG, found that only 2.5 million, or 2.4%, of the 104 million eligible taxpayers obtained a free return filing through the Free File Alliance because of the complexity, confusion, and lack of taxpayer awareness. Moreover, the IG concluded, more than 14 million taxpayers met the Free File program criteria and may have paid a fee to e-file their federal tax return. Some companies participating in the program did not clarify, for instance, that taxpayers must use the IRS.gov Free File webpage to qualify for free filing, which meant that some taxpayers mistakenly used commercial websites to file their taxes, thus incurring a fee. Taxpayers also faced inconsistent participation requirements from each of the 12 companies in the alliance, which sometimes meant that taxpayers didn't learn they didn't qualify for free filing until after they had typed in all their information. At this point, the taxpayer has spent significant time to research and select a participating free file company and to enter tax information into that particular company's software, and thus must pay the fee rather than restart the time-consuming process, says the IG's report. This may explain why the members do not disclose all of their exclusionary criteria on the IRS.gov Free File webpage. The IG also noted press reports alleging that some companies even hid their Free File webpage from internet search engines by tinkering with the code. The IG's office independently researched this claim and concluded that 5 companies had coding that prevented internet search engines from displaying the webpage in search results. In 2021, Intuit left the Free File Alliance, arguing that doing so would allow the company to focus on further innovating in ways not allowable under the current Free File guidelines, and to better serve the complete financial health of all Americans through all of our products and services, in tax preparation and beyond. In March 2022, however, barely a year after leaving the Free File Alliance, Intuit was sued by the Federal Trade Commission, or FTC, for deceiving consumers with bogus advertisements, pitching free tax filing that millions of consumers could not use. 2 months later, in May, the company agreed to a $141 million settlement of a suit brought by the attorneys general of 9 states, alleging the company had engaged in deceptive advertising by promising free tax prep and then diverting customers toward paid products. Intuit cheated millions of low-income Americans out of free tax filing services they were entitled to, said New York's Attorney General Letitia James in a statement announcing the settlement. In one major potential setback for the industry, Congress in 2022 gave the IRS a green light to explore return-free filing. As part of the sweeping Inflation Reduction Act of 2022, which also dramatically expanded funding for the IRS, Congress set aside $15 million for the agency to study and design a direct e-file tax return system. It could be years, however, before such a system becomes a reality, especially if tax prep firms, as is likely, fight tooth and nail to block its implementation. Nor is there any guarantee that an IRS free filing alternative would end the hassles and complexity that low-income taxpayers must contend with to access the EITC. The fact remains, the gatekeeper of the federal government's most important anti-poverty program is a profit-making industry whose top priority isn't the well-being of low-income families. What's happened with the EITC illustrates how a parasitic cottage industry can hijack a government program and subvert it to its own ends. As beneficial as it is for low-income families, the EITC is also now a subsidy for corporate interests, paid for by the fees extracted from low-income workers trying to access the benefits to which they're entitled. It would be easy to blame this result solely on the greed of corporations or the unscrupulousness of exploitative entrepreneurs, but that is too facile an explanation, nor will it lead to the right solutions. Banning private tax prep, for instance, won't solve the underlying problem of the tax code's complexity or address the deeper philosophical question of whether the most significant benefit now available to low-income families should be delivered by the IRS. At bottom, the rise and growth of the tax prep industry is a failure of governance, as well as a consequence of Americans' parsimonious insistence that government assistance be reserved for the deserving poor. 2. Corporate welfare. Maximus, Inc. is among a coterie of multi-billion-dollar government contractors anchored in Northern Virginia, a club that includes aerospace giant Northrop Grumman, consulting powerhouse Booz Allen Hamilton, information technology firm SAIC, and countless others, just a short hop from the Pentagon, Capitol Hill, and the CIA's complex at Langley. The company's headquarters occupy a sleek office tower in the Tony suburb of Tysons Corner. Across the street is the Tysons Galleria Mall, which boasts a Saks Fifth Avenue, a Neiman Marcus, upscale eateries like a Japanese donburi place with $20 rice bowls, and boutiques by Italian designers. Maximus's offices are just as luxe. The building includes a cafe on every floor of the building and free healthy snacks, a fitness center with cardio and strength equipment, recharge rooms, and open-concept floor plans with abundant natural lighting, according to a press release about the space, where the company moved in 2022. But unlike its peers, Maximus doesn't supply the government with fighter planes, satellites, or cybersecurity solutions. Instead, it makes much of its money running government-funded anti-poverty programs. Maximus is one of a handful of firms providing turnkey assistance to states that have hired private companies to run their welfare systems or other government services like Medicaid. Maximus manages applications, determines eligibility for benefits, and enrolls recipients in the programs for which they qualify. The company also runs job training programs for beneficiaries who must meet the work requirements established by welfare reform legislation in 1996. The company provides coaching, skills assessment, and career planning services according to its site, as well as help with job placement and training. In Texas, the company has run an integrated one-stop portal for the state's cash assistance or welfare program, Supplemental Nutrition Assistance Program, SNAP, formerly known as food stamps, Medicaid, and the Children's Health Insurance Program, or CHIP, for needy children since 2007. In addition to eligibility and enrollment, the company handles complaints, grievances, and benefit denial appeals. Though not apparent to visitors of yourtexasbenefits.com, the site through which low-income Texans apply for aid from the Department of Health and Human Services, Maximus is the Texas Welfare Agency. These contracts are lucrative. In fiscal 2022, Maximus, whose stock is publicly traded, reported total revenues of nearly $4.6 billion, including $3.9 billion from its domestic operations. It also runs welfare systems abroad. Fees from its contracts with Texas, according to the state's contracts database, will total $1.9 billion between fiscal 2014 and 2024. Though the company launched in 1975, it wasn't until 1996, with the passage of welfare reform, that its fortunes skyrocketed. The law abolished the old federal cash welfare program, Aid to Families with Dependent Children, or AFDC, and created Temporary Assistance to Needy Families, TANF, federally funded but run by the states. The law's provisions also opened the floodgates to commercial interests by ending restrictions on who can administer welfare programs. States overwhelmed by the law's new requirements were quick to outsource to contractors promising expert help. In the first 5 years after reform, Maximus's revenues swelled more than five-fold, from $88.4 million in 1995 to $487.3 million in 2001, according to M. Bernesanger of the Brookings Institution. By 2011, revenues had doubled again to $929.6 million. Nor was Maximus alone in profiting from the new welfare marketplace. Companies as big as Lockheed Martin, as well as niche players like America Works, have all had their finger in the pie. As Maximus notes on its website, approximately $1 trillion is spent annually by federal, state, and local governments, and 80-plus federal programs support low-income households, meaning that the market for welfare services is immense. But while companies like Maximus have benefited handsomely from welfare reform, the intended beneficiaries of safety net programs have fared less well. TANF reaches just a sliver of households in poverty, barely 1 in 5, according to the Center on Budget and Policy Priorities. And the central promise of reform, to move recipients from welfare to work, has proved a sham. Work requirements are all too often about checking the box or having an excuse to shove someone off the rolls than about genuine investments in moving a recipient to economic self-sufficiency. In New York City, for instance, a 2004 to 2005 audit found that Maximus, the city's principal welfare-to-work contractor, had placed just 8% of recipients into jobs, despite a contractually agreed job placement goal of 46%. At the same time, the company had expelled 76% of its clients for perceived rules violations. But in the new world of welfare reform, as Donald Cohen and Alan Mikaelian write in The Privatization of Everything, this counted as a success. And the company's contract was renewed in 2006. As of November 2023, Maximus still had half a dozen multi-million-dollar contracts worth more than $53 million to provide employment services to New York City's Department of Social Services. The national record is no better. Despite the billions in TANF dollars spent on job training and education each year, fewer than half of recipients, 47.1%, were working in pre-pandemic 2019, and 21 states reported that less than a third of their recipients were participating in work activities. What has succeeded all too well, however, is the corporate takeover of social services, facilitated by a decades-long conservative campaign to slash the size of government and privatize it out of existence. Privatization was a defining policy of President Ronald Reagan's administration, and that of President Bill Clinton as well, though under the guise of reinventing the government. In tandem with the devotion of federal power to the states, another conservative priority, privatization and welfare reform generated a surfeit of opportunities for welfare profiteers. Many states' welfare systems are now largely in the hands of private contractors, who enjoy top-to-bottom control of the government benefits many poor Americans receive. They process applications and determine who qualifies, a role once reserved for public agencies. They manage debit cards for delivering cash assistance, collecting fees from both the government and recipients with each transfer or withdrawal. They provide job training and other services to recipients compelled to meet federal work requirements as a condition of receiving aid. Though the stated purpose of welfare reform was to offer low-income families a path into self-sufficiency, its bigger achievement might be the path to riches it created for companies in the privatized welfare marketplace. Government business becomes the business of the government. The man whose work enabled the rise of companies like Maximus is Emmanuel S. Savas, widely acknowledged to be the father of privatization. Over the course of 4 decades, Savas and his allies enshrined privatization as a pillar of conservative anti-government theology and fostered its weaponization by President Ronald Reagan. A former city bureaucrat, Savas credits a snowstorm for sparking his crusade to bring the private sector into government. On February 9th, 1969, a historic blizzard hit the Northeast, burying New York City in 15 inches of snow. The storm paralyzed the city, killing 42 people, injuring 288, and stranding thousands, including more than 200 people who spent a night huddled in the Jamaica station of the Long Island Railroad. Forecasters would later call this event the 100-hour snowstorm of 1969, and it's still the worst recorded nor'easter in history. But it would also be dubbed the Lindsay Storm, after then-Mayor John Lindsay and his administration's catastrophic failure to clear the streets in the storm's wake. Nearly 40% of the city's snow removal equipment was defective, investigations later found, and the city had only 11 bulldozers at its disposal. While the city's sanitation department struggled to cope, garbage piled up as high as the snowdrifts, at the rate of 10,000 tons a day, reported the New York Times. Snowed-in residents emerged to boo the mayor during a tour of the city's cleanup efforts, which he had to conduct in a four-wheel-drive truck after his limo got stuck. Nobel Prize-winning diplomat Ralph J. Bunche, then Undersecretary General for the United Nations, even sent Lindsay a telegram decrying the shameful performance by the great city of New York. Commuting to the UN's Midtown headquarters was impossible, Bunche wrote. I may as well be in the Alps, his missive read. The disaster ultimately derailed Lindsay's political career. He ended up switching parties, from Republican to Democrat, then losing a bid for the Democratic presidential nomination in 1972. But it proved revelatory for Savas, then a relatively junior official in Lindsay's administration. A public servant becomes privatizer-in-chief. As he writes in his 2000 book, Privatization and Public-Private Partnerships, Savas says he discovered the city's sanitation department to be actually out plowing streets only about half the time. The rest was spent on warm-up breaks, fueling breaks, coffee breaks, and wash-up breaks. He wondered if the private sector could do better and discovered his silver bullet, privatization. When he compared the city's services to those of private trash companies, Savas writes, he found that the city's service cost almost 3 times as much per ton of trash collected. He recommended the pilot privatization of garbage services in 3 of the city's 63 sanitation districts, a suggestion that generated both interest and controversy, but stalled along with Mayor Lindsay's post-storm political fortunes. Undeterred, Savas pursued his idea in academia, where he quickly became a self-described advocate for prudent privatization. A lively and persuasive writer, he churned out papers, articles, and books proselytizing from perches at Columbia University and at Baruch College. Savas would soon become one of the nation's most ardent and effective champions of privatization, touting the benefits of abdicating public services to the private sector. His allies would include Stuart Butler of the Heritage Foundation and Robert Poole, Jr., an MIT-trained engineer who co-founded the Reason Foundation in 1978. Another wildly prolific writer, Poole authored a policy paper in 1988 proposing the nation's first private toll road in California, the 91 express lanes now connecting Orange and Riverside counties. The project would inspire hundreds of other public-private partnerships, privatizing toll roads and bridges nationwide. Poole's organization, the Reason Foundation, would also establish itself as the nation's preeminent pro-privatization think tank. The organization extolled the idea's virtues in policy briefs, its namesake magazine Reason, and its annual privatization report, launched in 1986 after a meeting between Poole and arch-conservative billionaire David Koch of Koch Industries, Inc., a Reason Foundation trustee. Populism and public choice. The politics of privatization. Savas was a hands-on advocate, using his bureaucratic expertise to implement the nuts and bolts of privatization in multiple contexts. As an assistant secretary in the Department of Housing and Urban Development, or HUD, under President Reagan, he single-handedly transformed U.S. affordable housing policy through his championship of housing choice vouchers as an alternative to public housing. More on this in Chapter 6. He also took his gospel abroad, advising the governments of Poland, Botswana, and Lesotho, among others. In 1994, he helped to privatize Ukraine's bus service after he noticed long lines for public buses during a 1993 visit. His 1987 volume, Privatization, The Key to Better Government, was translated into 12 languages. But Savas's biggest coup was to popularize the notion that the private sector can replace much of government and improve upon it. He helped to sell the public on privatization's virtues and promoted its mainstream acceptance. He normalized the idea of privately delivered government, which is one reason it doesn't raise more eyebrows today. Savas invented simple but powerful vocabulary to enhance privatization's political appeal. As Cohen and Michaelian put it in The Privatization of Everything, Savas's enticing but thoroughly dishonest language turned governments into monopolies, while citizens became customers and competition emerged as the panacea. Even now, they write, advocates of privatization consistently employ Savas's language and lines of attack, including images of lazy, unionized bureaucrats, looming bureaucracies that are remarkably both inefficient and nefarious, and the utopian promise of competition. In building this framework, Savas drew heavily from the public choice theory of political economy then gaining favor in conservative economic circles. Its creator, James M. Buchanan, would even win the 1986 Nobel Prize in Economics for his work. Public choice theory argues that government agencies, like any other entity, are prone to seek their self-interest above other priorities. Self-interested bureaucrats, the theory goes, strive to maximize their budgets and job security, while the constituencies that benefit from federal spending likewise organize themselves into powerful interest groups committed to preserving the status quo. Insulated from competition, government programs become less efficient and increasingly detached from the public interest. The irony, of course, is that this is exactly what's happened to private contractors who've colonized federal anti-poverty programs, as this book explores. Savas used this line of argument to perfect the art of the attack on public servants, argue Cohen and Michaelian, characterizing even teachers and firefighters as utterly self-interested to the point of, in the case of his hometown, victimizing the entire city and holding all 8 million New Yorkers hostage. Yet Savas also waged his attacks as a champion of good governance, maintaining that the purpose of privatization is to improve government performance and thereby improve the lives of those most dependent on it, as he wrote in Privatization, The Key to Better Government. This disingenuous message, To propose the shredding of government in the name of reforming it would prove especially potent in the hands of President Ronald Reagan. In the name of efficiency and better government, Reagan would gut the safety net and lay the foundation for the current welfare marketplace. Reagan repudiates the Great Society. Like Savas, President Ronald Reagan sensed the populist appeal of bashing big government, and he made dismantling federal government a signature focus of his agenda. Government is not the solution to our problem. Government is the problem, Reagan famously declared in his 1981 inauguration speech. Under his administration, privatization would become official federal policy. Government business would soon become the business of government. Also, like Savas, Reagan positioned himself as a reformer, not a destroyer. It's not my intention to do away with government. It is rather to make it work with us, not over us, to stand by our side, not ride on our back, he said in his first inaugural address. It is no coincidence that our present troubles parallel and are proportionate to the intervention and intrusion in our lives that result from unnecessary and excessive growth of government. Privatization rides the anti-government wave. Reagan's tenure was exceptionally fertile ground for privatization, thanks to an anti-government backlash fueled by a rapid expansion in federal spending, burgeoning concerns over the federal deficit, and public disappointment with the unfulfilled promises of President Lyndon Johnson's Great Society. Between 1960 and 1981, when Reagan took office, federal spending ballooned from $92.2 billion to $678.2 billion in nominal dollars, largely due to the expansion of Social Security and Medicare, but also because of massive increases in social services spending that accompanied the war on poverty. From 1965 to 1970 alone, federal spending on social services nearly tripled, from $812 million to $2.2 billion, according to Stephen Rathgeb-Smith and Michael Lipsky. These sums seem trivial today, but were shockingly large at the time. In contrast to the post-war boom that fueled the optimism of the Great Society, the U.S. economy of the 1970s was faltering, further shaking public faith in the nation's strength. The oil shock of 1973 to 74 triggered a global energy crisis as well as domestic stagflation, stagnant growth coupled with high inflation. The federal budget began running larger and larger deficits during the 1970s, breaking a historic cycle of wartime deficits and peacetime surpluses. It was also clear by then that the war on poverty was falling short. From 1969 to 1970, the number of Americans in poverty grew by 1.2 million. The number of Americans then in poverty, 25.5 million, sent the poverty rate soaring to 13%. A 5 percentage point increase in that single year, even as the welfare rolls swelled. Public confidence in government plummeted. In a 1980 survey, nearly 4 in 5 Americans thought the government wasted a lot of money, compared to 43% who thought the same in 1958. In one 1981 Gallup poll, notes public management expert Don Kettle, Americans thought the federal government wasted as much as 48 cents for every dollar. The result, he writes, of cynicism born of crushed expectations. Especially in the ambitious years of the Great Society, we dreamed such big dreams, to train the unemployed for jobs, to provide housing for the homeless, and most of all, to end poverty. That disappointment was inevitable, Kettle writes in Government by Proxy. Conservatives, moreover, capitalized on Cold War fears of communism to spread fear of the perils of big government and the encroachment of state control. Over the years, we have gradually but steadily transferred the responsibility for financing, supplying, and managing a staggering number of services from the private sector to the state, warned Idaho Republican Senator Steve Sims in a 1982 hearing by the Joint Economic Committee. This creeping collectivization, Sims argued, hampered our economy and prevented most of our citizens from attaining higher standards of living. Big business, in contrast, enjoyed a halo of competence. In the existential fight against communism, and in the face of apparent governmental failings, titans of capitalism became the guardians of democracy and American economic dominance. The celebrity entrepreneurs of the 1980s included Lee Iacocca, whose best-selling 1984 memoir, Iacocca, an Autobiography, chronicled his rescue of the Chrysler Corporation from bankruptcy. Donald Trump, whose 1987 book The Art of the Deal planted him firmly in the American consciousness, and billionaire Ross Perot, whose sponsorship of a daring rescue of 2 employees from pre-revolutionary Iran was memorialized in a 1984 book by Ken Follett and a 1986 miniseries starring Burt Lancaster. These men appeared to epitomize efficiency, creativity, and boldness, traits seemingly missing from government. Anti-government ideologues swooped in to make their case that whatever government could do, business could do better, and that an entrepreneur on their worst day could beat a bureaucrat on their best. There is mounting evidence that government is big rather than strong, that it is fat and flabby rather than powerful, that it costs a great deal but does not achieve much, wrote corporate management guru Peter Drucker in an essay for the public interest. Government has proven itself capable of doing only 2 things with great effectiveness. It can wage war, and it can inflate the currency. Other things it can promise, but only rarely accomplish. The best we get from government in the welfare state is competent mediocrity. More often, we do not even get that. And the more we expand the welfare state, the less capable even of routine mediocrity does it seem to become. Businesses, in contrast, were inherently innovative, flexible, and incentivized to be effective, Drucker argued. Of all social institutions, it is the only one created for the express purpose of making and managing change, he wrote. Reagan took these sentiments to heart. To make good on his intention to curb the size and influence of the federal establishment, Reagan used 2 high-profile commissions to showcase his efforts. The first of these was the so-called Grace Commission, headed by J. Peter Grace, CEO of the chemical company W.R. Grace & Company. Its official name was the President's Private Sector Study on Cost Control in the federal government, and involved the recruitment of about 2,000 business executives to look for ways to root out waste in federal spending. In his autobiography, An American Life, Reagan says the idea for the Grace Commission came from a similar effort he launched as governor of California to streamline the state government. The idea had worked in Sacramento. Why not in Washington? He wrote. The Commission's 1984 report came back with about 2,500 recommendations. Excellent fodder for Reagan's crusade to badmouth government and extol business's virtues. These volunteers discovered things going on in government that businesses hadn't been doing for a generation, Reagan wrote. For example, it cost the Veterans Administration between $100 and $140 to process, not pay, a medical claim, versus $3 to $6 for doing the same thing at private insurance companies. The Army spent an average of $4.20 on administrative costs to issue a paycheck versus an average of $1 in private business. Reagan later claimed that he implemented nearly 800 of the Commission's recommendations, which saved taxpayers tens of billions of dollars and kept the deficit from growing even larger than it did. For example, he boasted, we eliminated 75 federal printing offices that we didn't need and eliminated about half the government's publications, including such bestsellers as How to Buy Eggs. In his second term, Reagan appointed the President's Commission on Privatization to identify the swaths of government the private sector could take over. The Commission's resulting 1988 report included sweeping plans to privatize everything, from low-income housing, public schools, and air traffic control to jails and prisons and Medicare. At the same time, Reagan proposed a sustained campaign of deep reductions in federal anti-poverty spending, with the goal of shrinking the government's role in fighting poverty. During his first year in office, Congress passed a historic $35 billion in budget cuts, including $25 billion in reductions to AFDC, food stamps, housing assistance, Medicaid, and other programs for those living in poverty. Clinton reinvents government. Nevertheless, Reagan was not America's pro-privatization president, as Reason Foundation co-founder Robert Poole would point out in his essay in the 20th anniversary edition of the Annualized Privatization Report in 2006. In fact, Poole writes, the Clinton administration's privatization successes exceeded those of Reagan. These successes would include the dramatic expansion of the markets for human services after welfare reform in 1996. Coupled with the devolution of federal programs to state and local control, Clinton's embrace of privatization would birth the current corporate marketplace of social services that controls so much of the lives of those living in poverty. If Reagan launched the privatization revolution, Bill Clinton would complete it. Like Reagan, Clinton discovered that anti-government rhetoric was good politics. His co-option of privatization helped resurrect the Democratic Party's electoral fortunes, even as the long-term consequences of his policy decisions would prove dire. By the time Clinton won the presidency in 1992, Democrats had suffered 3 embarrassing failures in their efforts to capture the White House. Reagan had crushed President Jimmy Carter in 1980, winning the Electoral College 489-49, and humiliated Walter Mondale in 1984, with an Electoral College tally of 525-13. Reagan's defeat of Mondale was in fact the 5th biggest landslide in U.S. history, outdone only by Franklin Delano Roosevelt's lopsided victory against Alf Landon in 1936. James Monroe's election in 1820, he ran unopposed, and George Washington's 2 terms won by universal acclamation. In 1988, Reagan's vice president, George H.W. Bush, continued the GOP streak, trouncing former Massachusetts Governor Michael Dukakis with an electoral college vote of 426-111. While Dukakis' disastrous campaign might be best remembered for his infamous photo op atop an M1 Abrams tank, Bush also successfully capitalized on anti-government sentiment, labeling Dukakis a Massachusetts liberal who favored high taxes and big government. Clinton, who was serving as governor of Arkansas when he decided to run for president, refurbished the Democratic Party's image. Working with the Democratic Leadership Council, a coalition of moderate and conservative, mostly Southern Democrats, Clinton ran as a fiscally conservative New Democrat who pledged to balance the budget, get tough on crime, and to end welfare as we know it. His goal was to win back the centrists and Reagan Democrats who had defected to the GOP, and to rebuild a Democratic center-left coalition that could break Republicans' electoral dominance. He co-opted Republican talking points on welfare reform and taxes while seeking progressive goals, a third-way strategy that Democratic consultant Dick Morris would later famously call, and critics would later deride as, triangulation. Clinton also adopted Reagan's critique of government, in repudiation of perceived big government apologists like Carter, Mondale, and Dukakis. Bill Clinton and Al Gore are a new generation of Democrats, and they don't think the way the old Democratic Party did, says an ad from the 1992 campaign. Clinton's balanced 12 budgets, and they've proposed a new plan detailing $140 billion in spending cuts they'd make right now. Clinton fulfilled his pledge of reform by launching Reinventing Government, after a 1992 book of the same name by journalist David Osborne and longtime city manager Ted Gabler. In 1993, Clinton ordered a national performance review of the federal government's effectiveness, which resulted in a massive report titled From Red Tape to Results, Creating a Government That Works Better and Costs Less. Its preface, signed by Clinton and Gore, was Reagan-esque, but optimistic. We can no longer afford to pay more for and get less from our government. The answer for every problem cannot always be another program or more money. It is time to radically change the way the government operates, to shift from top-down bureaucracy to entrepreneurial government that empowers citizens and communities to change our country from the bottom up, We must reward the people and ideas that work and get rid of those that don't. Perhaps one of the few, maybe only public management books to crack the New York Times bestseller list, Osborne and Gabler's Reinventing Government articulated a highly readable, inspirational vision of what government could and should be. Drawing on case studies from across the country, the authors promoted a new model of entrepreneurial government that is lean, decentralized, and innovative, flexible, adaptable, and quick to learn new ways when conditions change. And in an echo of Drucker and Savas, Osborne and Gabler touted competition, customer choice, and other non-bureaucratic mechanisms to get things done as creatively and effectively as possible. In Phoenix, Arizona, for instance, the Public Works Department revamped its trash collection services after losing bids to private contractors and eventually won back the city's business. The Illinois Department of Public Aid started adjusting the amount of Medicaid reimbursements nursing homes received based on publicly available quality ratings, resulting in better care for residents and more information for consumers. Osborne and Gabler also popularized the idea of market-oriented government, policies that structure markets to achieve a public purpose or use market mechanisms to nudge private actors toward publicly beneficial aims. This philosophy underlay the creation of programs such as the New Markets Tax Credit, established in 2000, which provided tax credits to developers investing in low and moderate income neighborhoods, and the Low Income Housing Tax Credit, LIHTC, created in 1986 but made permanent in 1993, which subsidizes the construction of affordable housing. More on this in Chapter 6. Programs like these are also a form of privatization, though perhaps not as direct as contracting, because they rely on the private sector to ultimately deliver a desired service. Under the LIHTC, for instance, developers build privately run affordable housing complexes in exchange for tax credits, instead of the government building public housing. Despite their enthusiasm for competition and performance-based business practices like total quality management, the management system devised by W. Edwards Deming that became ubiquitous in the 1980s, Osborne and Gabler were careful not to oversell the virtues of privatization. Privatization is one arrow in our government's quiver. But just as obviously, privatization is not the solution, they wrote. Those who advocate it on ideological grounds because they believe business is also superior to government are selling the American people snake oil. But as theory turned into practice, the battleship that is the federal government proved difficult to steer. As envisioned by Osborne and Gabler, reinventing government requires enormous investment up front to delineate a program's goals, pinpoint the right outcomes, and establish systems for accountability. It also requires creativity alien to bureaucratic thinking. Perhaps inevitably, reinventing government defaulted to shrinking it. Clinton began his second term in 1996, declaring that the era of big government is over. By 1998, 2 years into Clinton's second term, the administration bragged of having cut the federal workforce by 351,000 workers, making it the smallest since Kennedy held office and, as a percentage of the national workforce, the smallest since 1931. While the vast bulk of these reductions came from cuts in defense spending, a result of the peace dividend accompanying the end of the Cold War, the administration also used privatization as a strategy to slim down the federal payroll. Hence, the Clinton years saw the privatization of the Naval Petroleum Reserve and the Helium Reserve, the U.S. Enrichment Corporation, the Alaska Power Marketing Administration, Sallie Mae, and a serious effort to create a nonprofit corporation to take over air traffic control, as the Reason Foundation's Poole wrote in 2006. In 1998, Clinton signed the Federal Activities Inventory Reform, or FAIR Act, which accelerated privatization still further by requiring agencies to create an annual list of the functions performed that are not inherently governmental and that could be contracted out. The result has been what some analysts call a shadow government of contractors, who now vastly outnumber federal employees. From 2000 to 2006, federal spending on contracts mushroomed from $203 billion to $412 billion, according to public management expert Don Kettle. By 2017, federal contractors and grantees employed a total of 5,162,800 full-time workers, according to New York University professor Paul Light, compared to 1,956,900 workers directly on the federal payroll. That's 2.6 contractors for every federal employee, versus a ratio of 1-to-1 in 1984. This overall ratio, however, masks significant variations from agency to agency. In the Department of Agriculture, for instance, federal workers still outnumber contractors, according to Light, while defense contractors outnumber federal employees 3.5-to-1. But the single most outsourced agency by far is the Department of Health and Human Services, or HHS, which runs the government's principal safety net programs, such as welfare and Medicaid. There, the ratio of contractors and grant employees to federal workers is a whopping 35.9-to-1. Coming in at a distant second is the Department of Transportation, where contractors outnumber feds 10.4-to-1. In 2017, Light finds, HHS employed a mere 15,500 federal employees, while supporting 556,800 full-time workers in the private sector, including those at both for-profit and not-for-profit entities. While governments have long relied on nonprofits to deliver social services at the local level, the federal welfare reform legislation signed by Clinton in 1996 turbocharged a shift in the administration of anti-poverty programs from government to the private sector. Welfare as we know it becomes the business of poverty. The welfare reform legislation signed by Clinton in 1996 was historic in its scope and impacts. It scrapped a 60-year-old entitlement and replaced it with a time-limited conditional benefit that dramatically reduced the number of recipients and pushed many back into poverty. It transformed what had been a central pillar of the safety net into a vestige of itself and radically altered the government's relationship with the poor. It also launched a gold rush among companies eager to stake out fresh territory, including those with no connection to the welfare system. In 1996, the New York Times reported on a three-way bidding war that pitted a subsidiary of defense contracting giant Lockheed Martin against two other megafirms, Anderson Consulting and Electrona Data Systems, the company founded by Ross Perot. The prize was not a new weapon system for the Department of Defense, but a $563 million contract to run the Texas welfare system. The winner would not only process benefits for the 255,000 Texas households then on welfare, but also set up systems to determine eligibility for new recipients and monitor their compliance with the new requirements of the 1996 welfare reform legislation. This is the same contract, incidentally, now held by Maximus. The Texas contract was only one of many similar contracts with other states that Lockheed and its competitors were hoping to nab. We're approaching this marketplace the way we approach all other marketplaces, as Holly Plug, Senior Vice President of Business Development at Lockheed Information Management Services, told the New York Times. By 1997, the Orlando Sentinel reported Lockheed IMS had inked 11 contracts in 3 states, including multiple deals in Florida for welfare services and child support enforcement. According to the Sentinel, the company collected $5.5 million from the state for collecting $46.6 million in delinquent child support from 1996 to 1997. It was also set to receive $2.8 million for providing counseling, training, and education to welfare recipients in 4 Florida counties surrounding Orlando. The 1996 law included several features that encouraged states to outsource their welfare programs to private companies. First was its radically divergent funding structure. Instead of paying directly for benefits, as was the case under AFDC, TANF provided block grants to states to spend as they saw fit, so long as they met federal requirements. States could design their own rules, programs, and delivery systems, so long as they met federal targets for work participation and other performance measures. This flexible funding freed states to rely more heavily on contractors if they wished, and many did. Second, the law removed restrictions on who could administer welfare programs. Before reform, deciding who could qualify for benefits was exclusively in the domain of public employees. Federal law essentially prohibited states from contracting out initial welfare intake and eligibility determination functions, according to the Urban Institute. The 1996 legislation, however, allowed states to delegate these responsibilities to private companies, including for-profits. States could, in fact, contract out the entire system, as Texas did in soliciting Lockheed's bid. Third, the law's new work requirements, convoluted and complex, required the creation of massive new bureaucracies to monitor recipients' compliance. Work could include up to 6 weeks of job search and could include a wide variety of activities, including paid internships, community service, job training, or vocational education, each of which had to be tracked and tallied. The number of work hours required per week per recipient also varied. Single mothers were initially required to work 20 hours a week, but would have to work 30 hours a week by 2000, while recipients in two-parent families had to work 35 hours weekly. The law also required each state to raise the share of welfare recipients working, as defined by the law, from 25% in 1997 to 50% by 2002. That meant tracking overall data on applications, caseloads, work participation, and spending. States that pushed a lot of families off the rolls could qualify for a caseload reduction credit that reduced the target percentage of recipients who had to work, but that too required monitoring and accounting. States, moreover, faced a maintenance of effort requirement, which mandated that they match a portion of federal dollars with state funds and use at least some of it for work supports, such as childcare. This was yet another detail to be tracked and reported. In addition, the legislation included a crackdown on child support enforcement, requiring each state to operate a child support enforcement program meeting federal requirements to receive TANF funding. Among other features, these new systems had to include a central registry of child support orders, as well as centralized collections. States were also required to work with each other so that delinquent dads could be tracked across state lines. Privatization appealed to the states because of concerns over cost and the need to meet specific federal goals very quickly, as the Urban Institute notes. Companies like Lockheed and EDS promised an instant expertise in setting up complex data and accounting systems. The market for TANF administration and services sprouted virtually overnight. Whereas the primary activity of state welfare programs pre-1996 was cutting checks, the new law now required states to provide recipients with a wide array of services to facilitate their transition to work. These mandates created extraordinary pressures on the service capacity of existing public agencies to find and engage large numbers of clients. M. Brina Sanger wrote for the Brookings Institution in 2003. Compliance required the provision of intensive and extensive services on a large scale to serve 2 to 3 times more clients than were previously serviced. By 2001, Sanger writes, states were spending more than $1.5 billion on contracting out for TANF-funded services, and in 19 states, more than a quarter of those funds were going to for-profits. States contracted out everything: job training and employment services for welfare to work, child welfare services such as foster care and adoption placement and mental health treatment, child support enforcement systems, including payment processing, parent location, and paternity establishment, and TANF-related services, including case management, child care, transportation, and other supports for recipients entering the workforce. Corruption, favoritism, and cronyism. Unsurprisingly, controversies trailed the deluge of TANF dollars into states as companies battled for lucrative contracts and state agencies adjusted to the sudden shift in their roles from service providers to contract managers. Contrary to the grandiose promises of privatization advocates, privatized welfare was neither cheap nor effective. One of the more attention-grabbing scandals involved Wisconsin's welfare program, Wisconsin Works, or W2, Widely celebrated for its success in welfare to work, W-2 was in fact the model for the 1996 law. The brainchild of then-Governor and future Secretary of Health and Human Services, Tommy Thompson, W-2 was the first state program to experiment with work requirements and time limits on benefits, under waivers from federal law granted first by the George H.W. Bush administration and then President Clinton. Thompson signed W-2 into law in April 1996, 4 months before Clinton signed his historic welfare reform legislation. Soon after, W-2 was in the hands of 5 contractors, including Maximus, tasked with administering the program. In 2000, state auditors released a report questioning more than $1.6 million in expenses Maximus incurred using W-2 funds, including a $23,000 payment to a nationally known musical performer for a speech to 40 W-2 participants and Maximus employees, and $15,471 for holiday parties, hotel rooms at Lake Geneva, and other social events. The company spent $22,248 on restaurant meals, for which there was no documented business purpose, $1,498 on flowers, and as much as $1.1 million on advertising, including $104,900 for backpacks, fanny packs, and coffee mugs with imprints of the Maximus name. Other investigations alleged that Maximus was as ineffective as it was wasteful. 10 months after W-2's launch, 67% of Maximus's clients had no work assignments, according to New York Times reporter Jason DeParle in a 2004 book on the aftermath of welfare reform. Many clients waited months for assignments, he wrote. Others ignored their assignments and got paid anyway. In the country's most famous work program, only 8% of clients were working in paid jobs. At around the same time, Maximus was under fire in New York City, where the company had won $104 million in welfare-to-work contracts in 1999. Then Comptroller Alan Hevesy tried to block the contracts, citing corruption, favoritism, and cronyism in the bidding process under then-Mayor Rudy Giuliani. Hevesy accused the company of failing to disclose its ties with former senior members of the Giuliani administration, one of whom allegedly helped to prepare the company's bid. The dispute embroiled the city in litigation for a year before the contracts finally took effect. Maximus wasn't the only contractor caught in controversy in the years leading up to and after reform. A New York Times investigation of the for-profit welfare-to-work provider America Works concluded that the company performed poorly and cost too much, despite enthusiasm for the firm's approach from both Mayor Giuliani and then New York Governor Mario Cuomo. Under a 1989 contract with New York State, said the Times, the state paid nearly $1 million to the company in job placement fees for people who never found permanent work. The Times also noted that Ohio had canceled a contract with the company after calculating that placement costs were totaling $24,000 per person and had a low rate of success. Subpar contracting practices were one reason for these failures. Because of the Reagan-era's attack on government, says public management expert Don Kettle, oversight is weak and capacity is low. It's relatively easy for contractors to get by with all kinds of things. States were learning how to manage contractor performance, on the one hand, while on the other, companies were writing provisions to benefit themselves. Lockheed Martin's 1997 bid to provide welfare services in Florida, for instance, proposed a fee of $450 for each person it processes, regardless of whether the person finds a job, the Orlando Sentinel reported. Moreover, the bid contained a built-in $260,000 profit and an additional $117,000 line item for overhead. At the time of the New York Times investigation, America Works received about 20% of its $5,500 fee per recipient, simply for enrolling clients in its program, whether or not the welfare recipients get jobs. In the case of Maximus and W-2, reporter Jason DeParle found, the state had budgeted for 50,000 recipients with the passage of reform, but only 23,000 enrolled. Awash in extra funds, writes DeParle, the state had little incentive to cut costs. while Maximus found itself with a big pot of someone else's money to spend. Hence the holiday parties, concerts, and Maximus-branded fanny packs. A 2003 report on the privatization of welfare services commissioned by the U.S. Department of Health and Human Services, or HHS, warned against multiple unintended consequences, potentially resulting from poorly worded contracts. Contractors may find work to find a job for the client quickly, but not help clients to find jobs that offer high wages, benefits, and the possibility of upward mobility. This may occur if performance standards focus on placement only. Contractors may choose to place fewer resources into contacting clients and enrolling them into the program if they believe that those who are harder to enroll are less likely to have positive outcomes. Contractors may put less effort into conducting thorough assessments and making appropriate referrals for clients if performance measures focus only on employment outcomes. Contractors may attempt to fine-tune service data in order to influence performance measures, for example, by estimating hours for work participation generously. The report also cautioned that competition, the driving rationale behind privatization, is not automatic, and can, in fact, be difficult to achieve. And in truth, the vaunted benefits of competition never came to pass. The biggest problem, as public management expert Don Kettle points out, is that there isn't an independent market for welfare services. Social service programs are in existence only because the government has chosen to fund them, he says. Because they create the market, governments are essentially dealing with a small collection of suppliers for whom there aren't ready alternatives, says Kettle. And once a provider lands a contract, the advantages of incumbency kick in, reducing the odds that a new provider will take over a contract when it's up for bid again. States are at the mercy of a handful of firms that even now maintain an oligopoly on welfare services. Contractors get fat. TANF shrinks. The growth of companies like Maximus hollowed out the nation's welfare system. Cash assistance, once a pillar of the safety net, now reaches just a fraction of households in poverty and is meager gruel to boot. Caseloads plummeted in the aftermath of welfare reform, from 12.6 million recipients in 1996 to 4.3 million by 2001. In 2022, TANF served just 1.9 million Americans. Despite the unparalleled hardship brought on by the coronavirus pandemic, which should have swelled the rolls as unemployment surged, participation fell to historic lows in 2020, according to the Center on Budget and Policy Priorities, CBPP. The program reached just 21% of families living in poverty in 2020, compared to 68% in 1996. In 14 states, says the CBPP, TANF reached less than 10% of impoverished households. In some states, like Michigan, TANF is practically non-existent, even though the state's poverty levels are consistently higher than the national poverty rate. The state's average monthly TANF caseload in 2022, for instance, was just 8,729 families out of nearly 4 million households, a record low cash assistance rate, according to Peter Rourke, a senior policy analyst at the Michigan League for Public Policy, MLPP. This despite the fact that the state received $777 million in federal funding for TANF in fiscal 2020. Moreover, very little TANF funding now goes toward cash assistance directly benefiting recipients. Of the $31.6 billion in total federal and state spending for TANF in 2020, only 22% was spent on cash benefits, while 10% went toward program management and the remainder toward a smorgasbord of work supports, such as child care or to supplement state spending on child welfare and other services. In Michigan, the state used the money freed up by having a lower caseload as a slush fund for itself. MLPP's Rourke discovered that TANF money was funding college scholarships largely flowing to wealthy students attending private schools, which was perfectly legal under the flexibility afforded by the law. The general purposes of TANF are so broad, you can drive a truck through the loopholes, Rourke told me. Most tragic, TANF has failed to bring recipients the promised path to self-sufficiency through jobs. In fact, many families are worse off. A review of federally funded welfare-to-work programs from 1996 until 2004 showed modest impacts at best, with most participants unable to find stable employment. Those who did work earned an average wage in 2004 dollars of only $8 an hour and had no access to employer-sponsored benefits like health insurance, albeit many continued on Medicaid. Welfare recipients subject to work requirements were more likely to live in deep poverty than to have incomes above the poverty line, according to a lengthier 2016 analysis by the Center on Budget's LaDonna Pavetti, whose data included the Great Recession. Gains in earnings were minimal or offsets by cuts in benefits, and many recipients were trapped in dead-end, low-wage jobs. A 2023 investigation by the Uncertain Hour podcast on public radio likewise found that the welfare-to-work industrial complex often places poor and vulnerable Americans into jobs that do not support their families and often leave them on government assistance. Contractors, however, continue to make hay. In New York City, for instance, Maximus has expanded its turf and is running the state's Medicaid program as well. It won a 13-year, $2.9 billion contract that runs through 2025. That's in addition to its contracts for employment services mentioned previously. America Works also still enjoys multiple contracts in New York. Checkbook NYC lists 9 contracts totaling $55.8 billion for employment services to be provided across the city through 2023. The ultimate irony is that for all the talk of welfare reform's stated goal to end dependency, the statute in fact birthed a new class of dependents, the companies reliant on government funding of social programs for their existence. Maximus, for instance, disclosed in its annual report for fiscal 2022 that 35% of its revenues for the year came from state contracts and 49% from contracts with the federal government, with the remainder coming from foreign government contracts and municipalities. Contracts with the state and city of New York alone accounted for 9% of the company's total revenue in 2021, according to the firm's 2021 annual report. Maximus's reliance on public money is a fact the company acknowledged in the risk factors section of its 2022 annual report. Any significant disruption or deterioration in our relationship with federal, state, and local governments, and a corresponding reduction in these contracts would significantly reduce our revenue and could substantially harm our business. Conservatives win. Gutting the federal safety net, consequences be damned, is likely what the conservatives who initially agitated for welfare reform have wanted all along. Privatization was an instrument and accelerant of that destruction. The old welfare system, AFDC, unquestionably needed reform. When the program was created in 1935, its purpose was to support young moms who'd lost their breadwinner husbands. It was originally designed for white widows, a population deemed deserving of aid, and one expected to stay home and raise children rather than enter the workforce, as noted by Vox. Eligible families received benefits indefinitely, so long as they met the definitional criteria for eligibility, and their income stayed below a certain level. Like Social Security, it was an entitlement program for all who qualified, which meant federal spending was unlimited. Conservatives blamed the program for discouraging work and rewarding single parenthood because it predicated eligibility on the absence of a second parent who could help support a child. Even liberals did not like the program's disincentives for work because every dollar earned at a job meant losing $1 of benefits, a punitively high marginal tax on beneficiaries. Analysts at the left-leaning Urban Institute, for instance, called AFDC the twice poverty trap, because work at even 2 times poverty level income, or more precisely, 2 or 3 times minimum wage, often yields little reward. The 1996 legislation, however, was less a reform of AFDC for better than a wholesale surrender to conservative demands for personal responsibility from mothers living in poverty. In fact, the official name of the law is the Personal Responsibility and Work Opportunity Reconciliation Act of 1996, PRWORA. This capitulation, however, was born of the politics of necessity. In repudiation of Clinton's victory in 1992, the GOP roared into Congress with the 1994 midterm elections, winning 54 seats in the House and 8 seats in the Senate. Republican House candidates also won a majority of the popular vote for the first time since 1946. Instrumental to these victories was the GOP's Contract with America, a 10-point legislative plan that promised middle-class tax cuts, term limits for legislators, and budget reform, among other priorities. Drafted by soon-to-be House Speaker Newt Gingrich and future House Majority Leader Dick Armey, the agenda also included an exceptionally harsh proposal for welfare reform, which would become the blueprint for the 1996 law. As initially contemplated, the GOP's proposed Personal Responsibility Act denied welfare benefits to mothers under age 18 and gave states the option to deny benefits and housing to mothers under age 21, allowed states to kick recipients off the rolls after just 2 years, required mothers to declare the paternity of their children as a condition for receiving benefits, and required all recipients to work at least 35 hours per week. Most significantly, the bill proposed to end welfare as an entitlement, instead converting the program into the fixed lump sum block grants to states that TANF is today. Clinton had already vetoed 2 GOP reform efforts as too punitive, but the results of the 1994 election shifted political momentum in the GOP's favor. By then, Clinton's failure to pass welfare reform, despite his pledge in 1992 to end welfare as we know it, also threatened to become a problem for his re-election campaign. Unwilling to risk the political fallout from a third veto, Clinton signed PRWORA on August 22, 1996, despite acknowledging the legislation had serious flaws. He reportedly described the measure as a decent welfare bill wrapped in a sack of shit, according to Time. Unfortunately, the bipartisan imprimatur Clinton bestowed on welfare reform has since calcified the politics of poverty. Unwinding major elements of the 1996 legislation, such as its block grant structure and work requirements, would take a miracle politically. Conservatives have moreover doubled down on the idea of work requirements as a condition of receiving benefits. The Trump administration, for instance, proposed in 2019 to tighten work requirements that the 1996 welfare law also imposed on some recipients of SNAP, or food stamps. The U.S. Department of Agriculture estimated that those restrictions would have ended benefits for about 688,000 Americans. President Donald Trump also approved efforts in 13 states to impose work requirements on Medicaid beneficiaries. Most of these initiatives, however, were later struck down by courts and rescinded by President Joe Biden. One exception is Georgia, where a federal court in 2022 allowed the Georgia Pathways program to continue. Rather than move low-income Americans out of poverty, these efforts are purely punitive and aimed at preventing idleness rather than creating genuine opportunities for advancement. For much of the nation's history, however, work has separated the deserving from the undeserving poor, and policymakers remain committed to training and educating as the path to self-improvement for impoverished Americans with limited skills. Absent a radical and unlikely shift in the politics of poverty, work requirements are here to stay. 3. Bridges to Nowhere. International College is a for-profit school in East Los Angeles, California, where 96% of residents are Hispanic, more than a quarter of children live in poverty, and only 9% have a bachelor's degree or higher, compared to 36% statewide. In the fall of 2022, International College offered just 5 courses, including basic graphic design, small business bookkeeping, computer operation and applications, and an online cake decoration class for $5,100 that promised to teach students how to properly bake and ice a cake, as well as how to cover a cake board. According to the school performance fact sheet that all for-profit schools must file with the state of California, the school enrolled 86 students in its bookkeeping class in 2020, 34 of whom finished. Just 33 students completed the graphic design class out of 105 who enrolled. Cake decoration boasted a 100% completion rate in 2020, but only 3 students took the class. Utterly unknown is whether any of the graduates of International College landed jobs because of their new credentials. Although the state requires for-profit schools to disclose job placement rates and wages, International College's report includes none of this data. Tables meant to display this information showed rows of NA instead. Yet despite its spotty record, International College is one of about 1,000 eligible training providers and more than 5,700 programs approved by the state of California to receive federal training dollars under the Workforce Innovation and Opportunity Act, WIOA, the federal government's largest workforce development program. Under WIOA, Congress appropriates nearly $3 billion a year to fund worker training programs through a network of nearly 2,400 American job centers. Unemployed and underemployed workers eligible for WIOA assistance get individual training accounts with a set amount of funds, typically capped at about $3,500, to pay for training from approved providers on a state eligible training provider list, the ETPL. If you visit caljobs.ca.gov, you'll see International College on the list of WIOA-approved programs. California's ETPL includes high-performing institutions, but they are hard to distinguish from lesser schools and questionable for-profits. These include the Stellar Career College in Modesto, whose students earn a not-so-stellar median annual income of $25,723, according to the Department of Education's College Scorecard, and UEI College, Gardena, where 93% of students take out federal loans and 22% are in default or delinquent. Also on California's approved list is American River College, a community college in Sacramento, with a 33% graduation rate, and various branches of the Milan Institute, a for-profit cosmetology school that, among other things, offers a 50-week course in barbering for $18,493.86. Substandard job training options are par for the course nationwide, not just in California. While federally funded job training has been a key strategy in the war on poverty since its inception, it's also been resoundingly unsuccessful. Dislocated workers, disadvantaged young adults, and other vulnerable populations lack a clear path to the skills they need for a well-paying job, despite the billions of dollars invested in training programs. Job Corps, for instance, is the federal government's largest and longest-running program for low-income youth, but the government's own auditors consider it a failure. No training program can compensate for underperforming K-12 schools or for the absence of jobs in impoverished communities. Training can't remedy the lack of childcare, transportation, health insurance, or steady housing that poses insurmountable hurdles for many low-income workers. Policymakers also haven't defined what a good training program is. The surest test might be whether a graduate lands a job. But what kind of job, for how long, and at what wage? None of these challenges, however, excuse the poor performance of a privatized job training industry that profits from lax oversight, public indifference, and public policies that demand activity on the part of benefits recipients but are far less concerned about outcomes. Federal training dollars support myriad for-profit schools like International College. Contractors run many of the federal one-stop centers that offer job placement and other services to unemployed or dislocated workers, with desultory results. An oligopoly of contractors has a tight grip on Job Corps, the program for youth that's been flailing for decades. Propping up the training industry is the public's insistence that recipients of public aid must earn their benefits through work. Though this sentiment hasn't led to the commitments necessary to ensure that low-income workers truly get the means to reach self-sufficiency. Supporting work is a central tenet of American social policy, but the abandonment of this goal to private interests has meant the promise of work is often empty. An alphabet soup of training failures. What's happened with WIOA and its eligible training provider lists is only the latest in a long line of disasters for government-funded job training programs. Over the last half-century, Congress has passed a slew of legislation authorizing billions of dollars for job training to benefit unemployed and low-income workers. But the federal government has consistently failed to design effective programs or to maintain adequate oversight over funding and implementation, a situation that's allowed the training industry's mediocrity to go unchallenged. The first wave of programs began even before the War on Poverty, with the Manpower Development and Training Act of 1962, MDTA. Its purpose was to retrain workers whose skills had become outmoded or had been replaced by automation. 2 years later, with the launch of the War on Poverty, Congress passed the Economic Opportunity Act of 1964, which created the Job Corps and Neighborhood Youth Corps programs for young adults, as well as the Work Experience and Training Program for welfare recipients. In 1968, Congress created the Work Incentive Program, or WIN, popularly known as Workfare, and in 1971, it passed the Emergency Employment Act, which authorized the creation of public jobs for the unemployed, in an echo of President Franklin D. Roosevelt's WPA. In addition to these larger programs, there were a spate of small efforts, including Operation Mainstream, which targeted unemployed adults aged 55 and older, the Job Bank Program, which aimed to aggregate listings for public jobs, the Jobs Program, an on-the-job training program, the Public Service Careers Program, yet another on-the-job training program, the Opportunities Industrialization Centers Program, which funded community-based employment and training centers, and the Concentrated Employment Program, also a community-based employment training program. None of these programs succeeded. In a 1972 survey of these efforts, the Government Accountability Office, GAO, identified 11 major areas needing improvement, including program design, eligibility and screening, counseling, occupational and academic training, job development and placement, monitoring, follow-up, program planning, supportive services, management information systems, and fiscal and financial matters. In other words, nothing worked. Further audits uncovered more problems. The Neighborhood Youth Corps, for instance, was supposed to reduce high school dropout rates, but the GAO found that dropout rates actually rose in locations where the programs operated. At some on-the-job program locations, either workers received no training beyond that normally provided to new employees, or the training involved menial tasks, such as custodial and cleaning work in buildings, rather than learning new job skills. The Concentrated Employment Program placed just 37 people in jobs over a 14-month period in Central and East Harlem, out of a program goal of 1,875 placements, while enrollees in the Mississippi Delta ended up in jobs that didn't match their training. For example, a person trained as a welder was placed as a janitor, and an automobile mechanic as a maintenance man, said the GAO. Among the many problems at both locations were training curricula that didn't meet enrollees' needs, inadequate staffing, fragmentation of responsibilities, and contracts that didn't demand accountability for results. In 1973, Congress tried to clean house with the passage of the Comprehensive Employment and Training Act, or CETA. Unlike the earlier generation of training programs, under which the Department of Labor directly administered nearly 10,000 separate grants to public and private training providers, one reason for MDTA's unimpressive results. CETA granted funds to about 400 state and local governments as prime sponsors to create training opportunities for the unemployed and public service jobs in sectors like public works, social services, and parks maintenance. From 1974 to its expiration in 1982, the federal government spent more than $51 billion on CETA, which at its peak funded about 725 public service jobs a year, in addition to 1 million training slots. Legislators hoped that CETA's model of state and local governance would lead to better training opportunities attuned to local needs, as well as better oversight. But scandals overshadowed its successes. In Chicago and St. Louis, for instance, CETA became a source of political patronage for city officials who hired relatives or other favored individuals. Some studies found that SEDA jobs didn't add to total employment, but instead substituted for city or state jobs that would have existed anyway. When the program expired in 1982, the GAO found that fewer than half of the workers employed by SEDA were employed 3 months later. About half of the unemployed were back on government assistance, and about a quarter of those who did have jobs were earning less than they did before their SEDA participation. In 1983, Congress tried again with the Job Training Partnership Act, JTPA, which rejected the public jobs model in favor of private sector placements for trainees. Under the JTPA, states received federal grants to fund partnerships with local businesses for training opportunities, subsidized jobs, and work experience. But with earlier problems of oversight still unresolved, this effort became yet another boondoggle for state and local governments, as well as for companies. In a 1990 screed from the Cato Institute, journalist James Bovard excoriated the program for wasting money on frivolous contracts, providing contractors with a license to steal. JTPA has spent taxpayers' money to set up a circus museum, teach cab drivers to smile, and enable a small-town mayor to fly to Japan, he wrote. Numerous audits by GAO and the Department of Labor's Inspector General faulted the program's contracting practices, wrote Bovard. And then there was the occasional graft. A 1988 investigation by the Plain Dealer, for instance, accused then Ohio Governor Richard Celeste for funneling $1.4 million in JTPA contracts to campaign contributors, including $100,000 for an effort to train 32 unemployed coal miners to become engineering aides. Only 2 of the trainees got jobs, which is not surprising because there was no demand for engineering aides in the area of Ohio where the training occurred, wrote Bovard. In 1998, Congress replaced the JTPA with the Workforce Investment Act, WIA, now the Workforce Innovation and Opportunity Act, WIOA, which created the American Job Centers and Training Provider Lists that are the current playground of the training industry and providers like International College. The deserving poor work. Despite all of these decades of failure, Congress can't help but continue to throw money at training programs, and, by extension, the training industry, thanks to a long-standing bipartisan consensus, buttressed by public opinion, that puts work at the center of anti-poverty policy. Willingness to work has long defined who, among the poor, Americans believe is worthy of help, as earlier chapters have alluded to. Throughout the nation's past, Americans have held the work ethic sacred, and they have defined the undeserving poor by its absence. Michael B. Katz writes in The Undeserving Poor. In 19th century America, paupers who didn't work were undeserving of public sympathy, let alone public aid. Poverty was judged a moral condition, not an economic one, the consequence of willful error, of shameful indolence, of vicious habits, in the words of a 19th century minister quoted by Katz. Especially in America, where opportunity awaited anyone with energy and talent, poverty signaled personal failure, Katz writes. In the 1980s and 1990s, conservatives resurrected these biases to weaponize work in their attacks on welfare. Their efforts to stigmatize and racialize welfare helped sour public opinion on Johnson's Great Society and create the political momentum that made the 1996 welfare reform inevitable. By the mid-1990s, many Americans shared the widespread belief that most welfare recipients would rather sit home and collect benefits than work hard to support themselves, as political scientist Martin Gilens concluded in Why Americans Hate Welfare. Among the loudest proponents of work requirements in welfare reform was New York University professor Lawrence Mead, who declared non-working poverty a political disaster that suggests the bankruptcy of the entire progressive tradition of our image of self-reliance as central to American politics. Breaking the politics of dependency, as Mead called it, required ending permissive social policies that he claimed coddled the non-working poor and engendered public resentment. What disturbs most people is the passivity of today's entrenched poor, their curious reluctance to help themselves in many ways. To average Americans, competence connotes not just working, but a more general quality of motivation or initiative about life. They fail to see in today's poor that desire to improve oneself and one's family that has marked American society. Only when poor adults show a clearer commitment to getting ahead will other Americans be able to identify with them and feel more generous toward them. Most Americans will accept poverty as an economic condition and will do something to help, but they will not accept defeatism. The poor, if they are to be deserving, cannot simply give up. They must try, and working or attempting to work is the great badge of that effort. But liberal and democratic policymakers have also reinforced the idea that recipients of government benefits should work. In the depths of the Great Depression, when unemployment peaked at close to 25%, President Franklin Delano Roosevelt was reluctant to maintain the federal government's public relief efforts, which he believed to be corrosive to the national character. The federal government must and shall acquit this business of relief, FDR told Congress in his 1935 State of the Union address. Continued dependence upon relief induces a spiritual disintegration fundamentally destructive to the national fiber. To dole our relief in this way is to administer a narcotic, a subtle destroyer of the human spirit. It is inimical to the dictates of a sound policy. It is in violation of the traditions of America. Work must be found for able-bodied but destitute workers. Roosevelt went on to create the Works Progress Administration in 1935, later renamed the Work Projects Administration, or WPA, in 1939, which would ultimately employ more than 8.5 million Americans during its existence. It would also inspire CETA. Even President Lyndon B. Johnson's War on Poverty was predicated on encouraging work and improving low-income Americans' employability. Like FDR, Johnson generally eschewed the idea of public relief. On the morning of his State of the Union address in 1964, the day he declared war on poverty, Johnson told his advisers that what we're trying to do, instead of people getting something for nothing, we're going to try to fit them where they can take care of themselves. That's our program. We don't want them to get something for nothing. We want to get them where they can carry their own weight. During his speech, Johnson emphasized his principal strategy, to equip poor Americans with the capacity for self-help through training and education. Our chief weapons will be better schools and better health, and better homes and better training, and better job opportunities to help more Americans, especially young Americans, escape from the squalor and misery and unemployment rolls where other citizens help to carry them, said Johnson. In its 1964 report, Johnson's Council of Economic Advisers proposed the maintenance of high employment as its main tactic for poverty reduction, including by accelerating economic growth, rehabilitating urban and rural communities, improving labor markets, expanding educational opportunities, and enlarging job opportunities for youth. Among the administration's signature initiatives was the establishment of Job Corps, a residential training program for young adults modeled after FDR's Civilian Conservation Corps. More on this later. And the preschool program Head Start. Rewarding work was also the rationale behind Democrat Russell Long's championship of the work bonus that later became the EITC and President Bill Clinton's pledge to make work pay in his embrace of welfare reform. On the other hand, the focus on work has helped justify significant investments in social services that Americans perhaps otherwise wouldn't support. Public opinion polls find nearly universal approval for providing welfare recipients with job training, education, and child care. The strength of this support enabled Clinton not only to expand the EITC, but also to increase child care funding for low-income workers by $4 billion, and to expand Medicaid coverage to working poor families. Clinton also persuaded Congress to grant $100 million in new transportation funding to improve transit access to jobs, and to create the Welfare to Work tax credit for employers who hired welfare recipients. The insistence on work, however, has also fed the notion that poverty is the consequence of personal choices versus the outcome of structural inequities that limit people's potential, regardless of the decisions they make. The public supports investments in job training, but the outcome of that training is still recipients' responsibility. Sentiments like these have allowed job training providers to avoid accountability for the quality of their services. Quality is immaterial if providers can shift the blame for any failures to trainees and their deficits in personal responsibility. The long-standing, hardwired belief that anyone can pull themselves out of poverty if they try is one reason substandard job training programs have managed to justify their existence and to collect federal funding from programs like WIOA and mechanisms like the ETPL. Woe is WIOA. When Congress passed WIOA in 2014, hopes were high, as was rhetoric. We've created a workforce system that's more nimble and adaptable, better aligned with what businesses need, and more accountable, said Senator Patty Murray, Democrat of Washington, one of the bill's bipartisan co-authors, on the eve of the legislation's passage. As enacted, WIOA called for a coordinated and comprehensive workforce development system that could deliver the skilled workers employers want, provide workers with pathways to well-paid careers, and bolster state and local officials' plans for economic development and growth. WIOA's network of American Job Centers, or AJCs, would serve as portals for workers seeking help with resume writing, job search, training, or other services, and act as brokers for local companies on the hunt for skilled hires. WIOA is designed to help job seekers succeed in the labor market and to match employers with the skilled workers they need to compete in the global economy, says the Department of Labor. In some instances, federally funded job centers do live up to this vision. NovaWorks in Sunnyvale, California, offers up to 3 workshops a day for job seekers, hosts a robust online job board with listings from employer partners, and keeps painstaking track of its clients' progress. We track every person who gets training subsidies and every program they're in, and we watch their success or failure and their wage or placement, says Chris Stadelman, who was NovaWorks' executive director for nearly 13 years. But more typical is the Arlington Employment Center, the designated WIOA job center for Arlington, Virginia. In the spring of 2023, the online job board on its bare-bones site included a lone featured employer, New Hope Health, along with the disclaimer that this employer does not currently have any posted jobs. According to the center's annual performance report, its 13 full-time staffers assisted just 586 customers in 2021. It hosted 56 core workshops over the year, which netted 263 attendees. The center also placed only 85 of its clients in jobs for a placement rate of 15%, against a goal of 70%, and more than half of those who found work, 54%, were earning less than the Commonwealth's living wage of $15.63. Virginia's overall WIOA numbers aren't much more impressive. Between April 2020 and March 2021, just 3,121 people enrolled in WIOA-funded training programs for adult and dislocated workers, according to information supplied by Commonwealth officials in the spring of 2022. Of those who exited their programs, median quarterly earnings were $6,156 6 months later, or $24,624 on an annualized basis. Nor is the situation much better nationally. With roughly $3.2 billion in funding, WIOA reached about 2.8 million participants, a term the government defines loosely, from July 2020 to June 2021, of about 240,000 of whom received WIOA-funded training. Though 2/3 of WIOA participants were reportedly working within 6 months of exiting the system, their median earnings on an annualized basis were $26,408, significantly less than the annualized median earnings of a typical worker without a high school diploma in 2021, $32,552. The number of participants and trainees has moreover been shrinking. From 2016 to 2019, recipients of WIOA-funded training dropped by 77,000, from 330,720 to 253,428, while the number of participants plummeted by 2 million, from 5.6 million to 3.6 million. Where WIOA has succeeded, however, is in creating myriad new and continuing opportunities for the training industry to sell its services to state and local workforce boards. If you notice some striking similarities among the websites for Virginia's Workforce Connection, California's CalJobs, and Florida's EmployFlorida.com, that's because they've all been built by Geographic Solutions, Inc., a Florida-based company whose entire business is developing software for state and local workforce agencies. Building integrated workforce development systems is its tagline. More than 120 job centers in 35 states use the company's flagship project, Virtual One Stop, according to its site. In October 2023, the company hosted a 4-day conference in Monterey, California, that attracted more than 325 attendees, including representatives from more than 190 agencies. The $994 registration fee included pre-conference training on the company's latest software. Other contractors purport to provide help with career exploration and skills assessment. The Arlington Employment Center site, for instance, includes a link to Career Concourse, an assessment tool created by Chamorro Economics and Analytics, a Richmond-based labor market research firm. When I took the assessment to find careers that fit your interest in December 2022, the 31-question form asked if I like, dislike, or am neutral about activities for which I had no qualifications whatsoever, such as build kitchen cabinets, develop a new medicine, write books or plays, install software across computers on a large network, test the quality of parts before shipment, or develop a way to better predict the weather. The potential careers recommended to me varied from dancer and choreographer to industrial production manager to nuclear technician. Another tool by the same company, which promised to help explore careers consistent with your values, asked if it was very important, somewhat important, or of little to no importance that I make use of my abilities, or that I would never be pressured to do things that go against my sense of right and wrong. This tool recommended I consider becoming an optometrist, along with a host of other unrelated professions for which I also lacked the requisite skills. Also on Arlington's site is a link to Skill Up, a virtual portal to 5,500-plus career readiness trainings, occupational skills trainings, career pathways trainings, and more, offered through a company called Metrics Learning. A click on the course catalog reveals an alphabetic listing of titles ranging from anger management essentials to thinking like a CFO. Detailed course descriptions are not available, nor is there information about the credentials someone would earn if they completed, for instance, the personal development curriculum, or how that would lead to employment. It's all static content with no curation and no guidance, says NovaWorks' former executive director, Chris Stadelman, who said her agency briefly experimented with Metrics Learning. It's real content, but it's not in a format that's digestible by anyone but the most introverted, self-motivated linear thinkers. In fact, she said, of the handful of her clients who tried out Metrics, no one finished a training. Nevertheless, WIOA job centers in at least 10 states in the Virgin Islands are customers of Metrics Learning, according to Learning Solutions magazine. A 2020 request for proposal, or RFP, posted on the Texas government contracts portal, TXShare, indicates that the company charges $25,000 for 500 licenses to the platform, while the package with 1,000 licenses costs $40,000. The company also charges between $170 and $900 for certificates issued when or if a trainee completes a course. The company, moreover, offers access to its proprietary skill and technical assessment tool for $1,000 per location. The Arlington Employment Center's annual report does not indicate how many, if any, clients use the Metrics Learning platform or completed any trainings. The mediocrity of these products is symptomatic of a system overrun by providers bent on capturing federal dollars, coupled with wholesale disregard for the accountability WIOA was supposed to bring. In what's now a familiar refrain, workers aren't getting the services they need, while private interests prosper. Nowhere is this more evident than on states' eligible training provider lists, or ETPLs. Ironically, the concept of eligible training providers was originally intended to give participants more control over their training. Under the Job Training Partnership Act, WIOA's predecessor, participants didn't pick their training, but were assigned to programs chosen and contracted out by local workforce development agencies. One reason that program was ripe for abuse. This approach led to the overconsumption of training, as one analysis put it, and many people ended up in trainings they didn't want or where opportunities weren't available, except for the training providers. WIOA's philosophy, on the other hand, is to be customer-focused. Individual training accounts provide workers with funding to pursue the training of their choice, while the ETPL is meant to ensure equality. Or at least that was the intent. What this structure has spawned instead is a training market dominated by mediocre providers scouting for easy WIOA dollars, while workers hoping to find quality programs must sort through mountains of chaff. The odds are high of choosing a program that is expensive, irrelevant, and of dubious quality. For one thing, anyone can apply to become an eligible training provider, and most states, in fact, actively solicit applications. In Maryland, for instance, qualifying programs must lead to an industry-recognized certificate or certification, or simply to measurable skill gains toward a credential. Qualifying providers can be an institution of higher education that holds a certificate of approval from the Maryland Higher Education Commission, MHEC, or simply a community-based organization. Although in the latter case, the organization would also need to obtain a not regulated status letter from the MHEC. The result is a preponderance of for-profits and fly-by-night operators hoping to goose their revenues with WIOA money. In California and Virginia, for example, the number of for-profit providers on the state's approved provider lists equals or exceeds the number of public institutions, such as community colleges. Many for-profit providers exploit their ETPL status as a badge of quality, however ersatz in their marketing. The online trading provider MedCerts, which offers IT and healthcare certifications, boasts on its homepage that it has approved ETPL status in 30-plus states. Other providers dangle WIOA money as a tactic for recruiting students. Arian Consulting and Staffing, a formerly approved Maryland provider that offered entry-level pharmaceutical manufacturing training, promised, if you are unemployed and receiving government benefits, you may be qualified for complimentary training and placement program. Arian's website was riddled with typos and included no information on tuition costs. As of November 2023, the organization's website had disappeared. The for-profit Medical Learning Center writes on its payment options page that it is an approved Northern Virginia workforce investment, or NVWIB trainer provider for Virginia residents. Funding is provided for nurse aid that covers the total cost. The predominance of for-profits lures students toward pricier options than necessary. Trainees pay out of pocket for costs above the training dollars provided in their individual training accounts. A student interested in becoming an administrative assistant, for example, could enroll in a 229-hour program at the Fairfax Public Schools Adult and Community Education for $2,616. Or they could spend $6,846 for a certificate in clerical studies from the Virginia Highlands Community College. They could also opt for the for-profit Joshua Career Institute, which offers a 600-hour certificate program for $8,000. Virginia's ETPL describes all three offerings as administrative assistant trainings approved by the state. The often random assortment of providers on state ETPLs also means that programs may or may not align with the skills and credentials a local economy needs. Just because a training is offered doesn't mean jobs are available. In West Virginia, for example, many approved providers are online and based out of state, so they likely lack a connection with local employers. A scan through the state's ETPL includes providers based in Kentucky, Ohio, Pennsylvania, Maryland, Michigan, and Virginia. Among the more than 1,500 approved programs in Virginia, trainees can pursue credentials in everything, from an associate's degree in diesel technology to certification as a wind turbine technician, an EMT, or a truck driver. They can also seek training as a bail bondsman, an ethical hacker, or a massage therapist, and get certificates in such specialties as permanent cosmetic tattooing, meat cutting, or the appropriate use of pepper spray for aspiring security guards. These might be excellent programs, but there's also no information about the availability of area jobs for students interested in these fields. That is, whether there's a local shortage of butchers or cosmetic tattoo artists. Compounding these problems is that WIOA participants can't tell which programs work and which don't. Training providers aren't handing over outcomes data, a challenge that dates to the 1998 Workforce Investment Act. In a 2003 audit, the Department of Labor's Office of the Inspector General found that many ETPL providers considered reporting requirements to be burdensome, especially if they didn't have many WIOA-funded students. Some programs also worried that disclosing personal information about students, such as social security numbers and wage data, would violate students' privacy rights and subject them to liability, although regulations have since resolved those concerns. In a November 2020 report, the research organization Mathematica found that in many states, local officials still said training providers could not or would not provide the required performance data. This report covered a pre-pandemic timeframe from 2016 to 2019. No doubt the pandemic made these reporting problems even worse. One likely reason for this lack of information is that the data aren't worth bragging about. Over the summer of 2022, I emailed 10 for-profit providers on the Virginia and Maryland ETPLs, asking about the number of WIOA-funded participants they'd served in the past year and their outcomes. 8 out of 10 did not respond, and 2 failed to follow up after an initial response. One of these 10 was Arian Consulting, noted earlier. States don't have much interest in digging too deep, as John Palish, who was formerly executive director of Kentucky's Workforce Development Agency and now the CEO of One Workforce Solutions, a consulting firm. No news is good news if the alternative is failing federally mandated performance targets. I know firsthand that in Kentucky, we cleaned the data well enough to get the performance measures, and then we moved on, he says. We didn't clean it pristinely, and there's not a state out there that does, because there's no incentive to do that. Technically, these failures to report data violate federal law. Department of Labor regulations require states to collect information from approved providers, including the number of WIOA participants enrolled in a particular course, the cost of the course, and outcomes, such as the percentage of enrollees who receive a credential and whether they're working. This data is supposed to be available on a state's ETPL and on trainingproviderresults.gov, a project initiated by the Labor Department in 2019 that was meant to be for training programs what the college scorecard is for colleges. But click on provider listings on a state's ETPL or the website, and lots of information is missing. Clicking on the Course Performance tab for half a dozen approved courses on West Virginia's ETPL yielded straight zeros for such measures as wages at placement, number employed after 6 months, and number receiving degree or certificate. For the 3 administrative assistant programs from Virginia's ETPL cited earlier, 2 listed no outcomes data as of November 2023. All values for completion rates and earnings were listed as zeros. One program, offered by the Fairfax Adult Education Program, reported just 7 students in 2021, with median earnings of $7,656.39 6 months after graduation. Trainingproviderresults.gov frequently shows only asterisks for employment rate, completion rate, and earnings with the note data suppressed. As of the fall of 2023, the site was still relatively new, and states had not finished submitting their data. But the problems are still profound, says Palish, who also served as Assistant Secretary for Employment and Training at the Department of Labor under President Donald Trump, and under whose watch the site was launched. The data in there is junk, because that's the data that the states are giving us, he says. But, in a final ironic twist, these reporting requirements, toothless as they seem to be, are still just burdensome enough to discourage some of the nation's best training providers from joining state ETPLs. Many small organizations that run good programs opt out because it's too bureaucratic. The former director of a nationally recognized training program based in Maryland says, they decline to use their name or the name of their institution to preserve relationships with state officials. We started to pursue an ETPL application, but stopped because the process was lengthy and it was clear they were going to mess with a program we felt good about. We didn't want to change it for dribs and drabs of money. Approved providers must, for instance, report performance on all students, not just those funded by the WIOA, though this requirement was frequently waived during the pandemic. Many community colleges opt out of applying for a state's ETPL because they don't have the capacity or desire to track all of their students for this purpose. National providers, such as LinkedIn Learning or Cisco, must also apply for each state's ETPL separately, another disincentive. These requirements are one reason you won't find Google, Coursera, or other high-profile organizations that offer online courses nationwide to adult learners. Also absent from state-approved provider lists are well-regarded cutting-edge institutions like Western Governors University, an online institution that offers skills-based credentials, and Southern New Hampshire University, the nation's largest nonprofit online college. SNHU is not even on New Hampshire's ETPL. At the end of the day, WIOA participants don't get the information they need. Poor-performing programs slide under the radar, and federal training dollars end up in the pockets of training providers, while trainees waste their time in programs that might not help them find jobs. Only about 1 in 3 people who enroll in WIOA training ends up in a job related to that training, according to the Labor Department data. But the slow-rolling disappointment of WIOA is not the most egregious failure in federal job training. That honor is reserved for Job Corps, a War on Poverty-era program that federal audits have faulted since its inception, but has still managed to survive as the government's largest training program for disadvantaged young adults. One secret to its staying power has been the small group of contractors that has managed the program through successive presidential administrations, defeating efforts at reform but at the expense of young people who might have benefited from more effective programs. The tragedy of Job Corps. The coronavirus pandemic that began the spring of 2020 has exacted an incalculable and ongoing social, economic, and human toll. But among the groups hit hardest were young adults caught in the transition to independence when the world shut down. Young adults on the front lines of the economy in sectors like retail, hospitality, and food service lost jobs in cataclysmic numbers. Unemployment among 18 to 24-year-olds soared from 10% in March 2020 to 28% by July, according to the Urban Alliance, with Black and Latinx youth suffering the highest rates of joblessness. College attendance also plummeted, with enrollment down by 1.4 million students from the spring of 2020 through the spring of 2022. From 2019 to 2021, the number of young adults ages 18 to 24, neither working nor in school, surged by more than 1 million, according to the labor market research firm Lightcast. All told, an estimated 4.7 million young adults, or 1 in 6, were disconnected from the mainstream economy, and the damage could linger for decades. You will see a lifetime impact on this generation, as Michael Hicks, director of the Center for Business and Economic Research at Ball State University in Muncie, Indiana, told Newsweek. In theory, the federal government's Job Corps program is ideally suited for tackling this crisis. Launched during the War on Poverty, its explicit aim is to connect out-of-school, out-of-work young people with education and employment through a network of more than 100 campus-based centers throughout the country. With an annual budget of $1.7 billion, Job Corps is still the government's largest education and training program for low-income youth. But Job Corps' pandemic performance was a miserable failure, even by the standards of the generally disastrous national experiment in remote learning from 2020 to 2021. Job Corps' residential model proved too rigid for the exigencies of the pandemic. Instead of redoubling its efforts to keep young people engaged, it shut down completely. In March 2020, it sent home the 30,000 students then enrolled in its centers and then struggled for months to move instruction online. Enrollment plunged by 56% over the following year, and the number of trades training completions dropped to 0 between April 2020 and April 2021, according to a November 2021 audit by the Department of Labor's Inspector General, or IG. The program struggled to get laptops and other equipment to students, partly because it took almost half a year to establish its student loaner device policies, the IG's office found, and some students were still without equipment months after centers ceased in-person instruction. Among the program's self-inflicted hurdles was a mandatory usage agreement that held families liable for a $500 penalty if laptops and hotspots were lost, stolen, or damaged, a burden that many low-income families couldn't or wouldn't take on. Some instructors mailed paper packets of materials that took weeks to arrive. After reopening in 2021, Job Corps centers struggled again, this time with recruitment and enrollment. In July 2022, Job Corps centers reported just 2,197 new arrivals nationwide. For the 9-month period from July 2021 through March 2022, 14 centers reported fewer than 50 total arrivals, and 2 reported none at all. The bigger scandal, though, is that Job Corps has performed poorly for decades. Even before the pandemic, Job Corps was barely serving 50,000 young people a year, and enrollments were declining. Between 2007 and 2018, enrollment slid from 63,448 to 46,969. Evaluations find that while the program helps some young adults, teenagers who make up the bulk of enrollees get no long-term benefits in earnings or employment. Government audits have been harsh, documenting mismanagement, safety problems, and persistent failures to place trainees into meaningful jobs. A scathing 2018 audit by the Department of Labor's Inspector General, or IG, concluded that the program could not demonstrate beneficial job training outcomes. Another report from the Government Accountability Office, GAO, noted more than 13,500 safety incidents from 2016 to 2017 at Job Corps centers, nearly half of them drug-related incidents or assaults. In 2015, 2 students were murdered in separate campus-related crimes. Even successful graduates call the program a last resort. If you're really desperate and ain't got anywhere else to go, then I would do Job Corps, says Irvin Rogers, who enrolled at a New Jersey Job Corps center in 2017 after dropping out of community college. Rogers landed a hotel maintenance job before the pandemic, but was unemployed when we spoke in 2021. Rather than the young people it purports to serve, the program's biggest beneficiaries may be the tight-knit coterie of for-profit government contractors who administer the program, some of whom have held on to multi-million-dollar contracts for decades. But in a testament to congressional inertia, the program lingers on, surviving threatened closures, resisting overhauls, and garnering enough political support to maintain its funding. Worst of all, vulnerable young adults are paying the price of subsidizing the Job Corps industry. While Job Corps siphons away much-needed dollars that could support better programs, young adults aren't getting the help they need to put their education and careers on track. Grand vision, modest results. Launched during President Lyndon B. Johnson's War on Poverty, Job Corps now consists of 123 centers across the country, many of them in former military facilities and often in rural areas. A typical campus is the Woodstock Job Corps Center, which sits on 64 acres of tranquil woodland in rural Maryland, about an hour from Washington, D.C. A stately H-shaped stone building that was once the oldest Jesuit seminary in America now houses the center, which can host up to 400 students. The purpose of this residential setting, as program founder Sergeant Shriver testified to Congress in 1964, was to take young men from crippling environments and put them in centers where they will receive a blend of useful work, job training, and basic education. Young people would get a chance to escape from the cycle of poverty and to break out of the ruthless pattern of poor housing, poor homes, and poor education, he argued. Today, Job Corps offers training and certification in more than 80 fields, including IT, construction, manufacturing, healthcare, and hospitality. The program's website features smiling, clean-cut young people driving forklifts, cooking in chefs' whites, and fixing cars. Job Corps is not just a career training program. You'll also receive everyday staples and a supportive community. All of this for free, the site promises. To be eligible for the program, students must not only qualify as low income, but also have at least one barrier to education and employment, such as low literacy or homelessness. Job Corps centers provide housing and meals, along with a small allowance, a uniform, books, supplies, and dental and medical care. Facilities also offer gyms and weight rooms, as well as after-hours activities. A recruitment presentation for the Treasure Island Job Corps Center in San Francisco boasts that it has one of the best recreation programs in the nation, with trips to bowling alleys and local beaches and special events like talent shows and picnics. The San Jose Center touts an Olympic-sized swimming pool and a dance floor. Tuition is free. Over the years, Job Corps has unquestionably had its share of successes. The professional boxer George Foreman, who attended the program in the 1960s, was reportedly so grateful that he repaid the federal government the cost of his enrollment. Today, success stories include alumni like Shamira Mills, who was 28 years old when we spoke in 2021. Mills said she enrolled in the Pittsburgh Job Corps Center in 2017 on a cousin's advice, after a brief stint in culinary school did not launch her dream career of being a chef. She spent 7 months living at the Pittsburgh campus, learning to be an HVAC technician. She found a job almost immediately at a small local business, but had just been hired at a large residential heating and air conditioning company in Philadelphia with better pay and room for promotion. Within the last 2 years, I have acquired 2 cars and an apartment where I'm living by myself, Mills told me. The program, she said, gave her a second chance when she needed one. Without Job Corps, Mills continued, if I'm going to be 100% honest, I would probably still be working dead-end jobs. Job Corps was also a lifeline for Ricky Gass. Now in his mid-20s, Gass was 18 when he fell into drugs. I paid the price because I was with the wrong people, he said. One day, he woke up in the back of a police car. I was smoking some bad stuff one time. I don't even remember what happened, he told me. They said I was trying to fight cops and all this crazy stuff was going on. I could have been shot and killed. I got lucky I was sent to lockup and not a graveyard. Gass resolved to turn his life around, especially when he learned he had a daughter on the way. But with only a high school diploma, the best job he could get was at the local Family Dollar. My check was $200 every 2 weeks, he said. It was horrible. In 2019, Gass enrolled at New Jersey's Edison Job Corps Center and threw himself into his classes, learning everything from putting in electrical wiring to hanging drywall. When one of his advisors offered him a training opportunity at a solar power company, Gass jumped at the chance and was hired soon thereafter. When we spoke in 2021, he was installing panels for Solar Landscape, a company that specializes in building large-scale solar projects in New Jersey. He was being paid the industry's prevailing wage, then about $62 an hour, according to Solar Landscape's Director of Community Engagement, Caitlin Gold. In November 2021, he starred in a CNBC feature headlined, "This 25-year-old makes $100,000 a year as a solar roof installer in Linden, New Jersey." But while Job Corps defenders point to students like Mills and Gass as proof of the program's value, there are also students like Julie Shannon, who spent 7 months at the Joliet Job Center in Illinois and earned certificates in Microsoft Word and other office software. While she told me she enjoyed the experience of living on campus, you get to see how it is to live without your parents. It teaches you to be a mature adult, she said over chat on LinkedIn. The program didn't help her land a job. She ultimately went back to community college and earned an associate's degree in criminal justice in 2019. As of December 2022, her LinkedIn profile listed her as a student at Kankakee Community College in Joliet. Formal evaluations of the program are similarly mixed. Evidence shows that for older students like Mills and Gass, Job Corps can be modestly beneficial. In a rigorous series of evaluations published in 2018, the research organization Mathematica found that students between the ages of 20 and 24 at the time of enrollment were 4.2 percentage points more likely to be employed 20 years later than a comparable group that did not attend. They were also 1.4 percentage points more likely to be filing taxes and 3.6 percentage points less likely to be on disability. For these students, the net benefit of Job Corps to society was about $30,000 over the course of a participant's lifetime, in inflation-adjusted dollars, considering the taxes they paid on earnings, as well as savings from reductions in crime and dependency on public benefits. But Mathematica's study told a different story about the teenagers who enroll in Job Corps, and who account for most attendees. It found no long-term gains in earnings or employment for students who started the program when they were ages 16 to 19. Overall, the study concluded, Job Corps was not cost-effective, with the net cost of Job Corps running about $17,800 per participant, again, in inflation-adjusted dollars. Even taking into account the benefits from older students' success, the government was losing money. In fairness, the mission of Job Corps is a difficult one to make good on. Job Corps is taking on a group of young adults who are tough to reach successfully. Of the nearly 50,000 young people enrolled in Job Corps in 2018, 60% did not have a high school diploma or GED when they entered the program, 20% were receiving public assistance, and 5% were homeless, runaways, or in foster care. About 80% of Job Corps students were teens and younger adults, ages 16 to 20. The labor market is not very hospitable to young people without high levels of post-secondary skills, says Dan Bloom, Senior Vice President at MDRC, a nonpartisan policy research organization focused on social and education issues. Put together with problems in the public schools, a harsh criminal justice system, and a bunch of other contextual factors, it's very difficult to change those trajectories. Job Corps graduate Malcolm Little, who served as student body president at the Woodstock Job Corps Center in Maryland in 2016, said many of his classmates were victims of crime or had witnessed violence. I met girls who were pimped out, put on drugs, folks trying to kill them, he told me. There were other people, both male and female, who were sex trafficked and ex-drug dealers, who were trying to get themselves together. Little said one young man he met in the program didn't go home to Atlanta for Christmas break because he feared for his life. He told me the neighborhood he lived in was so bad that if he disappeared for 3 weeks and came back, people would assume he had been detained by the feds and snitched to get out, and that would have put a target on his back, Little said. The prevalence of this kind of trauma means that Job Corps must serve as far more than a training program to its students if they are to succeed. They need mental health. They need physical health. They need medications, says Tony Stainings, who is now the director of the Potomac Job Corps Center in Washington, D.C., but was a consultant to the program when we spoke. There's a whole element to the delivery of service that the average person looking from the outside doesn't understand. The expectations placed on the Job Corps program might be unattainable. No career and education program can, on its own, salvage the fortunes of young people whose lives have been shaped by deep-rooted systemic poverty. A young person's disconnection from the economic mainstream is the result of subpar schools, a dearth of jobs, and often neighborhoods beset by violence. On the other hand, Job Corps has managed to sustain itself essentially unchanged for more than half a century. Its residential model, while its significant feature, is also the element that makes the program resistant to reform, not least because of the contractors who have a vested interest in maintaining the status quo. The Job Corps cartel. The proponents of Job Corps' residential model argue that living on campus can provide students with a clean break from negative influences in their lives. The folks who come to Job Corps need to be there in order to succeed, says Grace Kilbane, who served 2 separate stints as the National Director of Job Corps, most recently under President Barack Obama. She's also the board member of the National Job Corps Association, NJCA, the trade association for Job Corps contractors. I met students who were homeless or had aged out of foster care and had nowhere to go, Kilbane told me. That need has not gone away. If anything, it's gotten greater. Yet the residential model is a major driver of the program's expense, as well as its persistent problems with safety and security. Centers do what they can to create a positive culture, says Jeffrey Turgeon, who worked for nearly 5 years at a Job Corps center in Massachusetts and is now the executive director of the MassHire Central Region Workforce Board. But anytime you've got a bunch of young people, especially young people who are at risk and haven't been successful in the past, they're going to come with whatever baggage or drama they bring with them. Shamira Mills, the Job Corps graduate who is now an HVAC technician, said discipline was a big part of life on campus, which she described as having a boot camp type of vibe. We got graded on a day-to-day basis on how our rooms were and chores that we had to complete every morning and every evening, she said. If you've ever been to boot camp, they had the same system. Or jail, whichever one. Unlike a college campus, days were strictly regimented. Students woke up at 6 a.m. Breakfast was at 7. Classes began at 8. Many of her classmates did not make it through the program, Mills said. Her roommate was expelled after getting into a fight with another student. Other students were kicked out after failing drug tests, which are part of Job Corps' zero-tolerance policy toward alcohol and drugs. Of the 45,173 separations, graduations, or other departures from Job Corps in 2018, 65% of students left for jobs or the military, and around 7% went on to further education, implying that the remaining 28% either left without completing the program or graduated without a meaningful placement. Both Mills and Little said their rooms were searched from time to time. Every once in a while, I'd come back, and all my stuff from my dresser and my closet would be on the bed, Little said. Former student Ricky Gass, the solar panel installer, was among a minority of students who commuted to his Job Corps center every day. Unlike most centers, which are in rural or out-of-the-way areas, the Edison Job Corps Center he attended in New Jersey was reachable by public transportation, and Gass had childcare obligations for his daughter. Sometimes I felt like I wanted to be on campus, but if I was staying there, I would have possibly gotten into a lot of different situations, like females, the drama. There was a lot of testosterone, he said. Some situations I was shielded from by not being there on campus. Philip Matthew Golden, who taught at the Woodstock Center in Maryland for 4 years, told me he witnessed a significant amount of turnover among the staff who managed the dorms. They handled a lot of volatile situations, he said. They tried really hard and they really cared, but it was hard to keep people there. On occasion, that volatility has spilled over into violence. In August 2015, 4 students at the Homestead Job Corps Center near Miami were arrested and charged with hacking to death a 17-year-old fellow student with a machete and then setting his body on fire. Earlier that year, a 20-year-old student at the St. Louis Job Corps Center was arrested for allegedly shooting and killing another student in the dorms. Between 2007 and 2016, the GAO found, Job Corps centers reported 49,836 safety and security incidents, including 6,541 incidents involving drugs and 9,299 assaults. The need to maintain safety is just one reason why the program's residential model is expensive. There are also more prosaic concerns, such as meals, laundry, water, and electricity bills and building maintenance. Job Corps operates on what is essentially a franchise model, much like McDonald's, where a central office dictates the operation of individual centers in conformity with a single standard. Just like how every McDonald's must make its fries in exactly the same way, Job Corps contractors are obligated to deliver education, training, and residential services that are standardized across the program's 123 centers. Except for roughly 24 centers run by the U.S. Forest Service, private contractors are effectively Job Corps franchisees. Center specifications are spelled out in a more than 1,000-page policy and requirements handbook, which governs every aspect of center operation, including recruitment and screening of prospective students, curriculum, discipline, placement services, and tracking of performance metrics. Contractors must, for instance, have written plans for blood-borne pathogens, respiratory protection, and hearing conservation to protect students' hearing. Meal service is prescribed in exacting detail. Meals shall be planned using a minimum of a 28-day cycle cafeteria menu, the handbook dictates. Students must be offered, for example, 5 choices of fresh or frozen vegetables and/or fruits, and low-fat and/or fat-free milk and dairy alternatives, and water. The intent of this specificity is consistency across centers, although in truth, performance reports issued by the Department of Labor show that centers vary widely in quality. The downside is that few contractors can comply with the complexity and sheer scale of the Job Corps requirements. In practice, 5 private, for-profit contractors operate the majority of centers, says a 2022 Congressional Research Service report. Job Corps' largest contractor is Utah-based For-Profit Management and Training Corporation, or MTC, which operates 22 centers as one of several lines of business. The company also runs 6 immigrant detention centers and 23 correctional facilities in addition to prison medical departments and community release centers, for example, halfway houses. Another major contractor, Equus Workforce Solutions, formerly ResCare Workforce Services, runs WIOA-funded job centers, child care services, and welfare-to-work programs in addition to its work for Job Corps. Other major contractors include Adams & Associates Incorporated, which runs 15 Job Corps centers, with Sidelines running WIOA services at 2 job centers in Maryland and 1 emergency youth shelter in Nevada. New York-based Career Systems Development Corporation, which runs 10 centers, Kentucky-based Education and Training Resources, or ETR, which operates 9 locations, and Mississippi-based MINACT, which runs 7 centers. Job Corps contracts involve big money. MTC, for instance, won 3 multi-year contracts in 2022 to run the Sierra Nevada Job Corps Center in Reno, the Edison Job Corps Center in Edison, New Jersey, where student Ricky Gass attended, and the Hawaii Job Corps Center in Waimanalo, worth a total of about $264 million. Between 2019 and 2021, Career Systems Development won contracts to run the Loring Job Corps Center in Limestone, Maine, $56.3 million, as well as centers in San Jose and San Diego, California, $86.2 million and $99.6 million, respectively. Many of these companies have been reeling in lucrative Job Corps contracts for years, if not decades. MINACT, for example, opened shop in 1978, when its founder successfully competed for the company's first Job Corps Center contract, according to its website. Career Systems Development notes on its site that it was one of Job Corps' original contractors when the program launched in 1964. Reliance on contractors does not, of course, make a program inherently flawed. In fact, the federal government doesn't perform much better than its contractors when it operates Job Corps centers directly. While a few of the centers still run by the Forest Service are among the best performers, others have been among the worst. In 2014, the Labor Department shut down the Treasure Lake Job Corps Center, located within a national wildlife refuge in Oklahoma and run by the Forest Service. The closure came after years of underperformance, in which fewer than half of the enrolled students finished their training, and barely half of graduates found jobs. Yet a significant chunk of Job Corps problems throughout the years have been related to contractor performance, beginning with its launch. When the federal government announced Job Corps as a pillar in its war on poverty, it also promised to ramp up the program on a wartime footing. In its first fiscal year, the government pledged Job Corps would enroll 100,000 trainees, relying on a slate of high-profile contractors to help fulfill this goal. These early contractors would come to include many of the then titans of the U.S. industry, including the Packard Bell Electronics Corps, which won contracts to run centers in West Virginia and New Mexico, the Xerox Corporation, Thiokol Chemical Corporation, later infamous as Morton Thiokol, the manufacturer of the rocket responsible for the Challenger explosion, Radio Corps of America, or RCA, Philco Ford, builder of the NASA Mission Control Center in Houston, defense contractor Litton Industries, Inc., perhaps best remembered as the manufacturer of microwave ovens before it was acquired by Northrop Grumman, and Graflex, Inc., makers of the eponymous Graflex camera and the original parent of Career Systems. But the parade of prominent firms did not prevent what historian Alice O'Connor calls the all-too-familiar consequences of overpromise. By 1965, as she writes in Poverty Knowledge, Job Corps was already reeling from a barrage of highly publicized mishaps and criticisms coming from all quarters. Corpsmen were reportedly disillusioned by the combination of administrative unpreparedness, lack of curricular materials, and unfamiliar surroundings that greeted them at several of the new centers. Media reports of high dropout rates, overpaid staff, and isolated incidents of violence, drinking, or local vandalism involving trainees added scandal to the mix. Media coverage of Job Corps' early years was, in fact, unrelentingly negative and often racialized, with even the New York Times reveling in salacious nuggets about Job Corps' missteps. 18 Michigan youths jailed after battling Job Corps was one headline from 1966, as was Job Corps youth sentenced for possessing marijuana. The same year, the Times reported that a women's Job Corps center in St. Petersburg, Florida, was shuttered due to hostile elements in the community and uncooperative city government. During its 18 months in this city, the center tried vainly to combat gossip that its girls had loose morals, the Times wrote. In 1970, a 17-year-old trainee was stabbed to death at the Clearfield Jobs Corps Center in Utah, then run by Thiokol, in an argument that apparently involved 2 Negro teenagers and a couple of Puerto Rican corpsmen, according to the Times, in the wake of a near riot, in which several hundred Job Corps men armed themselves with clubs and knives. State, county, and local patrolmen stood guard until 123 Puerto Rican youths were moved to a National Guard camp 50 miles south of Clearfield for their protection, the Times reported. Stories like these bear more than a whiff of NIMBYism and bias, which might lead some to argue that perceptions of Job Corps' woes outweigh the reality. Yet both the Department of Labor's Inspector General and the GAO have also consistently faulted both contractors' performance and DOL's oversight, with dozens of audits over the years examining everything from student outcomes to contracting practices, center safety, reports of cheating, and inadequate financial oversight. In every year since 2006, the IG's annual report has identified Job Corps' safety and program effectiveness as among the Department of Labor's top management and performance challenges. A 2011 IG report, for instance, determined that the program may have spent as much as $164.6 million in 2010 on training for students who were not eligible to enroll. Another audit in 2011 found that Job Corps overstated the success of 42% of 17,787 job placements, with those students taking entry-level jobs unrelated to their training. Among the mismatches were culinary students placed as pest control workers, funeral attendants, baggage porters, concierges, tour guides, telemarketers, cashiers, telephone operators, and file clerks. Yet another investigation in 2019 concluded that the program wasn't doing enough to stop cheating in its high school diploma programs. In San Francisco, for example, investigators discovered at least 16 students who received diplomas despite having reading scores below the 6th grade level, which raised concerns about the integrity of the center's online high school program, as the investigation put it. Meanwhile, Tulsa's Job Corps Center reportedly neglected to follow any of its online high school program's rules of academic integrity and allowed students to print exams, search for the answers online, and then immediately take the exams. The IG's 2018 analysis further found that the program couldn't demonstrate that it placed students into meaningful jobs appropriate to their training. Out of the 50 students for whom the IG was able to track down employment histories, more than half were placed in jobs like what they were doing before Job Corps. One student who worked as a retail cashier before Job Corps spent 310 days in bricklaying training, only to return to the exact same store where they had worked previously. Job Corps reported this as a successful graduation and placement. Among 231 students for whom wage records were documented, the median annual income was just $12,105 in 2016, nearly $15,000 less than the median income for all workers without a high school diploma. Among the program's problems, the audit found, was the poor performance of contractors hired to provide transition services to Job Corps graduates needing help finding jobs. Job Corps paid millions of dollars of transition services to contractors, but we found insufficient evidence demonstrating they had provided the services required by their contracts, the report concluded. Auditors have also criticized the Department of Labor's contracting practices, which have perpetuated the current contractor oligopoly. As far back as 1982, GAO complained of non-permissible sole source contracting for Job Corps. Job Corps should stop using prohibited contracting practices and recover improper fee payments, was the subject of one 1982 letter to DOL from GAO. Nor have these issues been resolved in the ensuing decades. In a 2019 report, the GAO found that Job Corps was running 68 of 97 centers in 2016 under bridge contracts, either non-competitive extensions of expired contracts or short-term non-competitive contracts. In 42 of those cases, contracts were awarded to companies that had already lost their Job Corps contracts and were formally protesting the decision. The result was that these companies were able to squeeze hundreds of thousands of contract dollars from the government while their protests were being resolved. DOL has tried to reserve some contracts for small businesses or minority-owned contractors to diversify its contractor base. But these efforts may also be less successful than DOL has hoped. That's because small businesses winning Job Corps contracts often subcontract to bigger players. One example is Alternative Perspectives, Inc., or API, a certified woman-owned small business that won contracts to run the Job Corps Center in New Orleans and the Wind River Center in Riverton, Wyoming. According to a 2020 MTC press release, MTC and Alternate Perspectives entered a partnership to run the Wyoming Center, as well as two others. The release also noted that DOL had designated the Wind River Center as a small business contract with API as the small business lead and MTC as the subcontractor. Similarly, Education and Training Resources, another of the big guns, calls itself a major collaborator and subcontractor for Gadsden Job Corps Center, Gadsden, Alabama, and Treasure Island Job Corps Center, San Francisco, California. According to SAM.gov, the federal government's contracts database, the $31 million lead contract to run Gadsden was last awarded in 2015 to the New Jersey-based Education Management Corporation, a small woman-owned disadvantaged business, certified as both an 8A corporation by the U.S. Small Business Administration and a minority-owned business enterprise or small business enterprise for the state of New Jersey and the city of Philadelphia, according to its website. As of December 2022, the contract for Gadsden was out for a new bid under a set-aside for historically underutilized businesses. Status quo politics. The cabal of contractors running Job Corps has maintained its grip on the program in part through the advantages of incumbency. As experienced operators familiar with the program's complexities, they can easily outbid upstart firms without the same track record, efficiencies of scale, and inside connections. But more important, Job Corps has formidable political support in Congress, which has helped entrench the status quo. To some extent, this support is another collateral result of Job Corps' residential model. Every state has at least one center, and many are an important source of local employment. In rural areas or in a smaller town, Job Corps is a player in town, said one former senior Labor Department official who asked not to be identified to preserve their current relationships with members of Congress. They have jobs, and it's something people are proud of in those communities. Members of Congress are consequently reluctant to challenge the program. For example, this former official told me of one instance where a member refused to entertain the idea of closing a poorly performing center. We said, "Look, we're going to have to close it. It's not good for the students, and I wouldn't send my own kid there." But the congressperson pushed really hard not to close it, the former official said. They really loved having it in their community. In 2019, the Trump administration proposed closing or privatizing the 25 centers run by the U.S. Forest Service, which would have resulted in the layoff of more than 1,100 federal employees in 8 states. The plan quickly ran into bipartisan opposition and was scrapped in a matter of weeks. Also helping to keep Job Corps' perspective and priorities in front of Congress is the NJCA, the Contractors Trade Association mentioned earlier. Launched in 1998 with 38 charter members, NJCA now has more than double that membership, according to its website. Though it doesn't disclose its full membership, NJCA's 2022 board of directors included Brian Fox, president of Education and Training Resources, Susan Larson, president of Adams and Associates, Scott Marquardt, president of MTC, and Ramon Serrato, president of the Serrato Corporation, a service-disabled veteran and Hispanic-owned business, holding contracts to operate 13 centers. Among other activities, the NJCA maintains the Congressional Friends of Job Corps Caucus, whose goals include initiating a productive dialogue about the quality of services Job Corps provides to thousands of at-risk youth each year, and the enhancement of legislative efforts toward protecting and strengthening Job Corps. It boasted 87 members from across the ideological spectrum in the 117th Congress, 2021 to 2023. The NJCA also ran a small political action committee during the 2014 and 2016 election cycles that donated a total of about $60,000 to candidates, mostly to Republicans, according to Open Secrets, and spent $260,000 on lobbying in 2021 and 2022. Its website is full of testimonials and videos of Job Corps success stories. A page on the program's economic impact cites an analysis finding that the average Job Corps center supports 228 local jobs. In truth, these anecdotal successes are enough to make Congress feel good about supporting the program and to overcome whatever misgivings are raised by government auditors. Progressive advocates who know that the Job Corps system is flawed are also loath to criticize it, for fear of handing conservatives an excuse to kill the program and cut funding for an already neglected area of policy. Given that low-income young adults aren't a powerful political constituency, advocates say it's unlikely that money taken from Job Corps would be redirected toward other youth-serving programs. Nevertheless, the money now going toward Job Corps isn't going toward more promising strategies for low-income young adults. Young adults pay the price. The post-pandemic crisis young Americans are facing requires a better solution. The surge in young adult disconnection prompted by the pandemic should be catalyzing substantial new investment in young adults. Sergeant Shriver's vision of a second chance for young people in poverty is more relevant today than it has ever been. But young Americans deserve more and better than Job Corps. More money, for instance, could be going to expand apprenticeships, which are effective and relatively inexpensive. There aren't a lot of substitutes for getting young people to work in real employment situations with real supervisors, real mentors, and a real occupational goal, says Robert Lerman, an economist at the Urban Institute. A well-structured apprenticeship, Lerman says, could cost the federal government as little as $5,000 per participant, given that employers pick up much of the tab. More funding could also go to programs like Year Up, which trains students for careers in IT, sales, software development, and more, and places them in paid internships with mentoring and other support. Since its founding in 2000, the organization has enrolled more than 29,000 students and reports an average starting salary of $42,000 for its graduates. Also promising is the National Guard Youth Challenge Program, a boot camp-style residential program that has achieved relatively strong results among 16 to 18-year-olds, the group that Job Corps has failed to benefit. Evaluations find that graduates earned, on average, 20% more than non-attendees and were 86% more likely to go on to college. Of course, none of these programs is a panacea. In the post-pandemic economy, it's unclear how many employers will be able to afford to hire apprentices. Apprenticeships also tend to be selective programs that favor job-ready applicants, as is also the case with Year Up. Only 28 states offer the National Guard Challenge program, and its military focus isn't for everyone. But so long as Job Corps and its contractors monopolize the resources available, low-income young adults won't get the help they need and risk falling further behind. 4. Everybody profits. When I was an analyst at the Progressive Policy Institute in Washington, D.C., a company called Cool Smiles reached out, asking if I wanted to learn more about its efforts to provide dental care to low-income children. Cool Smiles was a nationwide chain of dentistry practices whose patients were primarily children on Medicaid, the federal government's health insurance program for low-income Americans. They suggested a tour of one of their offices and a chance to speak with their dentists. These kinds of offers are common in D.C., where companies often deploy public relations teams to engage in outreach to think tanks and nonprofits influential in public policy. I ended up visiting what was then the Cool Smiles office in Winchester, Virginia, about 80 miles west of Washington, in a strip mall next to a Cici's Pizza. The waiting room was large and bright, saturated in primary colors, with an indoor playground at one end. The treatment area in back was likewise spacious, equipment gleaming. But unlike many dentists' offices, which might have a chair or two, each tucked into its own cubby, half a dozen kid-sized dentist chairs in the center of the room sat arrayed like spokes in a wheel. I visited before the office opened for the day, but I could imagine what it looked like when the chairs were full, kids' heads just a foot or two apart. Medicaid dentistry, it turns out, is volume business. At the time of my visit, Cool Smiles ran practices in 17 states and employed as many as 500 dentists. The company had long been the nation's largest provider of dental services to Medicaid patients, serving at least 2 million children a year nationwide. It was also accused by the Department of Justice, or DOJ, of performing thousands of unnecessary procedures on its pediatric patients. Not long after my tour of the Winchester office, the Cool Smiles chain and its parent company, Benevis, agreed to pay $23.9 million to settle Medicaid fraud claims brought by federal prosecutors. According to whistleblowers across the country, the chain paid substantial bonuses to dentists who met production goals that rewarded expensive, unneeded, and often painful treatments, including root canals and steel crowns for children who still had baby teeth. In other instances, prosecutors said, the company billed state Medicaid programs for work that was never done. The company ignored complaints from their own dentists regarding overutilization, instead disciplining them if they were unproductive, according to the DOJ. Sometimes the patients were mere toddlers. In 2019, an Arizona family sued Cool Smiles after a clinic installed crowns in their 2-year-old son, who died 4 days after the procedure. The company has since changed the name of its clinics, operating variously as Pine Dentistry, Pippin Dental, Cortland Dental, Jubilee Dental, and Pinova Dental, among other names. The Winchester Cool Smiles is now Pine Dentistry and Braces, though the office still claims to be an official partner of Benevis and Cool Smiles on its site. Parent company Benevis, known as a dental management organization, was running 120-plus supported practices in 14 states as of November 2023, including the Pine Dentistry in District Heights, Maryland, mentioned in the introduction. It claimed more than 1.2 million patient visits a year. There's no dispute that Medicaid and its companion program Medicare are among the greatest triumphs of U.S. social policy. Medicare and Medicaid are the nation's largest health insurance providers and among the largest in the world. In 2021, the programs insured 135 million low-income, elderly, or disabled Americans, or about 40% of the U.S. population. Medicaid pays for nearly half of all births, as well as most of the long-term care services provided to seniors and Americans with disabilities. Roughly 12.2 million elderly and disabled Americans are covered by both programs, so-called dual eligibles. The share of seniors uninsured in 2021 was a scant 1.2%, thanks to Medicare, while just 5% of children were uninsured, thanks to Medicaid. The Medicaid expansion included in the Affordable Care Act of 2010, or Obamacare, saved an estimated 19,200 lives from 2014 to 2017, according to one landmark study, and reduced annual mortality rates for older adults by as much as 64%. The immensity of the programs also means oceans of spending, and with it, vast potential for both profit and profiteering. In 2021, the states and the federal government spent a total of $728 billion on Medicaid, while the federal government spent $689 billion on Medicare. Together, the two programs accounted for more than 27% of all federal spending in fiscal 2021. As in other contexts discussed throughout this book, the behavior of companies like Cool Smiles has sabotaged the efficacy of these programs. In 2021 alone, the Department of Justice reported recovering more than $5 billion in fraud claims involving federal health care programs, including Medicare and Medicaid, likely just a fraction of the money wasted on unscrupulous providers. But far more troubling is the impact of healthcare profiteering on the health of the nation's most vulnerable individuals, whose interests are eclipsed by the revenues to be had. Even the most cursory analysis of the challenges facing the U.S. healthcare system would consume a volume or three. The United States spends more per person on healthcare than any other major industrialized nation, but our outcomes badly lag our peers. A 2021 study by the Commonwealth Fund, for instance, ranks America last among countries in the OECD on measures such as access to care, administrative efficiency, equity, and healthcare outcomes. Medical debts are a leading cause of personal bankruptcies, and the quality of care a person receives depends all too often on the color of their skin, as the coronavirus pandemic all too starkly revealed. This chapter explores just 3 of the myriad ways in which healthcare profiteers enrich themselves at the expense of government programs, while at the same time jeopardizing the health of the poor. In the case of Medicaid dentistry, the problem is overtreatment, the consequence of fee-for-service payments and other policies that encourage the kind of volume-based treatment practices attributed to companies like Cool Smiles. In the case of Medicaid managed care, where companies received fixed payments per patient, patients experienced the opposite problem. Companies focused on maintaining their margins deny sick people needed services. A final example profiles the dialysis industry, where a powerful duopoly makes its profits from a steady stream of disproportionately low-income and minority patients, and the government dollars that accompany them. Each of these case studies, in turn, reflects a broader systemic flaw in the U.S. healthcare system, that profit-driven healthcare all too often reinforces disparities in care instead of alleviating them. Medicaid dentistry, from the mouths of babes. In January 27, the Pueblo chieftain ran an obituary for local dentist and Colorado native Eddie DeRose, who passed away at the age of 82. The article lauded DeRose as a champion of the underdog, a philanthropist, an avid football fan whose generosity prompted Colorado State University to name its stadium in his honor. Among his achievements, the obituary noted, was serving low-income children eligible for Medicaid through a network of clinics he built nationally. He was the only one in town to accept Medicaid at one time, and then that spread across the country with his clinics. His son Dan DeRose told the chieftain, millions of children nationwide received dental care because of Eddie. But DeRose's legacy was perhaps not so straightforward, or heroic. The dentistry chain DeRose founded, Small Smiles, was the target of multiple state and federal investigations, ultimately leading to a $24 million settlement with the Department of Justice. Though by then, DeRose had sold his interest to other parties. An exposé of his clinic's practices by the Colorado Springs Gazette led to new state rules restricting the use of papoose boards, flat boards resembling straitjackets that immobilize a child's head and limbs during dental procedures. The chain also became the centerpiece of a U.S. Senate hearing on the perils of corporate dentistry. And DeRose's son, Michael, also a dentist, became the subject of another $10 million settlement to resolve fraud claims against a chain of clinics he owned in North Carolina, while his license in Colorado was made permanently inactive. As with Cool Smiles, both Small Smiles and the younger DeRose's North Carolina clinics were accused of performing medically unnecessary procedures on their young patients, including baby root canals and the installation of steel crowns. These persistent patterns of practice, Cool Smiles and Small Smiles, are by no means alone in their alleged behavior, point to bigger problems with Medicaid and low-income children's access to dental care. Children either aren't getting the care they need, or the care they get is substandard, from Medicaid mills run by for-profit chains. However, governmental policies are what's allowed these companies to prosper. In most states, Medicaid reimbursements are far below what private insurers pay. It's no wonder, then, that Medicaid dentistry is a volume business. That's the only way to profit. And because most dentists don't accept Medicaid, Medicaid-focused practices have grabbed the market for themselves. As a result, chains like Cool Smiles and Small Smiles are all too often the only option for children in poverty who need dental care, if they get treatment at all. Dental health disparities and why they matter. In 2007, a 12-year-old Maryland boy, Diamante Driver, died when bacteria from an abscessed tooth spread to his brain. His mother had struggled to find a dentist who would accept Medicaid, and by the time Diamante got sick, his coverage had lapsed due to problems with paperwork. At the time of his death, authorities discovered fewer than 1 in 3 Medicaid-eligible children in Maryland was receiving dental care. Nearly 15 years later, too many children still aren't getting adequate dental care, even though Medicaid has required states to provide kids with dental coverage since 1967. Under Medicaid's early and periodic screening, diagnostic and treatment benefit, states must cover all medically necessary dental services for children up to age 18. In contrast, states are not required to provide dental care to adults, except in the case of emergencies. Children are supposed to get not only treatment for toothaches and cavities, but also regular checkups, cleanings, and orthodontia, provided it's medically necessary and not simply cosmetic. Yet only about half of all children enrolled in Medicaid saw a dentist in 2019, according to the Pew Research Center, and in some states, access is even more limited. One government study of patients in California, Indiana, Louisiana, and Maryland found that 78% of Medicaid-enrolled kids received insufficient care, and as many as 1 million kids received no services at all over a 2-year period. Oral health often doesn't get the attention it deserves, but it's a key driver of health disparities among Americans, with ramifications far beyond the pain of a toothache. In 2000, the U.S. Surgeon General's first ever report on the importance of oral health decried a silent epidemic of dental and oral diseases that included not just dental cavities or tooth decay, but also gum disease, oral cancers, and infection, all aggravated by sugary, ultra-processed modern diets and the widespread use of tobacco. Research found alarming links between gum disease and diabetes, while chronic oral infections signaled a greater likelihood of strokes, heart and lung conditions, and poor prenatal health. The mouth is a mirror, the report concluded, of a person's overall well-being. A follow-up report in 2021 noted vast disparities in both oral health outcomes and access to care, depending on income and race. Children in poverty are more than twice as likely to suffer from untreated tooth decay compared to their non-impoverished peers, for instance, as are Mexican-American and non-Hispanic Black children compared to white children. This disproportionate burden worsens other inequities faced by children in poverty. Among preschoolers, for instance, untreated dental problems can mean oral pain, chewing and sleeping difficulties, changes in behavior, and poorer school performance. Kids with toothaches often don't eat, leading to weight loss and delayed growth and development. Among older children, dental issues can seriously hamper academic performance. Children with toothaches and other dental problems are less likely to finish their homework, more likely to miss school, and have lower grade point averages than children without these concerns. The parents of these children were also more likely to be absent from school or work, missing an average of 2.5 days per year. Lack of access to routine dental care drives up healthcare costs as well. Dental emergencies are all too common, as is the reliance on expensive hospital ER departments for care. Dental problems accounted for more than 2.4 million ER visits in 2014, according to the 2021 Surgeon General's report, resulting in more than $1.6 billion in charges. Much of this was paid for by the government. In fact, Medicaid pays for more than 2/3 of dental ER visits by children, according to the American Dental Association. And ER care is no substitute for regular dental care. About 90% of the time, treatment consists of just painkillers and/or antibiotics, says the Surgeon General, and appropriate follow-up care is rare. How Medicaid dentistry became a niche industry. The simplest answer for why Medicaid-eligible children aren't getting care is a shortage of dentists willing to treat them. Though Medicaid requires states to offer dental coverage, dentists aren't required to participate, and most dentists opt out. Just 33% of dentists nationwide participated in Medicaid or CHIP in 2017, according to a July 2022 paper by the ADA's Health Policy Institute. And not all these dentists actually treated a Medicaid patient, even if they signed up for the program. In Michigan, for instance, where 71% of dentists were nominally enrolled as Medicaid providers, 15% saw no Medicaid patients at all in 2017. One reason so few dentists accept Medicaid is that it doesn't pay. In 2020, according to the American Dental Association, the average Medicaid reimbursement for treating children was just 61.4% of the fees paid by private insurance. This rate was moreover a decline from 2017, when Medicaid reimbursements averaged 61.9% of the rates offered under private coverage. Reimbursement ratios also vary widely by state, ranging from a low of 27.8% in Minnesota to 104.8% in Kentucky, a definite outlier. In 12 states, Medicaid paid less than half the rates paid by commercial insurance. Oregon, for instance, paid just 38.6% of commercial rates in 2020, and even cut rates in 2021, though these cuts were later partially restored. One 2017 study concluded that raising Medicaid reimbursement rates could help an estimated 1.8 million low-income children gain access to dental care. Many dentists are also coping with high and rising burdens of educational debt from attending dental school, which could prompt some dentists to limit the care they provide for free or at Medicaid's low rates. In 2021, new dental student graduates owed an average of $301,583, according to the American Dental Education Association. Other reasons dentists don't participate in Medicaid are non-financial. Some, for instance, might not want to locate their practices in low-income or rural areas, where Medicaid patients are more likely to live. More than 2/3 of the U.S. counties suffering acute shortages of dentists are in rural America, according to the Rural Health Information Hub. White dentists are also less likely to serve Medicaid patients, according to the American Dental Association's Health Policy Institute. Just 39% of white dentists take Medicaid, compared to 63% of black dentists, 51% of Hispanic dentists, and 50% of Asian dentists. As a result, Medicaid dentistry is concentrated among a subset of providers, many of them affiliated with larger practices or with dental service organizations, or DSOs, which include chains in the mold of Cool Smiles, Small Smiles, and their ilk. 63% of dentists affiliated with DSOs accept Medicaid patients, according to the ADA Health Policy Institute's analysis, compared to 41% of dentists without such an affiliation. In stark contrast to smaller practices, for whom Medicaid patients are unaffordable, these larger concerns have learned to leverage their scale to make Medicaid an engine for profit. Corporate dentistry cracks the code of scale. Despite the controversy to come, Small Smiles' Edward DeRose was among the first dental entrepreneurs in the country to build a profitable Medicaid-only practice, Profitable enough, in fact, to attract the attention of private investors and become a model for other Medicaid dentistry chains nationwide. But it was actually the state of Colorado that gave the chain its start. According to a 2006 investment memo by R Capita, a Bahrainian-based private equity firm that would eventually buy the company, DeRose was running a Medicaid-only clinic in Pueblo when the state criticized for not providing adequate access to dental care for children eligible for Medicaid, requested that DeRose open a Colorado Springs clinic in 1995. In 1999 and 2001, according to R Capita, Colorado officials provided nearly $400,000 in grants for DeRose to open yet more clinics in Denver and Aurora, which prompted the company to realize the potential opportunities waiting in other states. By 2006, when R Capita was ready to buy the chain, the company was running 44 clinics in 14 states, with a projected annual revenue that year of $146.5 million. DeRose's clinics, then run under an umbrella company called Forba LLC, for better access, were unabashedly aggressive in maximizing revenues from their Medicaid patient base. They strategically located clinics in low-income neighborhoods, thereby ensuring a steady stream of Medicaid-eligible patients nearby. The company is an expert in efficiently determining Medicaid or SHIP eligibility, processing claims, confirming appointments, and following up with patients who break appointments, R Capita noted admiringly. The company also overbooked patients and instituted an assembly line approach to treatment that minimized clinic downtime from no-shows and delays. Importantly, Forba's unique business model mitigates the 33% broken appointment challenge, in that patients are not scheduled to have appointments with specific dentists. Instead, any one of 4 dentists at a clinic can see a patient. Therefore, since Forba employs a minimum of 3 to 4 dentists per clinic, Forba can leverage its critical mass of dentists and overschedule appointments by 25%. Since patients are assigned chairs, not individuals, the usual bottlenecks of appointment runovers are cleared because the next dentist available simply sees the next patient. Also unique about Forba's clinics, and what drew the interest of investors like R Capita, was the management structure DeRose and his sons created to expand their Small Smiles empire. DeRose was a pioneer of the dental management company model, now known as DSOs. DeRose and his sons created Forba to provide business and management services to its affiliated clinics, including billing, marketing, administrative support, equipment, and supplies. In many ways, it was not unlike the corporate parent of a franchise, McDentist versus McDonald's, you could say. Because states generally prohibit corporations from owning dental practices outright, Forba did not technically provide dental care, as R Capita's memo put it. Instead, it entered into long-term management agreements with the dentists who nominally owned the company's affiliated practices. But whatever was said on paper, Forba, in practice, effectively owned and managed the clinics, according to R Capita. Among other duties, the company would select clinic sites and even negotiate the leases. It would buy equipment and computer systems, and it would recruit and hire staff, including the dentists nominally owning the practice. In return, Forba received a fee from each of its clinics, equal to the greater of 1. $175,000 per month, 2. 40% of booked patient revenue, and 3. 100% of operating profit, residual collections minus dentist compensation and other clinic operating expenses, a payment structure that R Capita called highly profitable. At the time of R Capita's interest in Small Smiles, arrangements like these were rare, representing less than 2% of the total dental market, according to R Capita's analysis. But R Capita predicted correctly that the dental management company model would grow rapidly. What Forba had invented was a way for non-expert managers and financiers to profit from dentistry without really knowing anything about how to be a dentist. Naturally, Wall Street would find this opportunity irresistible. In 2019, according to the ADA, more than 10% of all dentists, including 20% of dentists under age 34, worked for practices affiliated with the DSO. As of 2021, as many as 27 of the nation's 30 largest DSOs were private equity owned, according to the private equity stakeholder project. Some analysts predict that DSOs could make up as much as 50% of the dental industry by 2030. Certainly, DSOs have their advantages. Dentists are spared the day-to-day burdens of managing a practice, such as dealing with computers, office space, and payroll. DSOs can also leverage the same IT, billing, and finance infrastructure across their practices, thereby standardizing practices and reducing costs. In a 2014 white paper, the Association of Dental Support Organizations, or ADSO, argued that DSOs provide a way for dentists to reduce the time, expense, and stress associated with the administrative aspects of their practices. DSOs have also arguably helped alleviate the shortage of rural dentists by sponsoring visas for foreign dentists willing to work in underserved areas. Few small practices could likely manage the paperwork and expense of dealing with the U.S. immigration system. When I visited the Cool Smiles in Winchester, Virginia, the staff orthodontic specialist, an immigrant from Syria, told me the company was sponsoring his application for a green card. He did not want his name used because the paperwork was then still in progress. Cool Smiles also connected me to another staff dentist, this one from Venezuela, for whom the company was sponsoring an O1 visa, the so-called genius visa for individuals with extraordinary ability. I really thank Cool Smiles for supporting me, this dentist told me. He also noted that he was one of the few available dentists in his area. No one wants this job in a rural area, he said. Other dentists are not interested in Medicaid patients. He estimated seeing 400 to 500 patients a month, some of whom traveled 2 hours each way to see him. If an immigration officer denies my visa, 5,000 Medicaid kids will not have a provider, he said. A spokesperson for Benevis, Cool Smiles' parent company at the time, told me that about 50 of the roughly 500 dentists they employed at the time were in active immigration status under H-1B or O-1 visas. According to H-1B Grader, a website that aggregates H-1B application data, federal immigration authorities approved 513 H-1B visas for dentists in 2022. Western Dental, a DSO owned by a subsidiary of private equity firm New Mountain Capital, was the single largest sponsor of H-1B visas in 2022, with 39 visas issued. Western Dental is currently one of the nation's largest DSOs, with 175 offices in California, Arizona, Nevada, and Texas. 70% of its California patients are covered by Denti-Cal, California's Medicaid dental benefit. As the ADSO argued in its white paper, the administrative infrastructure provided by DSOs frees dentists to serve a wider community base, including patients who have been previously underserved. Certainly that was true for Cool Smiles dentists like the ones who spoke with me. However, this structure has encouraged the volume-based approach to dentistry that has fueled multiple investigations into the Medicaid dental industry. Extracting profits and pain. Shortly after Forba's sale to R Capita, the Small Smiles empire began to disintegrate. In 2008, television station WJLA aired a stunning exposé of the practices inside a Small Smiles clinic in Langley Park, Maryland, just outside Washington, D.C. Video showed a 4-year-old patient, Miguel, crying hysterically while strapped to a papoose board to restrain him during treatment. A dentist pinches Miguel's nose shut to force open his mouth, a practice most dentists abandoned years ago, according to investigative reporter Roberta Baskin, who prepared the report. The papoose board wasn't the only disturbing practice Baskin uncovered. Former staffers spoke of winning bonuses of up to $1,500 a month for converting patients from checkups to major procedures on the same day. 1 in 3 patients got crowns, whether they needed them or not. They wanted us to tell patients they needed services on teeth that were healthy, former staffer Deborah McDaniel told Baskin. Small Smiles clinics had already come under scrutiny in Colorado for using papoose boards to restrain their patients, presumably so treatments would go faster. In 2004, the Colorado Springs Gazette discovered that the clinics had used the boards almost 7,000 times over an 18-month period. In 2005, the Colorado Dental Board issued new regulations restricting the use of papoose boards, except under certain narrow circumstances, and only with parental consent and extensive documentation. According to the Gazette, Michael DeRose had objected to the rules, arguing we should be rewarded for what we do, because we're doing something that nobody else wants to do, and we work very hard. The WJLA investigation sparked multiple governmental inquiries, which led to a $24 million settlement with the Department of Justice in 2010. Prosecutors accused Forba of performing procedures that were either medically unnecessary or performed in a manner that failed to meet professionally recognized standards of care. In addition to paying a fine, Forba agreed to a 5-year corporate integrity agreement under which independent evaluators would monitor the quality of care. In the meantime, Small Smiles co-founder Michael DeRose was embroiled in a separate set of difficulties. Though he had shed his interest in Forba, he apparently imported its practices into a chain of 7 Medicaid dentistry clinics he launched in North Carolina with another dentist. In 2008, DeRose's Medicaid Dental Center, or MDC, agreed to pay $10 million to the federal government and the state of North Carolina to settle claims of Medicaid fraud for medically unnecessary dental services. Local news stations reported that MDC had drilled and capped as many as 16 teeth in one 4-year-old patient in a single visit, using a papoose board to restrain him. When he came out, he was crying. His whole shirt was soaking wet with sweat, the boy's mother told Charlotte TV station WCNC. Another boy, only 3 years old at the time, was subjected to 17 root canals and 17 caps. News of the North Carolina settlement led the Colorado Dental Board to deactivate DeRose's license. Forced into bankruptcy by its problems, Forba re-emerged as Church Street Health Management, later CSHM, but still couldn't avoid further scandal. In a 2012 investigation, NBC News documented persistent allegations of abuse, including unnecessary root canals, shoddy work, and insufficient anesthesia. The U.S. Senate Finance Committee then conducted its own investigation of corporate dentistry, spotlighting CSHM's checkered history. The committee's nearly 1,600-page findings included multiple reports from the independent reviewers charged with monitoring Small Smiles clinics who witnessed some highly questionable practices. At the company's clinic in Oxon Hill, Maryland, for instance, a large mouth prop was used in a young patient number 34, that stretched her lips so tight the doctor was unable to use distraction to mitigate the pain associated with administering local anesthesia to maxillary anterior teeth. The patient cried during administration of local anesthesia. In another instance, monitors reported, a child undergoing a baby root canal screamed and fought the entire time. She vomited approximately halfway through the procedure. The dentist immediately turned the patient on her side and suctioned her mouth and throat. The child's airway was in jeopardy because the mouth prop opened her mouth so wide it restricted her ability to swallow and protect her airway. The patient was screaming and gasping, leaving her airway open and vulnerable. In 2014, the Department of Health and Human Services Inspector General banned CSHM from participating in federal health care programs, including Medicaid, which led to its final demise as a DSO powerhouse. Unfortunately, the end of Small Smiles has not meant an end to predatory dentistry. If anything, the overtreatment and overbilling practiced by Small Smiles has been normalized as the standard of care in Medicaid dentistry. The Small Smiles saga served not as a cautionary tale, but as a blueprint for dental profiteers. In a December 2022 article, published by the Journal of the American Dental Association, or JADA, researchers found that children on Medicaid were much more likely to have experienced multiple root canals compared to children with private insurance, and that these procedures were much less likely to have been performed by a specialist or an endodontist. Investigators and settlements have also become the norm. In 2011, an investigation by television station WFAA in Dallas-Fort Worth, Texas, discovered that Texas's Medicaid program paid $184 million in a single year more than the spending of the next 10 states combined, to put braces on 120,000 children. Among the chief culprits was a chain of clinics called All Smiles, whose owners lived in a Dallas mansion with a private water park and traveled via clinic-owned corporate jets. In 2020, a Travis County District Court held former All Smiles owner Dr. Richard Maloof responsible for 1,842 instances of Medicaid fraud, including more than 100 claims he filed while he was vacationing out of country. Maloof was also required to pay $16.5 million in penalties, interest, and attorney fees. Another WFAA investigation in 2015 found Dallas dentists who were paying patients to come to their clinics. In one instance, the station interviewed a mother who received more than $200 to take her kids to a clinic called Sunshine Dental. That clinic, WFAA found, later billed Medicaid nearly $20,000 for procedures performed on 4 of this woman's children. In another instance, WFAA interviewed 6 children who said they were paid $10 to get into unmarked vans, taken to a southeast Dallas dental clinic called All About Dentistry, and drilled without their parents' permission. In 2017, federal prosecutors entered an $8.45 million settlement with yet another Texas-based DSO, MB2 Dental Solutions, whose 19 affiliated clinics allegedly billed Medicaid for services that were not rendered, were tainted by kickbacks, or falsely identified the person who performed the service. The Department of Health and Human Services Inspector General's office also conducted a series of investigations in 4 states, Indiana, Louisiana, New York, and California, and found a distressing amount of questionable billing by a subset of dentists. One New York dentist, for instance, provided fillings on 42 separate tooth surfaces for the same child during the same visit, while another performed extractions on 76% of his patients, compared to an average of 10% for all dentists in New York. In California, the IG's office identified 229 dentists who were providing at least 76 services per day, compared to an average of 24 statewide. One of these dentists provided more than 1,000 services per day on 97 days, including a high of 1,658 services on a single day. If this dentist spent only 5 minutes performing each service, it would have taken over 138 hours, the IG's office calculated. The majority of the suspect dentists in each of these states, the IG's report also noted, were affiliated with dental chains. In 2020, USA Today published a year-long investigation into the North American Dental Group, which owns 200 offices in 13 states. Among other practices the paper uncovered, North American Dental pits office against office and dentist against dentist by sending out monthly tables ranking dentists and hygienists by who's making the most money per appointment. Offices failing to hit their goals are colored in red and told to step it up. And then, of course, there was the Justice Department's $23.9 million settlement in 2018 with Benevis and Cool Smiles, whom the government accused of submitting false claims to state Medicaid programs for medically unnecessary pulpotomies, or baby root canals, tooth extractions, and stainless steel crowns, in addition to seeking payment for pulpotomies that were never performed. According to a whistleblower who worked in one of the chain's Connecticut clinics, Cool Smiles dentists wrapped child patients in papoose-like cocoons to keep them still and kept a hairdryer to dry children's clothing when they wet themselves during treatment. This whistleblower also told their lawyer that Cool Smiles dentists were young, foreign-born in the U.S. on visas and dependent on Cool Smiles salaries, according to the Hartford Courant. Unfortunately, the problem of Medicaid dentistry brooks no easy answers. Simply raising the rates Medicaid pays, for example, may not prompt more dentists to accept Medicaid patients, thereby easing the shortage of high-quality providers. And it could even backfire by encouraging profit-mongering. According to a 2012 Frontline investigation, Connecticut raised the fees it paid to Medicaid dentists in 2008, which attracted a slew of new dentistry chains to the state, including Cool Smiles. Within months, Frontline reported, the state's Medicaid dental director saw a disproportionate spike in kids getting stainless steel crowns to treat cavities. That's because the state was paying about $230 per crown versus $100 for a filling. Likewise, in Texas, more money for Medicaid has not meant better care. As the result of a class action lawsuit filed in 1993 on behalf of the state's indigent children, the state of Texas agreed to dramatically increase its spending on Medicaid, including on dental benefits, to improve access to care. But, as Dr. Christine Ellis of the University of Texas Southwestern testified to Congress in 2012, the result was an explosion in fraud, typified by the All Smiles case noted earlier. Texas has spent a lot of money straightening basically already straight teeth and has gained a lot of fraudulent orthodontic providers, Ellis testified. We have used the mouths of children to enrich unethical providers and private equity investors. Unless and until the profession of dentistry can solve the problem of equitable access to dental services, low-income children will remain at the mercy of unscrupulous practitioners, using government dollars to deliver substandard care. Managed care, growing profits. In January 2015, Iowa's then-Governor Terry Branstad unilaterally announced his plan to privatize the state's Medicaid program, putting more than 500,000 Iowans' health into the hands of managed care. Medicaid costs had risen an unsustainable 73% since 2003, state officials said, and privatization would save the state money. Instead of traditional fee-for-service Medicaid, where the state pays doctors and hospitals directly, the state would pay a fixed fee per patient, for example, a capitation payment, to private managed care companies, which would in turn pay providers. In theory, managed care companies can negotiate lower prices for prescription drugs, hospital stays, doctor visits, and other services. Fixed payments also theoretically encourage insurers to prioritize preventative care and the management of chronic conditions, so patients avoid expensive emergencies. Medicaid members will receive better coordinated care so that they get the services they need to become healthier. An overall healthier Medicaid population will drive down program costs, said then Medicaid Director Mickey Steyer in a 2015 press release. In the first 6 months alone, Branstad's team optimistically predicted savings could total as much as $51.3 million. Annual savings could reach $232 million. But just 2 years later, the Des Moines Register's editorial board was condemning the effort as a slow-motion train wreck. Contractors had abandoned the program or been fired. Projected savings failed to materialize. Doctors and hospitals were dissatisfied, and patients weren't getting adequate care. Nor did things improve. After nearly a decade in, Iowa's Medicaid program was still a prime example of privatization falling short of its promise, an outcome that would recur in other states that fell to the same allure. Iowa's Medicaid transition was a textbook case of privatization gone awry. Less than a year into the transition, the state canceled its contract with WellCare, one of 4 companies hired as the state's first Medicaid contractors. Trouble with contractors has been one reason Iowa's privatization has been rocky. In its bid to the state, WellCare neglected to mention a corporate integrity agreement it entered with the federal government after 4 of its executives were convicted of Medicaid fraud, including the CEO. In a related settlement, WellCare had also agreed to pay $137.5 million to the federal government and 9 states to settle the charges against it. Not only had the company misrepresented the medical conditions of patients and the treatments they received, the U.S. Department of Justice alleged, but WellCare had also engaged in certain marketing abuses, including the cherry-picking of healthy patients in order to avoid future costs, manipulated grades of service or other performance metrics regarding its call center, and operated a sham special investigations unit. All of this was highly relevant information WellCare should have disclosed to Iowa officials, ruled an administrative law judge who reviewed the bidding process after rival companies sued to protest WellCare's winning bid. By 2019, 2 more companies had quit the state on their own, citing underfunding and unacceptably low reimbursement rates. United Health, for instance, claimed it had lost $250 million on Iowa's program, despite receiving more than $2 billion in state and federal Medicaid payments a year to cover about 425,000 residents. As of year-end 2021, just two companies, Amerigroup and Iowa Total Care, a subsidiary of Centene, were running Iowa's Medicaid program. Iowa also hasn't seen the savings it thought it would from privatization, even as contractors have complained of underpayment. A 2018 report by state auditors calculated $126 million in savings that year on a nearly $5 billion program, or less than half the amount projected by the governor's office. Privatization, instead, has been costly for doctors and hospitals who say they've struggled with added bureaucracy to justify the treatments they provide. In a 2020 state auditor's survey of Iowa Medicaid providers, nearly two-thirds, 65.8%, said submitting claims was more complex and took longer, while 57.9% said costs for staffing and administration had increased. Just 6.1% of doctors and hospitals felt privatization had been beneficial to quality of care, and only 9.9% felt it had improved access. 4 in 10, or 41.1%, said they were dissatisfied or extremely dissatisfied with their ability to provide services to Medicaid patients. And the overwhelming majority said new restrictions on care imposed by managed care companies were inappropriate. Patients have, in fact, been denied necessary care, the most troubling consequence of Iowa's Medicaid privatization. In a 2021 investigation, the state auditor's office found a massive increase in illegally denied claims after managed care's takeover of Medicaid. In a comparison of pre-privatization and post-privatization appeals for claims denied, auditors found an 891% increase in the number of times that courts reversed the judgment of managed care companies, thereby finding the initial denial to be illegal. Privatized Medicaid in Iowa is substantially less likely to follow the laws and regulations regarding providing care to members, the auditor's report concluded. As disability advocate Jen Wolfe told Cedar Rapids The Gazette, Iowans were made more vulnerable by privatization. Though Iowa's experience illustrates well the potential downsides of Medicaid privatization, managed care is now the predominant delivery system for Medicaid, according to the Congressional Budget Office, or CBO. As of July 2020, more than 58 million Americans, or about 72% of Medicaid patients nationwide, were enrolled in a comprehensive Medicaid managed care plan from which they received all their care. The share of total Medicaid spending going to managed care has grown dramatically, from 15% to 37% between 1999 and 2012, according to the CBO. In 2020, reports the Kaiser Family Foundation, payments to Medicaid managed care organizations accounted for 49% of all Medicaid spending, making it the single largest category of spending within the program. The growth of Medicaid managed care has, of course, also meant the growth of the Medicaid managed care industry, dominated by the Big Five companies: Aetna, CVS, Anthem, Centene, the company with a subsidiary in Iowa, Molina, and United Health Group. These companies control about half of the Medicaid managed care market nationally, according to Georgetown University's Health Policy Institute, with a total 2021 enrollment of about 39.4 million. Companies collect substantial amounts acting as the middlemen between patients and providers. In Iowa, for instance, managed care companies can receive up to 12% of total state Medicaid costs for their fees, according to a 2018 report by the nonprofit In the Public Interest, or $57.6 million on a $4.8 billion program. The organization also points out that the state only spent between 4% and 8% on administrative costs before privatization. Over the last 20 years, changes in federal law have helped facilitate the shift to managed care. Fiscal pressures have also prompted states to look for managed care to control spiraling budgets. But, as Iowa's privatization transition shows, the promised benefits of managed care are far from guarantee. Research shows mixed results for patients' health, The only certainty has been the steady stream of revenue flowing to managed care companies. The rise of Medicaid managed care. Unlike Medicare, which is an exclusively federal program, Medicaid has always been administered by the states. While federal law sets broad national standards, states control program design and administration, including eligibility, payment rates, and the freedom to adopt delivery models like managed care. The federal government's chief role is to help finance the system. Under a federally defined formula, poor states get more federal help with Medicaid expenditures, while wealthier states get less. In Mississippi, for instance, the federal government will pay 84% of Medicaid costs in 2023, compared to 56% in Massachusetts. A formula determines the exact percentage. California began experimenting with managed care as early as the 1970s, according to the Robert Wood Johnson Foundation, or RWJF, though these early efforts were especially disastrous. Inexperienced entrepreneurs created dozens of new entities, which marketed door-to-door, signing up thousands of beneficiaries, as a foundation report recounted in A History of Medicaid Managed Care. Within months, there were allegations of illegal marketing, inadequate access, poor quality, and undercapitalized health plans. In 1976, Congress passed legislation to prevent these kinds of misadventures, allowing only federally qualified HMOs, or health maintenance organizations, to enter state-managed care contracts. This limitation would prove short-lived, however, under President Ronald Reagan's push for privatization. Throughout the 1980s, reports RWJF, Reagan encouraged states to adopt Medicaid managed care, and Congress reversed the requirement that HMOs must be federally qualified to enter state contracts. By 1992, a little more than 1 in 10 Medicaid enrollees was participating in managed care. But it wasn't until later in the 1990s that Medicaid managed care truly began to take off, catalyzed by new federal requirements expanding Medicaid and a recession that severely strained state budgets. In 1989, Congress passed legislation mandating Medicaid benefits for low-income pregnant women and children under 6, who lived in households with incomes up to 133% of the federal poverty line. Congress also expanded benefits to low-income children under 18 living in poverty. Together, these mandates added millions of people to state Medicaid rosters, along with billions in additional expenses. State policymakers began referring to Medicaid as the Pac-Man of state budgets, gobbling up nearly all available revenues, according to RWJF. Managed care, with its promise of better care at a lower cost, became increasingly appealing to desperate states. Congress then passed the Balanced Budget Act of 1997, which included multiple provisions creating a glide path for Medicaid managed care. First, the legislation allowed states to require that Medicaid enrollees participate in a managed care plan. Second, it allowed states to limit the choice of available plan providers to only 2. Third, Congress repealed federal protections allowing Medicaid beneficiaries to disenroll from a plan for any reason on 1 month's notice. The purpose of this provision was to protect enrollees from denials of service. Instead, it enacted a provision allowing plans to lock in members for 12 months and requiring enrollees to show cause to the state if they wanted to switch. In addition, Congress repealed the 75-25 rule, which had required Medicaid contractors to enroll at least 25% of their members from outside Medicaid. Ending this requirement paved the way for companies focused solely on Medicaid enrollees. By 2009, the Medicaid managed care market was booming, with as many as 10 publicly traded companies in this market, 4 of which focused almost exclusively on managing the care of Medicaid enrollees, according to the Commonwealth Fund. Among the businesses flying high was WellCare, the company that lost its contract in Iowa, whose biggest early investor was a private equity fund connected to billionaire George Soros. 2 years after going public in 2004, WellCare's stock price had already tripled, boosting the wealth of its CEO, Todd Farha, by $77 million. Farha would later be sentenced to 36 months in prison as one of the company's 4 executives convicted of fraud. Soros's fund, meanwhile, cashed out its stake for $870 million in 2006, compared to an initial investment of $220 million, according to the Wall Street Journal. Companies don't need to disclose exactly how much money they make from Medicaid, a lack of transparency that Georgetown University's Health Policy Institute calls a public policy failure. So it's impossible to determine the total volume of governmental dollars going to managed care companies. But revenue data for California's Medi-Cal program, obtained by California Healthline, gives one small window into how profitable Medicaid managed care has become. According to a spreadsheet provided to Healthline by the California Department of Healthcare Services, or DHCS, companies operating in California collected about $2.9 billion in net profits from 2014 to 2020, while overall revenues ballooned from $2.8 billion to nearly $13.6 billion over that period. Companies seeing the fastest growth included Blue Shield Promise, whose revenues grew from $60.7 million in 2012 to $403.7 million in 2020, and Molina, whose revenues spiked to $1.63 billion in 2020, from $374.4 million in 2012. Like the healthcare and insurance industries generally, the Medicaid managed care industry has experienced significant consolidation over the past decade, hence its current domination by the Big Five. Embattled WellCare, for instance, was acquired by Centene in 2019 for $17.3 billion. The combined company was expected to cover 22 million enrollees nationwide in 2019 and generate $97 billion in projected revenue, according to a company press release announcing the deal. In 2021, Centene acquired Magellan Health, another Medicaid-focused company, for $2.2 billion. Through this transaction, according to the company, Centene acquired an additional 5.5 million members enrolled in government-sponsored health plans, including, but not limited to, Medicaid, as well as 41 million enrollees of a specialty managed care program focused on behavioral health, for example, mental health, addiction treatment, etc. For the fiscal year ended December 31st, 2021, according to its publicly filed annual report, Centene reported total revenues of $126 billion. It also reported 72,500 full-time employees. But while companies have been thriving, many patients have fared less well. Managed care, in fact, has aggravated existing flaws in the U.S. healthcare system, especially when it comes to disparities in care and outcomes for lower-income Americans, nor has it delivered the dramatic cost reductions states want. Illusory savings. Like Medicaid dentistry, Medicaid managed care is a volume business. The more enrollees a company signs up, the more revenue it collects. But unlike dentistry, where providers are paid for each service and have an incentive to perform as many procedures as they can, managed care companies are under pressure to keep costs low. Because companies receive a fixed amount per patient to cover their healthcare costs for the year, more services provided mean less profit for the company. Federal law does require, however, that at least 85% of the amounts paid to managed care companies be spent on beneficiary care, not on administrative expenses or kept as profit. Industry-sponsored studies insist that managed care can deliver both lower costs and high-quality care. For instance, a 2017 study by the Association for Community-Affiliated Plans, or ACAP, calculated that managed care delivered nationwide Medicaid savings of $7.1 billion in 2016, compared to fee-for-service, and that 10-year savings through 2026 would total $94.4 billion. Likewise, a 2020 analysis commissioned by America's Health Insurance Plans, or AHIP, the trade association representing the nation's largest health insurers, concluded that states using Medicaid managed care for prescription drug benefits spent 25% less on drug costs compared to states under traditional fee-for-service plans. Another AHIP Commission study from 2020 claimed that managed care organizations notched dramatic improvements in quality from 2014 to 2018. As measured by national quality standards and consumer assessments. All three studies were authored by the Menges Group, a strategic health policy and care coordination consulting firm that also published a 2021 review of Kentucky's shift to managed care. According to the group's analysis, managed care potentially saved Kentucky as much as $310 million in fiscal 2019, or up to $1.7 billion, counting the federal government's share. Kentucky's Medicaid managed care program has significantly reduced Medicaid program expenditures, the study concluded. In truth, research has found little rigorous evidence that states have saved much money by transitioning to managed care. In one analysis of state Medicaid expenditures from 1991 to 2003, when managed care enrollment soared from 11% to 58% of all Medicaid enrollees, researchers for the National Bureau of Economic Research, or NBER, concluded that shifting Medicaid recipients from fee-for-service into Medicaid managed care did not reduce Medicaid spending in the typical state. In fact, some states ended up spending more if payment rates were initially too low to attract doctors and hospitals into networks. Cutting costs or cutting corners. Managed care hasn't meant better quality care, despite industry claims. Certainly successes are out there, but according to the federal government's Advisory Commission on Medicaid, or MACPAC, research is scarce and the results are mixed. For instance, notes MACPAC, a 2016 study of the Texas Medicaid program found one distinct benefit from managed care for children with type 1 diabetes. They were less likely than other children to be readmitted after hospitalization, possibly indicating greater access to services that helped them prevent readmissions. Meanwhile, another analysis of Texas's program found the transition to managed care worsened the incidence of infant mortality, preterm births, and low birth weight among Black infants compared to Hispanic children. In fact, the Black-Hispanic mortality gap rose by a shocking 42%, according to research cited by MACPAC. Managed care's goals for cost reduction can clash with patients' needs for care. One 2021 NBER analysis, for example, examined the quality of services provided by the lowest spending Medicaid managed care plans. Rather than reducing wasteful spending, lower spending plans broadly reduce medical service provision and worsen beneficiary satisfaction and health, the study concluded. Not only are enrollees less likely to receive any care at all, but they're also more likely to experience avoidable hospitalizations, resulting from the lack of needed care. These cheaper plans are not achieving savings by keeping people healthy, the researchers concluded. They are restricting access to a broad set of services with potentially harmful health consequences. At times, this lack of access can be deadly. Another NBER study, also from 2021, found that the mandatory enrollment of seniors and persons with disabilities into California's Medicaid managed care plans led to an increase in preventable emergency room visits and a 12% increase in deaths, especially among sicker enrollees. Lack of access to care can mean that needed services aren't covered or that claims are denied. It can also mean a shortage of providers willing to accept rock-bottom payment rates. A 2014 survey of 1,800 randomly selected Medicaid providers nationwide, the HHS Inspector General's office found that slightly more than half of providers could not offer appointments to enrollees. More than a third, 35%, could not be found at the location listed by the plan, and 16% said they were either not participating or not accepting new patients. Among providers who did have availability, the IG's office found, the median wait time for an appointment was 2 weeks, 10 days for a primary care provider and 20 days for specialists. One specialist, a neurologist, had a wait time of 9 months, while another offered appointments only if the patient had a body mass index or BMI under 40. A secret shopper study commissioned in 2022 by the New Mexico legislature found even worse results. Investigators calling providers could schedule appointments only about 13% of the time, thanks to inaccurate listings and voicemails that were never returned. Nevertheless, New Mexico's Medicaid program costs the state and federal government about $8.8 billion a year. Incompetence and failures in performance. As with Medicaid dentistry, Medicaid managed care has had its share of outrages, scandals, and government investigations. In Kansas, for instance, the State Department of Health and Environment fired Medicaid contractor Maximus in 2020. Yes, the same company discussed earlier in this book, after years of complaints about poor performance. At one point, the average wait time for calls to the CanCare service center run by Maximus was 27 minutes. The company had also failed to process Medicaid applications on a timely basis, leading to enormous backlogs. The Kansas City Star reported that some nursing homes turned seniors away because of application delays. In California, multiple investigations by Kaiser Health News and state auditors led to a wholesale reboot of the entire $124 billion Medi-Cal system in 2021. Kaiser's investigation found that 25 managed care companies hired to run the state's Medi-Cal program systematically outsourced their responsibilities to independent physician networks and even to other health plans. These subcontractors, in turn, hired their own contractors to process claims. The result was a thicket of bureaucracy, leading to substandard care and unjustified denials. One subcontractor investigated by Kaiser, Cinermed, was later discovered to have falsified documents for years to cover up improper denials of care. Another company, Agilon, admitted to state regulators that its employees had been altering records to pass state audits, such as by changing dates to cover up delays. State officials, meanwhile, discovered that many low-income Californians weren't receiving basic care, despite Medi-Cal's soaring costs. A 2019 report by the State Auditor's Office ranked California 40th in providing preventative health services to children, largely due to lack of access to care for children on Medi-Cal. As many as 2.4 million children a year weren't getting required services, such as vaccinations and regular checkups, and only 25% of California children had received a development screening by age 3. In 2021, California regulators set about rewriting the state's managed care contracts, vowing to tighten oversight. And in 2022, the state levied a record $55 million in fines on LA Care, the state's largest Medicaid contractor, for its failures in performance. It's unclear, however, just how much things will really change. In 2022, Kaiser Health News reported that the state's new Medicaid prescription program, awarded to Magellan Health, now owned by Centene, was riddled with problems, including wait times of up to 8 hours on call center phone lines. When the state awarded new Medicaid contracts in 2022, the biggest winners were 3 companies that already had major footprints in the state: Molina, Anthem Blue Cross Partnership Plan, and HealthNet of California, also now owned by Centene. In an appeal filed by longtime contractor Blue Shield, whose bids were shut out altogether, the company accused its rivals of failing to disclose hundreds of millions of dollars in penalties against them, according to Kaiser Health News. Blue Shield's filing further attacked the winners for poor performance and even mendacity, and submitting bids filled with puffery, which the state bought hook, line, and sinker, without an iota of independent analysis. Blue Shield CEO Paul Markovich also posted an open letter to the people of California in October 2022, warning that the state had chosen for-profit health plans with poor track records in improving access to quality care. The letter was taken down as of January 2023. Molina's CEO, meanwhile, reportedly told investors that the new Medi-Cal contracts would have a profound impact on his company, according to the Los Angeles Business Journal, boosting revenues by as much as $6 billion a year. Poor oversight, revenue maximization, and fraud. States arguably bear a good share of the blame for the problems plaguing Medicaid-managed care. Federal investigators have found lax oversight, sloppy record-keeping, and, on occasion, collusion to grab federal dollars. Some states, for instance, have learned that their own coffers benefit from overbilling Medicaid, particularly if they hire revenue maximization consultants to help them. In a spate of investigations between 2006 and 2013, the HHS Inspector General's office discovered that 4 states, Arizona, Missouri, New Jersey, and Wisconsin had each overbilled Medicaid with the help of Maximus. Yes, that Maximus, which was acting as a revenue maximization consultant. In Wisconsin, for example, Maximus was paid contingency fees based on the amount of reimbursements it helped Wisconsin garner, creating an incentive for Maximus to encourage the state to increase its billing, according to a 2019 report by the government contractor Accountability Project. Among the reimbursements Wisconsin asked for from the federal government was $41.4 million between 2004 and 2006 for a Medicaid-financed psychiatric services program. The IG's office concluded that 95% of the state's claims, or $39.4 million, were actually unallowable. In 2012, a congressional hearing on Medicaid fraud aired allegations of state schemes to game federal Medicaid reimbursements in their favor. States systematically overpaid managed care companies to cover Medicaid beneficiaries, while underpaying the same plans for coverage of individuals paid for with state-only dollars, said Iowa Senator Chuck Grassley. This appears to be another example of the old game of states pushing the bounds to maximize federal dollars received while minimizing state dollars spent. Minnesota, for instance, was allegedly inflating what it billed the federal government for Medicaid in order to subsidize 2 state-funded medical programs ineligible for federal money, according to the testimony of a whistleblower, who called the scheme a substantial and massive fraud against the federal government. In most cases, however, simple inattention and lack of oversight capacity are the likeliest culprits for programmatic inefficiency and waste. States have, for instance, paid tens of millions of dollars in annual capitation payments to managed care companies for Medicaid beneficiaries they didn't know had died. In another series of investigations, from 2018 to 2021, the HHS Inspector General's office discovered that California had paid nearly $74 million to managed care companies on behalf of deceased beneficiaries, while Ohio had paid as much as $90.5 million. Ohio did not always identify and process Medicaid beneficiaries' death information, said the IG's office, which meant those residents stayed on the rolls and companies got their payments. On a separate 2021 investigation, the HHS Inspector General's office found that most states could not provide complete or accurate payment data about the claims submitted to their Medicaid managed care plans, which potentially meant significant levels of improper or improperly documented claims. In fact, the Centers for Medicare and Medicaid Services, or CMS, estimates that 21% of Medicaid claims filed in 2021 lacked proper documentation. This does not mean, however, that 21% of Medicaid claims were wrongly paid. One potential reason for this apparent laxity is philosophical. A principal rationale for privatization by states is to offload the hassle of running a government program. But as public management expert Don Kettle has argued, privatization doesn't work without effective contract management, which can sometimes be more difficult than program administration, yet often falls by the wayside in the rush to privatize. States have also been experiencing a brain drain of experienced Medicaid administrators to manage program oversight, in part because they are leaving for the private sector. In 2016, the median tenure of state Medicaid directors was only 2 years, down from 4 years prior. Managed care executives not only get paid more than state Medicaid directors, but also have easier jobs, according to a 2017 study by the Government Accountability Office, or GAO. Based on a 10-state survey it concluded, the GAO found that state Medicaid directors were paid an average of $152,439 in 2015, compared to the $236,007 average salary for the top executives of private managed care organizations, whose salaries ranged as high as $1.9 million. Executives also received bonuses, stocks, and other compensation averaging $78,271. State Medicaid directors also described their jobs as very complex and time-consuming, and said that they were held accountable for their state's Medicaid program to the federal government, their governor and legislature, the media, and the public. Managed care executives, meanwhile, said their roles were generally less complex and time-consuming, and that they didn't face the same level of accountability as their public employee peers. In its 2014 report to Congress, MacPac cautioned that states were not investing in the administrative capacity necessary to administer their Medicaid programs effectively, especially as their size and complexity have grown. There are few clear standards to assess efficiency, value, or performance in state and federal Medicaid program administration, MacPac concluded. Nevertheless, the Medicaid managed care industry is certain to grow, even as patient care potentially suffers. The dialysis machine. As many as 37 million Americans have chronic kidney disease, often the result of diabetes, high blood pressure, and other chronic conditions. If you're white, well-educated, and middle class or better, odds are you'll get the right kind of medical care that will save your kidneys. You likely have private health insurance and get regular checkups. You likely caught your condition early and are taking medicines to slow down the disease's progression. And if you're unlucky enough to be among the roughly 130,000 Americans diagnosed each year with kidney failure or end-stage renal disease, ESRD, you probably still have the resources and wherewithal to get yourself as fast as possible on the wait list for a kidney transplant. But if you're poor, less educated, or black, odds are that your kidney disease will run unchecked, the result of long-standing disparities in access to quality care. You will likely end up on dialysis, spend 3 days a week, 4 hours a spell, at a place like the one in a run-down strip mall on Pennsylvania Avenue, Southeast, in Washington, D.C., in a heavily African-American neighborhood across the river from the Capitol. The DeVita Washington Southeast Dialysis Center has room for 25 patients at a time and takes up a full corner of the shopping center. It's right next door to a liquor store and steps away from an Ace Cash Express check cashing outlet, a barbershop, and a carry-out fast food place. I dropped by one sunny August day, pre-pandemic, when I first started researching the dialysis industry for Washington Monthly magazine. An elderly, fragile-looking black man was slumped in a wheelchair, eyes closed, just outside the center's doors, where a big sign on the glass warned visitors that firearms were not allowed inside. A Metro Access public bus was idling in the parking lot, waiting to take other patients home. It was mid-afternoon, but the shopping center was buzzing with knots of people hanging out by the carry-out and the barbershop 2 doors down. Everyone I spoke to seemed to know someone on dialysis. One man in a barber smock out for a cigarette break told me he had a friend who died at a dialysis center. He wouldn't share his name. Bad for business, he said, but he said ambulances were a constant presence at DeVita. It's not unusual for people to die on dialysis. In fact, about 1 in 5 dialysis patients die in the first year, and 6 in 10 will be dead within 5 years. Among patients over 65, who make up more than half of those who begin dialysis, 30% won't survive the first year. Farther down the sidewalk, I met Sharon C., who was waiting on her daughter at the carryout. Soft-spoken and fine-boned, she wore a flowing sleeveless white dress and Jackie O sunglasses, her caramel-colored hair in a ballerina bun. She said she was 62 years old. She, too, was sitting in a wheelchair, and I noticed how her left foot and ankle were grotesquely swollen, a shocking mismatch with the rest of her slender frame. It was the result of poor circulation caused by the diabetes she was diagnosed with in 2005. Sharon is also on dialysis, but goes to another DeVita center, this one at 8th and C Streets near Capitol Hill, where she spends every Tuesday, Thursday, and Saturday. You can't miss a treatment, she said. You can't go anywhere. She said she started dialysis 2 months earlier when her one functioning kidney finally failed. She wasn't on the wait list for a transplant. I need to find a donor, she said, echoing what patient advocates say is a common misperception among dialysis patients. I don't want to be like this. Government statistics show that people with less than a high school diploma are more than twice as likely to be diagnosed with kidney disease than people with a bachelor's degree, while someone earning $35,000 or less is about 3 times as likely to be diagnosed than someone earning $100,000. And of more than 800,000 Americans living with kidney failure, a disproportionate share are low income or Black. Black Americans are 3 times as likely to experience kidney failure as whites, while the risk for people in poverty is more than double that of those who aren't poor. Black Americans also account for 35% of people on dialysis, according to government statistics. This explains the profusion of dialysis centers in neighborhoods like the one in southeast Washington, D.C. In the District of Columbia, where the prevalence of diabetes, a leading cause of kidney disease, is 6 times as common among Black residents as it is among whites, there are 22 dialysis centers inside the city. Located mostly in northeast and southeast Washington, the heavily lower income and African American parts of the city. Another 106 dialysis centers are within a 25-mile radius of D.C., again concentrated in the suburbs with the largest minority and lower-income populations. Just across the river in District Heights, Maryland, for example, a DaVita clinic dominates the busy intersection of Pennsylvania Avenue and Silver Hill Road, while a U.S. renal care clinic sits just across the street. Like check-cashing outlets, payday lenders, and other businesses that disproportionately serve low-income and minority communities, dialysis centers are now fixtures in the urban commercial landscape. We used to say there's a liquor store on every corner, Howard University transplant surgeon and professor of medicine Clive Callender told me. Now we say there's a dialysis unit on every corner. The overwhelming majority, or 89% of these clinics, are for-profit, and their ownership is dominated by just 2 companies, Colorado-based DaVita Inc. and the German conglomerate Fresenius Medical Group. According to the federal government's Medicare Payment Advisory Committee, MedPAC, the 2 firms control 3/4 of the nation's roughly 7,800 dialysis facilities. The bulk of their revenues, moreover, come from the federal government, which pays for the lion's share of dialysis care in the United States. Under the current system, Medicare guarantees payment for every dialysis session, which means that clinics bill the federal government for each treatment they provide. In 2022, according to its annual report filed with the Securities Exchange Commission, or SEC, DaVita earned 67% of its revenues from government-sponsored health plans, including Medicare and Medicaid. Revenues for the year totaled $11.6 billion, $10.6 billion of it from its U.S. dialysis operations. The company also runs clinics overseas. It administered more than 28.9 million dialysis treatments in 2022, for an average of 92,506 treatments per day. Though DaVita and Fresenius are private, for-profit companies, they are, like defense contractors, basically subsidiaries of the federal government, given the share of their revenues that come from federal dollars. What the federal government spends on dialysis also amounts to a shockingly large share of the federal budget. While kidney failure patients make up about 1% of Medicare beneficiaries, they accounted for 7.1% of Medicare spending in 2019, and almost 1% of the total federal budget. On average, each patient costs the government $82,190, much of it for dialysis, but also for medications, hospitalization, and other ancillary care. Like Medicaid dentistry, the treatment of kidney failure in America is a volume-centered business aimed at keeping dialysis centers running. You fill up a facility with so many stations, you make sure somebody is sitting in each of those chairs around the clock, says Dennis Cotter, president of the Medical Technology and Practice Patterns Institute, MTPPI. It's the Henry Ford production model. It's a system that also arguably creates incentives to keep kidney patients on dialysis until they die. For patients with kidney failure, that means a quality of life that can be intolerable. That can also mean being steered away from other treatments, like transplants, that could improve their lives and even save the government money in the long run. For dialysis companies, however, it means steady and growing revenues, so long as the systemic inequities in U.S. health that contribute to kidney disease and kidney failure persist. The dialysis industry would like the public to believe that dialysis centers are safe and pleasant. For instance, here's for-profit American Renal Associates describing its facilities in its 2019 annual report, filed with the SEC. The company, which operated over 200 clinics nationwide, has since been acquired by private equity and is no longer public. Our clinics generally contain between 15 and 20 dialysis stations, one or more nurses' stations, a patient waiting area, examination rooms, a supply room, a water treatment space to purify water used in hemodialysis treatments, staff work areas, offices, and a staff lounge. Our clinics are also typically outfitted with patient-friendly features, including heated massage chairs, wireless internet, and individual television sets. I wasn't allowed to go inside a dialysis clinic like the DaVita Clinic in Southeast D.C. My requests were initially denied out of privacy concerns, and then the pandemic hit. But survivors say the scene inside most centers is grim. Clinics typically consist of one big room, lined with banks of chairs and machines. Patients say they are far from luxurious. Sharon C., for example, said that while the staff at her clinic were kind, flies were a problem. They are everywhere, she told me. You can't eat without the flies coming everywhere. It's not an uncommon issue. Dialysis facilities offer a great environment for some bugs, including roaches, flies, and gnats, reads the Bugs and Infestations webpage on the site of the Quality Insights Mid-Atlantic Renal Coalition, one of several ESRD networks established under federal law to improve the quality of kidney disease care in the United States. Kidney patient Patrick G., who lives near Richmond, Virginia, says he remembers the first time he set foot in a dialysis clinic after his diagnosis in April 2013. I literally cried, he told me. I stood there and cried. I was looking at amputees. I was looking at people who were brought in and out by paramedics. Nobody had a smile on their face. It looked dead. Patient advocate Neil Chegedny, who was diagnosed 2 decades ago, recalls something similar. That first impression of walking into the clinic was all those machines with alarms blaring and people moaning and comatose in their chairs, she said. I call it my PTSD moment. Amenities can't hide the fact that dialysis, technically hemodialysis for the procedure performed in centers, is a grueling process. Your blood is leaving your body, says Dennis Cotter of the Medical Technology and Practice Patterns Institute. It's going through a filter and getting returned. That in itself is traumatic because the blood encounters a lot of foreign surfaces and there's a huge problem with a large variety of infections. Patients often experience cramps, chills, fever, and crippling fatigue as their bodies try to cope with a process that tries to accomplish over 4 hours what a pair of healthy kidneys would do over the course of 2 or 3 days. The treatments in center are designed pretty much to beat you up, said Gedney. That's why people are moaning and comatose. And then it takes them 12 hours to recover. You're literally stunning the body. G said it was all he could do to keep his eyes open on the drive home after a session. One time I got in the garage and parked the car, and my wife found me asleep behind the wheel, he said. Dialysis is hell, says patient advocate David White of Washington, D.C., who spent nearly 6 years on dialysis before finally receiving a kidney transplant. All you want to do is sleep, White told me. You just want to rest until you feel better. And when you feel better, guess what? It's time to go back to dialysis again. It's a pretty strange way to live. Patients' hearts must cope with the stress of pumping their blood through a machine, usually at the rate of a pint per minute. That's a big reason why dialysis is exhausting. According to the U.S. Renal Data Service, more than 40% of deaths among dialysis patients are due to heart problems. I can't remember if the ambulance came for me once or twice, said White, who said he recalled one episode when his heart wouldn't stop racing for the better part of 30 minutes. I saw one person almost die, he said. It was really gruesome. After he was gone, there was a pool of sweat around his chair. It was unbelievable. Whenever he saw a patient carried out, he said, it always goes through your mind that you'll never see that person again. Federal Medicare policy, paved with good intentions. In 2019, more than 490,000 Americans were dependent on in-center dialysis, living the life that David White described. The numbers diminished to about 480,000 in 2020 during the coronavirus pandemic, when medically fragile dialysis patients were especially vulnerable. More than 70% of kidney failure patients who are Black and 65% who are Hispanic rely on in-center hemodialysis, compared to about 52% of whites. White patients are much more likely to have received a kidney transplant, 37% versus 22% and 26% for Blacks and Hispanic patients respectively in 2020. White patients are also more likely to have access to home-based options for dialysis, which are gentler on the body and offer the convenience and privacy of being at home. The irony is that access to a dialysis machine, now the default treatment for low-income patients, was once rare, expensive, and precious. The well-intended changes in federal policy that led to the ubiquity of dialysis today are simultaneously a triumph, a tragedy, and a trap for both patients and the federal government. Until the early 1970s, a diagnosis of kidney disease was literally tantamount to a death sentence. In 1962, journalist Shanna Alexander published a now classic account in Life magazine on the workings of Seattle's Life or Death Committee, a group of 5 anonymous citizens convened by the King County Medical Society to decide who would have access to the Seattle Swedish Hospital's 10 dialysis machines. The committee, the original death panel if there ever was one, looked at applicants' income and net worth, marital status and children, occupation, past performance and future potential, and references. As Alexander wrote, with no moral or ethical guidelines save their own individual consciences, they must decide, in the words of the ancient Hebrew prayer, who shall live and who shall die, who shall attain the measure of man's days and who shall not attain it, who shall be at ease and who shall be afflicted. It's not hard to guess what kinds of patients made the cut and who didn't. In 1972, Congress and President Richard Nixon passed legislation extending Medicare fee-for-service coverage to anyone with end-stage renal disease. It is still the only disease for which its sufferers are entitled to Medicare eligibility, regardless of their age. According to lore, the pivotal moment for the legislation was when kidney patient Shep Glazer hooked himself up to a dialysis machine on the floor of the House Ways and Means Committee and pleaded for the means to afford his treatment. I am 43 years old, married for 20 years, with 2 children ages 14 and 10. Glazer told the committee, if your kidneys failed tomorrow, wouldn't you want the opportunity to live? Wouldn't you want to see your children grow up? Medicare eligibility transformed access to dialysis from a treatment for the lucky few to something standard, commoditized, and ultimately a multi-billion-dollar industry, all during slightly more than a decade. It's a stark testament to government's power in creating and shaping a new market for treatment. With a guaranteed stream of government payment for every dialysis treatment performed, dialysis clinics began springing up nationwide. Some of these were non-profit, such as the Nashville-based Dialysis Clinic, Inc., or DCI, which was established in 1971 and still exists today. Others were for-profit and quickly came to dominate the nascent sector. Fresenius Medical Care is not only one of the world's 2 largest providers of dialysis services, it's also the world's largest manufacturer of dialysis equipment, with total global revenues in 2022 of about 19.4 billion euros. According to Fresenius's 2021 annual report, more than 40% of the hemodialysis machines worldwide are made by the company. It's also the principal supplier of equipment to the world's number 2 dialysis provider, DaVita. The fee that Medicare pays dialysis providers is called a bundled payment, and it varies slightly from year to year, depending on the costs reported to CMS by providers. In 2023, that payment was $265.57 per treatment, and is intended to cover all the services, equipment, supplies, and drugs involved in a single session. The intent of the bundle is to keep costs low for Medicare, but it has also helped enable big players like DaVita and Fresenius to push out small players and non-profits, in the same way Walmarts have decimated small-town mom-and-pops. This payment structure also encourages providers to perform as many treatments as they can at the lowest possible cost if they want to maximize their revenues. The benefits are efficiencies of scale and standardization of treatment, but it also prompts clinics to err toward a one-size-fits-all approach. In a 2017 episode of Last Week Tonight, HBO's John Oliver dedicated an entire show to the questionable practices of dialysis companies and ridiculed the flamboyant ex-CEO of DaVita, Kent Thiry, for riding into company meetings on horseback, dressed as a musketeer, and referring to himself as the man in the iron mask. Oliver also aired a clip of Thiry comparing the management of his dialysis business to that of Taco Bell. If I had 1,400 Taco Bells and 32,000 people who worked in them, I would be doing the same stuff, Thiry tells a group of business students at UCLA. Unfortunately, Medicare's bundled payment approach only encourages Thiry's approach. Dialysis centers are, in fact, like Taco Bells. In the same way that Taco Bell employees might be taught one way to make a burrito that's uniform across the franchise, dialysis center employees might be taught one way to administer dialysis. The typical center. The easiest thing to do is just put them on in-center hemodialysis, said surgeon Joseph Melancon, chief of the George Washington University Transplant Institute. That's one set of skills for the staff. Everybody is the same. The patients come in, they sit there for their amount of time, and they come in 3 days a week. Patients say their treatment can reflect this factory mentality. They are literally herding you in like cattle, says Dallas area patient Nicole Jefferson, who endured dialysis before her transplant. You walk in, you weigh yourself, you wash your hands, you sit down. They get to you when they get to you to stick you. David White, whose advocacy has taken him behind the scenes at dialysis centers, says the patient census is often the top priority for facility personnel in the staff meetings he's attended as a patient representative. The very first topic they always discuss is the census, he said. I can't explain how it makes me feel to think that we're just numbers. But that was always the first topic of discussion at every meeting, whether they had more or fewer patients. Putting someone on home-based dialysis, such as peritoneal dialysis, potentially means less money for providers, which might be one reason it seems discouraged as an option. One study finds that hemodialysis, for example in-clinic dialysis, costs an annual average of $108,656 in 2017, versus $91,716 for patients on peritoneal dialysis. Setting patients up for home dialysis also requires more staff with different skills, including the ability to train patients to perform this procedure themselves. That, in turn, requires a different attitude toward patients, says Neil Chegedny, who launched the advocacy organization Home Dialysers United after her PTSD moment at the center. People say about in-center that the patients are fungible. You plug one person in, they're there, you unplug them, they go home, and you replace them, she said. Home dialysis requires a lot more one-on-one engagement. As a result, the patients most likely to get treatment at home are the ones who have the wherewithal to demand it. Kidney patient Patrick G., who is Black, says he believes many minority patients must fight stereotypes to access home-based modes of treatment. My dialysis nephrologist told me, you can do it peritoneal, because you have a PhD and you're smart enough to be in compliance, G recalls. And I'm listening to that and hearing the microaggression. Just 9.6% of kidney failure patients used in-home dialysis or peritoneal dialysis in 2020. These patients were more likely to be white. The wrong kind of innovation. To its credit, the federal government has launched some recent initiatives to reform the treatment of kidney disease and improve patients' lives. In 2019, HHS Secretary Alex Azar announced pilot modifications to Medicare's payment structure intended to encourage home-based dialysis and transplants for kidney failure patients. The current Medicare payment system encourages in-center hemodialysis as the default treatment for patients beginning dialysis. The Centers for Medicare and Medicaid Services, or CMS, acknowledged in its press release about the effort. In early 2023, CMS announced an expansion of its Kidney Care Choices pilot, designed to encourage comprehensive, coordinated care for patients with advanced kidney disease so they can delay dialysis or avoid it altogether through better management of their condition or through transplant. According to CMS, this effort could reach as many as 250,000 Americans with advanced kidney disease or kidney failure. It may take years, however, for these models to become the standard of care, assuming the hoped-for benefits materialize. In the meantime, the current fee-for-treatment structure gives dialysis companies little incentive to invest in innovation of their own. They have a cash cow, and there's no need to do any innovation, says Murray Sheldon, Associate Director for Technology and Innovation at the Center for Devices and Radiological Health at the U.S. Food and Drug Administration, or FDA, told Nature. As a result, the process of dialysis has changed little over the last 40 years. In fact, modern dialysis still rests on two 20th century breakthroughs. The first from 1944, when Dutch physician Willem Kolff invented the first artificial kidney in Nazi-occupied Holland, using, among other things, sausage casings, orange juice cans, and a washing machine. After the war, according to a history by Richard Rettig for the Institute of Medicine, Kolff sent 4 of his by then refined machines to the United States, where they were successfully used to treat soldiers suffering from kidney failure during the Korean War. The second breakthrough came in 1960, when Belding Scribner and Wayne Quinton, working at the University of Washington in Seattle, invented the Scribner shunt, a U-shaped Teflon tube inserted into a patient's arm that made it possible to connect a patient to a machine as often as necessary. Before then, the damage done to a patient's veins with each treatment made it literally impossible to administer more than a few sessions before it was no longer safe. Today's patients typically get a fistula, a procedure that connects an artery to a vein to create an access point for the machine. In 2018, the American Society of Nephrologists and HHS announced Kidney X, a kidney innovation accelerator that would award prizes for technological innovations in the development of an artificial kidney. Congress appropriated $5 million for the effort in 2019. And in 2021, Kidney X announced the first 6 winners of its artificial kidney prize, none of which were affiliated with the 2 big dialysis companies. In its 2021 annual report, Fresenius reported spending 818 million euros in research and development across its portfolio of companies. The only dialysis-related innovation it mentioned was the unveiling of the FX Coral Dialyzer, which uses new and improved materials for filtering patients' blood to reduce the side effects of dialysis. The industry needs us sick, argues patient advocate Gedney. We're absolutely no benefit to them if we're healthy. There's no motivation to get a patient well, and there's no motivation in dialysis to do it better, because they're making a ton of money doing it poorly. So why should they have to change? Where the industry has innovated, however, is in its development of new business models to maximize profits. After years of acquisitions during which bigger dialysis companies swallowed up smaller ones, essentially leaving no one left to buy, companies have been entering joint ventures with kidney doctors who are offered ownership stakes in new clinics that are typically built with borrowed funds. Although the so-called federal Stark Law generally forbids doctors from referring patients to clinics and laboratories that they own, self-referrals, dialysis is largely exempt from this prohibition. This means nephrologists are free to refer as many patients as possible to the clinics they own, and they have every reason to do so. A chair that is not used in a facility is not much use, explains Mark Neumann, editor-in-chief of Nephrology News and Issues. You want to keep your shifts filled, and you want to keep your chairs filled. It's no different from any other business. One company that worked exclusively through this model was American Renal Associates, which went public with a $100 million IPO in 2015 before its recent acquisition by private equity. According to its 2019 annual report, its last public filing, the company operated 246 dialysis centers in partnership with approximately 400 nephrologist partners. In its 2021 annual report, DaVita reported that 28% of its revenues came from joint ventures with nephrologists, hospitals, management services organizations, and or other healthcare providers. DaVita acknowledges that some of these arrangements might be stretching the limits of the law, as it disclosed in its 2022 annual report. Our joint venture arrangements do not satisfy all of the elements of any safe harbor under the federal anti-kickback statute, however, and therefore are susceptible to government scrutiny. If our joint ventures are found to violate applicable laws or regulations, we could suffer severe consequences that would have a material adverse effect on our business, results of operations, financial condition, and cash flows, and could materially harm our reputation. The company did not mention that it has in fact already come under government scrutiny for past partnerships. In 2014, the Justice Department announced that DaVita had agreed to pay $350 million to resolve allegations of illegal kickbacks to induce the referral of patients to its dialysis clinics. According to the government, DaVita identified and targeted physician practices with significant patient populations suffering renal disease and offered them lucrative opportunities to partner with DaVita. To make the transaction financially attractive to potential physician partners, DaVita would manipulate the financial models used to value the transaction, the government further alleged, and lock in physicians with non-compete agreements or as medical directors of the joint venture clinics. The most serious consequence of these schemes, however, is the impact on patients, whose well-being might be in the hands of a physician with a financial stake in their remaining on dialysis. Some patients may not be referred by their nephrologist for a kidney transplant, which is beyond a doubt the best treatment for kidney failure. A successful transplant gives you almost a normal life expectancy, particularly if you've never been on dialysis, said GW transplant surgeon Joseph Melanson. According to the latest available data, between 82% and 91% of transplant recipients survive 5 years after transplant, compared to just 40% for patients on traditional hemodialysis. Yet Howard University surgeon Clive Callender said some of his patients, who are primarily black, were told by their nephrologists they'd be eligible for transplant later, after spending time on dialysis. They were told, "We'll dialyze you for a year or two, and then after that, we'll put you on a transplant list," he said. Of course, the longer you're on dialysis, the poorer your outcome is, the more likely you are to reject your transplant, and the more likely you are to die. Anecdotally, nephrologists and surgeons potentially even compete for the best patients. That's because the patients most likely to last the longest on dialysis, those who are younger and healthier, are also the best transplant candidates. I think there really is a financial incentive for a dialysis nephrologist, especially if they're an easy patient, a low-maintenance patient, to keep them on dialysis, as opposed to referring them to transplant, said Joanne Bargman, a nephrologist and professor of medicine at the University of Toronto. Transplant surgeon Melanson is more blunt. "I'm not saying it's typical, but I've definitely heard it said, 'Wow, you took my best patients and gave them a transplant when they were doing so well on dialysis,' which is exactly the opposite of what you want." Research backs up Melanson's experience. A 2014 study found that patients of for-profit chain dialysis clinics were 13% less likely to be put on the wait list for a transplant than patients at non-profit centers, of which few now remain. For-profit ownership of dialysis chain facilities appears to be a significant impediment to access to renal transplants, the researchers concluded. Among the patients never told about transplants when he started dialysis was Patrick G. G finally received a transplant, but feels he's lost valuable time. "When I was told that my kidneys were failing, I should have been told right then and there I could have had a transplant instead of dialysis," G said. "I think my chances of finding a living donor would have been better if I'd known. I could have had a transplant in 2013. Over the past 2 decades, the Federal Trade Commission, FTC, has sought to slow the pace of consolidation in the dialysis industry and preserve competition. Unfortunately, it's had limited success. Fresenius and DaVita together now control about 75% of the nation's clinics. In 2005, for instance, the FTC filed suit against DaVita for its planned $3.1 billion purchase of Gambro Healthcare, Inc., then the country's third-largest provider of dialysis services, with 565 clinics. The FTC characterized the merger as anti-competitive and likely to result in monopolies for outpatient dialysis clinic provision. The merger proceeded, after DaVita agreed to sell 69 clinics in 35 states to another competitor, Renal Advantage, Inc. In 2010, however, Renal Advantage was bought by Fresenius. More recently, the federal government tried a more ambitious approach to the industry's anti-competitive practices, but again fell short. In July 2021, a federal grand jury indicted DaVita and then CEO Ken Thiry on criminal antitrust charges for allegedly conspiring with 3 of its competitors, all led by former DaVita executives, not to poach each other's employees. In 2022, however, both DaVita and Thiry were acquitted of all charges. In the meantime, as DaVita and Fresenius have continued to gain market power, they've been accused of increasingly brazen behavior to maximize revenues and maintain their market dominance, as well as the regulatory status quo. In 2016, Fresenius agreed to pay $250 million to settle thousands of lawsuits on behalf of patients whose deaths were potentially connected to one of the company's dialysis medications. The drug in question, Granuflo, was supposed to help maintain the right pH in a patient's blood, but excess acetate in the product allegedly led to sudden cardiac arrests. According to the New York Times, Fresenius purportedly knew of the drug's risks and sent a warning memo to its own dialysis centers, but failed to alert other dialysis centers using the product of the potential hazard. The FDA later recalled Granuflo as unsafe. In 2022, the Service Employees International Union, United Healthcare Workers West, SEIU-UHW, the National Health Law Program, and 5 dialysis patients filed a complaint with the HHS Office for Civil Rights, alleging that DaVita and Fresenius dialysis clinics discriminated against Asian and Latino patients by disproportionately subjecting them to treatments at dangerously high speeds. Presumably, faster dialysis means more turnover in a chair and more revenue for the clinic. Patients suffered low blood pressure, dizziness, headaches, and cramping because of high-speed dialysis, while others died, according to the complaint. The SEIU's analysis of facility-level data provided to the government found that the clinics with the highest proportion of high-speed treatments were disproportionately located in areas with large Asian and Latino populations. These clinics also experienced more deaths than expected, as well as higher rates of hospitalization and ER visits. In 2015, DaVita agreed to pay the federal government $450 million in settlement of claims that the company had intentionally and unnecessarily wasted dialysis medications, and then billed Medicare for the waste. According to a whistleblower, DaVita would require employees to maximize their use of 2 different types of dialysis drugs with each treatment so that a clinic could bill for the excess amounts. For example, the government alleged, the company's protocols required the administration of one drug in small amounts at frequent intervals so that nurses would be forced to open numerous single-use vials. Nurses would use only a portion of the vial and throw away the rest, but the clinic would bill for the entire vial. In 2017, DaVita's pharmaceutical subsidiary, DaVita Rx, agreed to pay $63.7 million to settle claims it had billed the government for drugs that were never shipped or were shipped and returned. The government also alleged that the company had offered financial inducements to Medicare beneficiaries in violation of the federal anti-kickback laws, such as by offering discounts to patients who paid by credit card. In 2018, DaVita Rx was acquired by Walgreens. In 2020, DaVita settled a class action lawsuit brought against its shareholders, who alleged the company had illegally inflated its revenues by steering kidney failure patients away from Medicare and Medicaid and toward high-cost commercial insurance. According to the complaint, filed in 2017, the rates DaVita charged commercial plans for dialysis were up to 10 times or more what it received from Medicare, as much as $4,000 per treatment versus $300, which is why it wanted to increase the share of private pay patients it served. Clinic staff were allegedly directed to pressure the company's ESRD patients to forego their Medicare and or Medicaid benefits in favor of enrolling in commercial plans, even if they could not afford the premiums. The company also purportedly helped patients pay for their insurance through an affiliated charity, the American Kidney Fund, or AKF, primarily funded by the dialysis industry. This financial aid lasted only so long as a person remained on dialysis, however, which meant that if an ESRD patient obtains a life-saving kidney transplant, the AKF's premium assistance for that patient immediately ceases. Had a patient stayed on Medicare, their transplant would have been fully covered. According to a separate suit filed by a federal whistleblower in 2019, the fund allegedly steered financial aid primarily to patients of DaVita and Fresenius, while denying aid to patients of other clinics that weren't fund donors. From 2017 to 2020, the dialysis industry reportedly spent more than $233 million to defeat two union-backed initiatives in California that would have put tighter regulations on the industry. According to Kaiser Health News, DaVita was responsible for about $143 million of this spending, while Fresenius accounted for most of the rest. Also, according to Kaiser, the company spent about $111 million in 2018 to defeat Proposition 8, a union-backed effort to cap industry profits. In 2020, the industry spent $105 million to stop Proposition 23, another SEIU-backed initiative, which would have instituted patient safety protocols, such as on-site physicians at every clinic. The companies have also defeated proposed legislation to set staff ratios at dialysis clinics to prevent understaffing. The industry also tried to stop AB 290, which forbids the steering of patients into commercial plans, as just described, and limits commercial insurance reimbursement for dialysis to Medicare rates. Governor Gavin Newsom signed AB 290 in 2019, promptly triggering a lawsuit from the industry. In 2022, patient advocates put forward Proposition 29, a ballot measure that would have instituted many of the same patient safety rules as AB 290. The proposal was defeated after the industry spent $89 million on campaigns opposing the measure, according to the Los Angeles Times. DaVita and Fresenius have also spent plenty to maintain a presence in Washington, D.C. In 2022, according to OpenSecrets.org, DaVita ponied up $1.9 million in campaign contributions and more than $3 million on lobbying, while Fresenius spent about $1 million on campaign contributions and $5.6 million on lobbying. Both companies give to both Republicans and Democrats. Fresenius and DaVita have spent about $130 million on lobbying since 1998 and about $13 million on campaign donations since 1990. As Duke University economics professor Ryan McDevitt told Kaiser Health News, it's very natural for these private chains to spend millions to make billions of profits. The steady profits enjoyed by the dialysis industry are also very likely to continue. The Centers for Disease Control, or CDC, predicts that the share of Americans with chronic kidney disease will grow to 16.7% of all adults over 30 by 2030, up from 13.2% in 2010. Minority and low-income Americans will moreover bear a disproportionate share of the burden of this disease, given higher rates of diabetes and high blood pressure among these populations, the result of systemic disparities in access to quality care, nutrition, and other determinants of health. Shortcomings in federal policy have not only calcified these disparities, but also facilitated a rapacious industry that counts on these systemic failures to thrive. 5. Crime pays. The business of criminal justice. America's most famous bail bondsman might be Dog the Bounty Hunter, aka Dwayne Chapman, the star of an eponymous reality show that aired for 8 seasons on A&E. Before his self-inflicted implosion over a series of controversies, including multiple public revelations of racist and homophobic remarks, Chapman cut a colorful figure as the patriarch of the family-run bail business he ran with his wife and son, Dakine Bail Bonds in Honolulu, Hawaii. With his bleached blonde mullet, heavy tattoos, and trademark leather vest, he dished out tough love to the defendants he tracked down on his show, while also portraying himself as an untiring crusader against crime. Beware of the dog, warns his website, where you can also buy a bag of his signature coffee, Grounds for Arrest Bounty Brew, for $19.99. Chapman's commercial success is as outsized as his on-air persona, but he's not unusual in finding a way to profit handsomely from the criminal justice system. Every year, according to FBI statistics, law enforcement arrests more than 10 million people, essentially creating and maintaining a massive market of potential clients for criminal justice profiteers, who will wait at every step of the process. That's because many state and local governments have outsourced huge swaths of their justice systems to private contractors, while at the same time shifting the costs of running the system onto defendants. Pre-trial supervision, for instance, is often in the hands of commercial bail bondsmen or private home detention companies, who charge for ankle monitors and other services. Private prisons housed 96,370 inmates in 2020, according to the Sentencing Project. Contractors, moreover, perform many of the functions inside government-run jails and prisons, such as providing meals and medical care. Inmates pay exorbitant fees for phone calls, commissary accounts, and access to email, also typically provided by private contractors. Sometimes, these contractors pay commissions to corrections authorities for access to inmates, and the return to society is often accompanied by significant debts, including those accrued during incarceration. Among the cruelest injustices perpetuated by the criminal justice system is that there's no release from companies' pursuit of profit. Pre-trial profits, the bane of cash bail. The notoriety of shows like Dog the Bounty Hunter has glamorized the bail bonds industry and popularized misconceptions about its role in the justice system. Dog himself has also used his celebrity to protect his industry's standing. In recent years, Dwayne Chapman, or Dog, has become an outspoken opponent of bail reform, with appearances around the country and on Fox News. As a growing number of states have moved to limit cash bail or even abolish it altogether, especially for minor offenses, Chapman has argued that these reforms are coddling criminals. "We tried it your way and people are dying," he claimed on Fox News Primetime in 2021. With the help of larger-than-life personalities like Chapman, the commercial bail industry has cultivated the perception of offering a public service that keeps dangerous criminals off the streets. The commercial bail system in this country is the best form of ensuring criminal defendants are returned to court and ensuring the victims of crime their rights to justice, argues the trade association Professional Bail Agents of the United States, or PBUS, on its site. It's a system paid for by the perpetuators of crime, not by the tax-paying victim. The PBUS conveniently forgets that anyone out on bail is in fact awaiting trial and therefore considered innocent. In truth, the commercial bail business is a lot more like loan sharking than law enforcement, and it's been profitable enough to attract the involvement of some of the world's largest financial services firms. Its clients are low-income Americans who cannot afford the often exorbitant cash bails imposed by courts in many jurisdictions, but who also can't risk the consequences of jail. Spending more than even one day in jail can have devastating consequences, finds Harvard University researcher Sandra Smith. The more time someone spends in detention, the more likely they are to lose their jobs and housing, to take a plea that will permanently scar their prospects, or to become re-involved in the system. The commercial bail industry preys on this vulnerability for its profits and mires low-income Americans in debt, including the innocent. One such innocent caught up in the commercial bail industry's debt machine was Baltimore resident Rafiq S., whom I met in 2016 through the Baltimore City Public Defender's Office. Rafiq had been in the wrong place at the wrong time, walking past a row house in his neighborhood that the police were about to raid. Mistaking him for someone else, they arrested him and confiscated the keys to his mother's car, parked nearby. At his trial in 2016, police claimed that he consented to a search of his car. He didn't. They also claimed they smelled marijuana in the vehicle. There wasn't any. And they also claimed they found a gun in the glove compartment, a discovery that stunned Rafiq, who said he'd never owned a gun in his life and didn't have the key to the glove compartment in the first place. He was charged with illegal possession of a handgun and possession of a handgun in a vehicle on a public road, punishable by up to 3 years in prison. But because the police had no actual evidence against him, such as fingerprints on the weapon they allegedly found, a jury acquitted him on all counts after less than half an hour of deliberation. Nevertheless, Rafiq was still on the hook to his bail bondsman for $10,000, the non-refundable premium that his family agreed to pay to get him out of jail 2 days after his arrest. Because bail arrangements are private contracts, unrelated to court outcomes, the bondsman still collects his fee, regardless of what happens in court, guilty, innocent, or even if the charges are dropped, as is often the case. The Maryland Office of the Public Defender found that over one 5-year period, more than $75 million in bail bond premiums were charged in cases that were resolved without any finding of wrongdoing. This was more than double the amount of premiums paid by defendants who were, in fact, ultimately convicted. It's crazy, as Rafiq said. In Rafiq's case, his initial bail was set at $100,000, and his bondsman set the premium at 10%, $10,000. Rafiq and his family paid the bondsman about $2,000 up front, with a promise to pay $100 a week until the amount was paid in full. At the time we met, he was earning $10.15 an hour installing trailer hitches for U-Haul. "I'll be paying for a long time," he said, "like forever." Low risks, high rewards for bail bondsmen. Commercial bail bonds work differently from bonds posted directly with the court. Defendants who can afford to make bail on their own will get their money back when they show up for their court date. That's the stated purpose of the bond, to ensure a defendant's appearance. Commercial bondsmen, on the other hand, charge a premium to post a bond with the court on a defendant's behalf. The bondsman gets his money back from the court when the defendant appears, but the premium collected from the client is non-refundable. It's essentially a loan for making bail, and the premium is the interest. Do you get the bail money back if found innocent or not guilty? Asks the FAQ for Arrow Bail Bonds in Richmond, Virginia. Say it with me here. No, writes owner Don Bartow. The premium is never returned. Whether the defendant is innocent or guilty doesn't matter. Bail bond premium is a no. Bail bondsmen argue that the fees they charge are premiums because what they provide is insurance. Bail is similar to homeowners or auto insurance, says Jeff Kirkpatrick, a bail bondsman in Jackson, Michigan, who was executive vice president of PBUS when we spoke, around the same time I met Rafiq. Say you went to jail for shoplifting or larceny, and the judge set your bail at $10,000, Kirkpatrick says. In most states, you would pay 10% to 15% of that bond amount as a premium. In return, the bond agent is guaranteeing the court that should you fail to appear and the bail agent failed to produce you, they would pay the court that $10,000. In truth, the premiums paid by defendants cover the fees that bail agents themselves must pay to large insurance companies to guarantee payment on a bail bond. If somebody jumps bail, a bondsman can call on his insurer rather than put up the cash himself or deed over his house. Bondsmen are essentially brokers for these bigger firms. As of this writing, the largest financial services firm underwriting U.S. bail bonds is Fairfax Financial Holdings Limited, a Canadian conglomerate with multiple subsidiaries that insures bail bonds as part of its business. The profit a bondsman makes is the difference between the premiums charged to a defendant and the premiums the bondsman pays his insurer. That gives bondsmen an incentive to ensure their clients show up in court. Forfeiting a bond would have the same effect on their insurance as totaling a car. Kirkpatrick, who's been in the bail bonds business for more than 30 years, said he started out as a night shift bondsman. "I'd cover the bonds that got written in the middle of the night," he told me, before he progressed to owning his own agency. He had been PBUS's Bail Agent of the Year, according to his bio, and was inducted into the organization's Hall of Fame in 2009. He even had his 15 minutes of fame in 2013 as a guest on Dwayne Chapman's spin-off show, Dog and Beth, On the Hunt, when the Chapmans came to his town in search of fugitive Ricky Wheeldon, later convicted of racketeering, drug, and firearms charges. Despite the drama portrayed on Chapman's shows, Kirkpatrick says most of his job is administrative work, aimed at ensuring his clients show up in court, making sure they know when their court date is, calling them, and reminding them. He argues that this aspect of his business is a public service. The bail agents do all the work they do at no cost to the taxpayer, he told me. It's one of those public-private partnerships that works really well. We've done a very good job of making sure that suspects appear. Bail bonding is, in fact, a relatively low-risk business. One reason insurance companies find it appealing. According to one analysis, insurers' gross profit margin on bail bonds is as high as 83%, compared to 33% for home and auto insurance. In addition to extortionately high premium rates, bail bonds contracts can be heavily skewed in favor of the bondsman, with exceedingly onerous conditions imposed on bailees to ensure they don't skip. Bail bond insurer Lexington National Insurance Corporation, for instance, offers a helpful library of standard contracts on its site for its bondsmen, including state-specific forms, bond approval requests, and other agreements. Bail Standard Form Number 1, the bail bond application and agreement to be signed by bailees, requires that clients provide their bondsmen with access to any and all private or public information and/or records, including credit reports, Social Security records, criminal records, civil records, driving records, tax records, telephone records, medical records, school records, worker compensation records, and employment records. The agreement further provides that clients irrevocably grant the bondsman the right to enter your residence or any other property that you occupy without notice at any time for the purpose of locating, arresting, and returning you to custody. In addition, the client must agree that the bondsman may attach a location tracking device on any vehicle owned or driven by you at any time without notice, and may use location technologies to locate your wireless device at any time. You will not have the option to opt out of location use or tracking during the bail period, the contract further warns. Both this contract and the bail bond premium receipt make clear that the premium owning or paid is fully earned upon the defendant's release from custody, and the fact that the defendant may have been improperly arrested, rearrested, the case dismissed, or the bail reduced shall not obligate the return or forgiveness of any portion of the premium. Bail bondsmen also limit their risks by choosing their clients. They're not obligated to write a bond for anyone who asks, and bondsmen won't do business with someone who has a reputation for missing court dates. Bail bondsman and PBUS executive Jeff Kirkpatrick again analogized this practice to insurance. Just like an insurance company that writes policies for your car or your home, if you're a person who frequently gets arrested for drunk driving, most insurance companies are going to look at you as a bad risk, he said. If you have a history that you fail to appear in court all the time, you'll have a harder time getting your bond posted. Kirkpatrick said that for him, it depends on the crime and the personal history. But it's more times that we bond them out than we don't, he added. This kind of discretion only adds to the leverage that bail bondsmen already have over their bailees. In a 2022 report on the civil rights issues raised by cash bail, the U.S. Commission on Civil Rights expressed its concern that those who work for the private bail industry can refuse to write a bond based on any set of attributes, stereotypes, or belief that a defendant might miss their court appearance. It's really the only place in the criminal justice system where a liberty decision is governed by a profit-making businessman that will or will not take your business, Temple University professor John Goldkamp told the commission for its report. Given the protections bail bondsmen provide themselves, few defendants skip out on bail, which means that few bondsmen and their insurers will be liable for big debts to the court. In fact, PBUS acknowledges as much on a webpage discouraging aspiring recovery agents, industry lingo for bounty hunters, which it says can be one of the worst jobs there is. The reason you cannot make reasonable money being a recovery agent is simple, says the site. Most bail agents do a very good job of making sure their defendants go to court. Instead, the site counsels, recovery agents can make more money if they are also a bail agent, which grows their network of influence and potential clients. Best of luck in the recovery agent area. Protecting the market for bail. Low risks, easy profits, and a steady supply of clientele are just a few of the reasons why the commercial bail industry has lobbied industriously over the last 3 decades to preserve and grow its market. Though market research firm IBISWorld predicts a decline in the industry's future revenues due to falling crime rates and an aging population, older Americans are less inclined to commit crimes. It still estimates annual revenues for the industry. For example, the amount collected in non-refundable premiums of about $2 billion a year. According to the nonprofit Justice Policy Institute, the number of defendants released on bail, as well as the amount of bail required, increased dramatically in the 1990s, coincident with the 1992 launch of the American Bail Coalition, an industry trade association. From 1992 to 2006, the share of felony defendants released on bail doubled from 21% to 42%. While the percentage released on personal recognizance without a cash bond dropped from 41% to 28%. At the same time, the average bail amount spiked dramatically, from $25,400 to $55,500. Bigger bail amounts mean bigger premiums for bail bondsmen. Not content to sit on its laurels, the industry spent at least $3.1 million from 2002 to 2011 trying to influence state policies on bail and pretrial justice, the Justice Policy Institute further reports. The bail industry's big wins in the 1990s were helped along by the conservative American Legislative Exchange Council, or ALEC, which drafted and advocated industry-friendly model legislation, expanding the use of bail and tilting state laws in favor of commercial bondsmen. For instance, ALEC's model Crimes with Bail Restrictions Act called for the mandatory imposition of bail for certain offenses, including murder and sexual assault, and also theft by extortion and resisting arrest. Echoes of this proposal live on today in the many jurisdictions where bail schedules dictate the bail that judges must impose. In Los Angeles County, for instance, the Superior Court's 2022 felony bail schedule mandated a minimum bail of $2 million, or no bail at all, for suspects charged with murder, $50,000 for vehicular manslaughter with gross negligence, $100,000 for mayhem, and $50,000 for second-degree robbery. It also mandated minimum bails of $10,000 for bookmaking, $20,000 for grand theft of dog if value exceeds $950, $50,000 for own or operate a chop shop, $10,000 for cultivating marijuana, and $50,000 for manufacturing concentrated cannabis using volatile solvent without a license. Though California legalized recreational marijuana in 2016, only about 10% to 20% of marijuana sales are technically fully legal. Another old ALEC model bill, the Bail Forfeiture Relief and Remission Act, provides a grace period for the refund of a forfeited bail if a bondsman can track down a bail jumper within a specified period. Florida's bail statute gives bondsmen up to 2 years to track down bailees and contains language identical to the ALEC model legislation. It also allows bondsmen to claim a refund even if it's the police, not they, who pick up a bail jumper, so long as the bondsman had substantially attempted to find the defendant. Virginia, however, might win the prize for the most industry-friendly bail law. Its statute governing bail bonds requires bondsmen to charge a minimum premium equal to at least 10%, though not more than 15% of the amount of the bond. The fight over bail reform. Legislators in many states have nevertheless recognized the destructive impacts of cash bail, especially on those who can't afford to pay. Overstuffed jails and unwarranted detention of innocent people are the collateral damage from the bail industry's efforts to expand the use of cash bail. Greater reliance on cash bail has led to a steep increase in the number of people held in jails pre-trial because they don't have the money to get out. In 2021, according to the U.S. Bureau of Justice Statistics, 71% of jail inmates were people presumed to be innocent and awaiting trial. The share of the jail population that was unconvicted, the government reports, has risen 10 percentage points, from 61% to 71% over the last decade. And as noted earlier, pretrial detention has catastrophic impacts on an individual's prospects. Spending time in pretrial detention raises the risk of future rearrest and future costs for the justice system, according to a 2022 study by Christopher Lowenkamp for Arnold Ventures. People in pretrial detention also get longer jail sentences than those who've been released. These destructive consequences fall disproportionately on Black and Hispanic communities. Although the government hasn't collected racial demographic data on pretrial detainees since 2002, the last available data shows that a whopping 62.6% of pretrial detainees were Black or Hispanic, compared to about 25% of the overall population, according to a 2019 analysis by the Prison Policy Initiative. In 2017, New Jersey replaced cash bail with a risk-based assessment system for determining whether defendants should be detained or released. Under this approach, whether a defendant goes free depends on their actual risk to the community versus their financial ability to make bail. The same year, Maryland's highest court, the Court of Appeals, approved new rules requiring judges to consider whether defendants can afford cash bail when setting pretrial conditions, essentially eliminating cash bail in most circumstances. This change unfortunately came too late for Rafiq. In 2018, California eliminated cash bail with the passage of SB 10, also in favor of a risk-based system. New York followed suit in 2019 with legislation that ended cash bail for most misdemeanors, though leaving violent felonies bail eligible. In 2022, Illinois passed a sweeping criminal justice reform bill that abolished cash bail altogether. The bail industry, however, has fought these reforms ferociously, with the result that many of these victories have been short-lived or put into limbo. In California, for example, the bail industry successfully blocked the implementation of SB 10 by securing a public referendum on the measure in 2020. Voters resoundingly defeated Proposition 25 by a margin of 55% to 44%, effectively repealing SB 10. Legislation requiring bail premiums to be refunded if charges are dismissed or never filed also failed in 2022. New York, meanwhile, partially rolled back its reforms in 2020 to make more offenses bail eligible. The state also made further changes in 2022 to grant judges more discretion to set cash bail. In Illinois, a coalition of prosecutors and sheriff's offices filed suit to block the end of cash bail, prompting courts to halt the implementation of reform until litigation is settled. Unsurprisingly, the American Bail Coalition has helmed the industry opposition to bail reform. Its website is littered with instances of politicians condemning bail reform as a failure, and the organization posts plentiful research purporting to show the effectiveness and cost-effectiveness of the cash bail system. In January 2023, the American Bail Coalition released its pre-trial roadmap, previewing the model policies that the industry would like to see, such as tough new limits on judges' ability to release defendants on personal recognizance, like without cash bail. The coalition's membership page listed 7 bail bond insurers as of 2023, including Bail USA, a subsidiary of Fairfax Financial, Bankers Surety, a subsidiary of Tampa-based Bankers Financial Corporation, the A1A Surety, which calls itself the nation's oldest and largest bail bond insurer. In a 2021 investigation, Reuters calculated that the industry had spent $17 million fighting bail reform, including $7 million to defeat California's Proposition 25. That's likely to be just the first tranche of spending in coming years as the industry fights to preserve its market. The growing market for home detention. At the same time, cash bail's fall from favor in some jurisdictions has boosted the rise of another industry, for-profit home detention. For judges no longer allowed to impose cash bail, but reluctant to release a defendant outright, house arrest with electronic monitoring is an appealing alternative, especially when defendants bear the cost. Before Maryland's courts changed the rules for bail, the streets near Baltimore's detention centers downtown teemed with storefronts for bail bondsmen. The Baltimore Central Booking and Intake Center sits on Eager Street, around the corner from the Baltimore City Correctional Center, the city jail, on Greenmount Avenue. The city jail is a squat red brick facility, but Central Booking resembles a medieval fortress with gray stone turrets and windowless walls. The building was reportedly constructed in the 1800s, when Thomas Jefferson was president. The modern addition of a multi-story fence topped with razor wire adds to its foreboding air. Across the street is a dilapidated sign for Central Booking HQ bail bonds, but the windows around it are boarded up, and the building looks abandoned. Online directories say the place is still open, but bail reform has clearly been bad for business. For ASAP Home Detention of Towson, Maryland, on the other hand, business has been great. ASAP, it stands for Advantage Sentencing Alternative Programs, is one of 3 companies that have essentially cornered the market in Baltimore for at-home detention services, including pretrial detainees. Its chief competitor is Baltimore-based Alert, Inc., while A1 Trusted Monitoring, based in Upper Marlboro, Maryland, is a relative upstart in the area. I honestly can't tell you where they came from, but they've become the powerhouses of Baltimore, says Marianne Lima, an assistant public defender for the city of Baltimore, whose clients are frequently in the custody of these companies. ASAP offers home detention monitoring through ankle bracelets and GPS units made by Scram Systems, a leading manufacturer of electronic monitoring equipment and remote breathalyzers. Scram's most famous user might be actress Lindsay Lohan, who agreed to wear the company's alcohol monitoring bracelet after her 2007 arrest for driving under the influence, DUI. In its company history, Scram acknowledges it became a household name as media throughout the world began covering the use of our technology on high-profile Hollywood celebrities. Alert, on the other hand, uses the OmniLink ankle bracelet to monitor its charges, while A1 relies on the Blue Tag system, manufactured by Houston-based Securus Monitoring. ASAP, Alert, and A1 work directly with defendants, or clients, as the companies prefer to call them, who apply for services and are accepted into their monitoring programs. Among other things, ASAP's participant rules and agreement requires defendants to share all details of their schedules with the company and to promise never to submerge the ankle bracelet in water. A common practice is for defendants to get a pre-approval letter from a home detention company willing to take them on. Defendants then present the letter in court to support their case for home detention before trial, rather than going to jail, assuming there's no bail. This happened multiple times at a bail review hearing I attended in Baltimore City District Court in the summer of 2022. Typically, within 24 hours of their arrest, unless it's a weekend, defendants in Baltimore appear before a judge to determine the conditions of their release while charges are pending. For each defendant, an investigator for the state's Division of Pretrial and Detention Services will offer their recommendations for detention or release, depending on the severity of the alleged offense, prior criminal history, and flight risk. Investigators typically describe whether a person is employed, has a stable home address, or has family in the area. They also summarize the circumstances of the arrest and the charges filed. The judge then hears from both the prosecution and the defense. Defendants' attorneys typically argue for a reduction or elimination in bail. If bail has been imposed, or a release to home detention in lieu of incarceration in the city jail. A pre-approval letter, defense attorneys say, makes it more likely that a judge will approve home detention. Some judges, I was told, also prefer one company over another. Until 2021, low-income defendants in Maryland also had to pay for home detention services, which often led to hundreds and even thousands of dollars in fees accrued while awaiting trial. After Baltimore County eliminated home detention fees in January 2021, the Maryland legislature followed suit, ending fees for indigent defendants, though not for others. Maryland, however, is the exception, not the rule. The Fines and Fees Justice Center reported that 43 states authorized electronic monitoring fees as of 2022, and many states leave it up to companies to decide how much to charge. As a predictable consequence, the market for electronic monitoring is booming. An explosion in e-carceration. Criminal justice advocates and researchers have noted a sharp rise over the last decade in the use of ankle bracelets and other forms of electronic monitoring, both for pretrial defendants and for people at the other end of the process, on probation or parole. In 2015, according to the Pew Research Center, more than 131,000 accused and convicted offenders were under electronic monitoring, up from the 53,000 in 2005. The coronavirus pandemic accelerated the trend, and some advocates estimate that as many as 200,000 people may be subject to electronic incarceration, or e-carceration, at any given time. In Chicago's Cook County, for instance, some 3,500 pretrial defendants were on home detention with ankle monitors in December 2021, compared to 2,500 the preceding April. From a public health perspective, house arrest with electronic monitoring is arguably safer than a crowded jail, especially during a pandemic. Jails and prisons were responsible for a majority of the largest single-site outbreaks since the beginning of the pandemic, according to the COVID Prison Project at the University of North Carolina, Chapel Hill. As of February 2023, more than 643,000 inmates have suffered an infection while incarcerated. Nearly 3,000 have died. But ensuring prisoner safety isn't what's motivating jurisdictions to opt for electronic monitoring. Rather, it's about saving money. In Pitt County, North Carolina, for instance, authorities touted $1.2 million in annual savings from switching to electronic monitoring of pretrial defendants, prompting a similar switch in nearby Carteret County. Announcing the shift in 2009, the Carteret County Sheriff's Office told local news outlets that housing inmates cost the county $45 a day versus $9 a day for electronic monitoring, which defendants would pay. The system comes at no cost to the taxpayer. Then Sheriff Asa Buck told the Carteret County News-Times. Home detention company Alert, Inc., which operates in Pennsylvania and West Virginia as well as Maryland, claims on its site that its services save states $25,000 per defendant per year, though it cites no evidence for this assertion. Costs for detainees, on the other hand, can be extortionately high. In a 2021 survey of dozens of jurisdictions, George Washington University law professor Kate Weisberg documented a wide range of daily, weekly, and monthly fees for electronic monitoring, from a low of $1.50 per day in Lancaster County, Nebraska, to a whopping $47 a day in Sacramento County, California, for detainees who are self-employed. Monthly fees were as high as $350.61 in Connecticut, while some jurisdictions charged one-time fees of up to $2,275, Ramsey County, Minnesota. On average, Weisberg calculated, the average cost of spending 1 year under monitoring in the jurisdictions she examined was $3,284.08. Among the most expensive was Fairfax County, Virginia, which charged $7,300 a year at the time of Weisberg's analysis. These fees were, moreover, on top of other charges a defendant might be asked to pay, such as for drug treatment, court costs, or other expenses related to court supervision. In some jurisdictions, these add-on charges include an equipment installation fee of up to $250. Fees are often directly payable to the company, rather than the court. In Maryland, for instance, state law provides that defendants shall pay directly to the private home detention monitoring agency the agency's monitoring fee, unless they're exempt by reason of their indigence. The majority of states impose no explicit limits on what companies can charge, instead allowing the imposition of reasonable fees, whatever that means. In most states, says the Fines and Fees Justice Center, failure to pay leads straight to incarceration. No better than cash bail? While house arrest seems intuitively less harmful to detainees than traditional incarceration at the local jail, electronic monitoring, in fact, raises its own set of concerns. For-profit detention companies are capricious jailers, leading to immense harms and injustices suffered by detainees. Electronic surveillance is not an alternative to incarceration. It's an alternative form of incarceration, as George Washington University's Weisberg writes. For one thing, private detention companies have exceedingly broad discretion to set the conditions of house arrest, as well as the power to decide when a detainee has violated the terms of their detention, which could lead to their imprisonment. Justice system advocates argue that this frequently leads to arbitrary and even abusive outcomes, especially when contracts are vague about what constitutes a violation. Weisbird's study, for instance, found that some monitoring agreements prohibited contact with people of disreputable character or bad reputation, or required detainees to behave in an orderly manner. Minor violations, such as leaving the house to put out the garbage, or literally technical violations, such as a malfunctioning monitor, have sometimes been enough to result in a person's re-incarceration. In Cook County, Illinois, for instance, which runs one of the nation's largest pre-trial e-detention programs, more than 500 people were re-incarcerated for technical rule violations in just the first 6 months of 2021, according to the Chicago Appleseed Center for Fair Courts. Detainees get minimal or no access to employment and education services or other supports that might help them set their lives on a better trajectory. Jurisdictions are aiming to spend as little as possible after all. People on house arrest also can't go to job interviews or to work without court and company permission, and the obvious presence of an ankle monitor is highly stigmatizing for job seekers. Even if a detainee is allowed to go to work, they could be subject to random checks at their job site or required to ask permission from the monitoring company for any changes in their work schedule. In contrast, a person out on bail at least has the freedom to go to work or to look for a job without these kinds of constraints. In Baltimore, says Assistant Public Defender Marianne Lima, judges often impose 24/7 lockdown with no exceptions, except to see their lawyers. Our clients really suffer because they've had jobs for years, and then they're stuck there not able to go to work or assist with the family, like transporting the kids to school, things they would do on a normal basis, she said. While they're no longer detained, it's a huge deprivation of liberty that impacts the community. Detainees report significant impacts on their mental health. According to a major joint study on electronic monitoring, Cages Without Bars, by the Shriver Center on Poverty Law, Media Justice, and the Chicago Appleseed Center for Fair Courts. Numerous participants interviewed by the researchers said they felt humiliated and debilitated by the trauma of 24/7 electronic surveillance. I had to pay someone to get me toilet tissue because I couldn't leave the house, one participant told researchers. Cages Without Bars also found significant racial disparities in who is subject to electronic monitoring. In Cook County, Illinois, for instance, 74% of detainees in electronic monitoring are black, compared to 23% of the overall population. Unsurprisingly, research to date finds that electronic monitoring has no beneficial impacts on whether defendants appear in court or avoid rearrest. Instead, the only real benefits of electronic monitoring are accruing to state corrections budgets and to the profit margins of monitoring companies and equipment manufacturers. As in other industries profiled throughout this book, a relatively small group of companies have a lock on the market for electronic monitoring. According to Cages Without Bars, the largest of these firms is BI Incorporated, a subsidiary of private prison powerhouse Geo Group. More on Geo in the next section, followed by Satellite Tracking of People, or STOP, Sentinel Offender Services, and Attenti, formerly a subsidiary of Post-it maker 3M. These four companies together earned an estimated $700 million in revenue in 2018. In 2023, researchers estimate the market for electronic marketing is projected to grow to at least $1.2 billion, although the true size of the market is difficult to gauge, given the multiplicity of federal, state, and local jurisdictions entering contracts with monitoring companies and the opacity of the players in this space. Except for Geo Group, the vast majority of companies involved in electronic monitoring are privately held. Attenti, for instance, is now owned by the private equity firm Apex Partners, which acquired the company in 2017. Sentinel, likewise, is owned by Bison Capital Management LLC, a New York-based private equity firm that holds more than $1 billion in investments. In 2022, Sentinel bought equipment maker OmniLink, formerly a subsidiary of Canada-based Sierra Wireless, for $37.6 million, which means OmniLink is now in the hands of Bison Capital as well. According to the press release announcing the acquisition, OmniLink's 2021 revenues totaled approximately $13.1 million. Similarly, STOP is a subsidiary of Securus Technologies. Affiliate Securus Monitoring Solutions is the maker of the Blue Tag system, which is itself a subsidiary of the privately held Aventive Technologies. Aventive's other subsidiaries include JPay, the biggest company in the country providing money transfer, email, and other prison services. More on this too in the next section. George Washington University's Weisbord, who was able to obtain 76 contracts between electronic monitoring companies and state or local corrections agencies, documented numerous instances of multi-year, multi-million-dollar contracts. Cook County, Illinois, for instance, agreed to pay the track group up to $4.1 million over 3 years, while the state of Texas entered a 2-year contract with 3M, now Attenti, for $7.4 million. Many contracts, she noted in her study, required agencies to pay as they go. In other words, the more devices and services they use, the more they pay, she wrote, thereby creating an incentive for firms to encourage electronic monitoring as much as possible. The persistence of commercial bail and the rise of the electronic monitoring industry shows just how tough it will be to disentangle private actors from the criminal justice system. Both phenomena also illustrate the limitless capacity of profiteers to exploit low-income Americans and the difficulty of reforming a broken system. Nowhere is this more true than in Maryland. While bail reform effectively wiped out the bail bonding business, it facilitated the ascendance of for-profit home detention, which itself has destructive impacts on pretrial defendants. Worse yet, many judges are not releasing defendants from detention at all. In Prince George's County, for instance, the share of defendants held on cash bail declined by 11% after reform, but the share held with no bond at all rose by 14.5%, according to a 2018 report by the Color of Change and Progressive Maryland. During the bail review hearing in Baltimore I attended in 2022, none of the half-dozen defendants whose cases I saw reviewed were released, either on bail or into home detention, including the defendants with pre-approvals from detention companies. One of these defendants was a man arrested for driving under the influence. He was denied bail, even though his attorney argued that continued detention would make it impossible for him to get the substance abuse treatment he needed, let alone keep his job. Public Defender Lima said keeping defendants detained before trial has become the default position for many judges. It's a particular disappointment for Lima, for whom bail reform was among the first projects she tackled when she joined the Office of the Public Defender as a young attorney. Yeah, what we thought was a win to overhaul the bail system kind of blew up in our faces, she said. Prison, a captive market. Prison is pricey. America spends about $84 billion a year on jails and prisons, or a little more than the entire annual economic output of the state of Delaware in 2021 dollars. It's expensive for states and localities, where corrections departments often swallow up big chunks of the budget. In 2017, local governments spent more than $25 billion on jails, according to the Pew Research Center, at an average annual cost of $34,000 per occupied cell. In some states, correction spending equals or even exceeds state spending on other priorities, like higher education. In Delaware, for example, state and local funding for higher education in fiscal 2021 totaled $307 million, compared to a budget of $355 million that year for the Department of Correction. The same year, Oregon allotted $2.2 billion to public safety versus $2.6 billion to post-secondary education. In many states, much of that money flows straight into the coffers of private companies that run vast swaths of the nation's corrections systems. Enticed as always by the false nature of lower costs and better performance, federal, state, and local governments have allowed the wholesale for-profit takeover of almost every aspect of the corrections system, from prison to parole. The result in many instances is a system less concerned about the proper administration of justice than about maximizing profits from prisoners. The private detention industry, prisons and beyond. As with so many other industries profiled in this book, a handful of firms dominate the private detention market. The two biggest are CoreCivic, formerly the Corrections Corporation of America, or CCA, and the GEO Group, formerly Wackenhut. Smaller players include the Management and Training Corporation, the same company that holds the monopoly on Job Corps, described in Chapter 3, and LaSalle Corrections, whose facilities are focused in Louisiana, Texas, and Georgia. From the start, the industry has moved aggressively and creatively, including through the strategic use of public policy, to grow, preserve, and diversify their business. Prisons are, in fact, just a single facet of the modern corrections market. The idea of prison privatization isn't new. America's first private prisons opened at least a century earlier. As early as the mid-1800s, economizing state legislatures awarded contracts to private entrepreneurs to operate and manage Louisiana's first state prison, New York's Auburn and Sing Sing penitentiaries, and others, writes prison privatization expert Byron Eugene Price in his book Merchandising Prisoners. Scandals and abuses led to the industry's near demise through the 1950s, before expanding prison populations, pressures from courts to quickly add prison space, and increases in prison costs sparked a revival in the 1980s, Price writes. Between 1985 and 2005, the number of Americans behind bars grew to a stunning 1.6 million, in part because of rising crime rates, but also because of the war on drugs, harsher sentences, and other policies encouraging mass incarceration. While states struggled with the influx of inmates, prison entrepreneurs saw a golden opportunity to relaunch an industry. Leading the way was Nashville-based Corrections Corporation of America, or CCA, now Core Civic, founded in 1983 by Republican Party activist Thomas Beasley and financed by venture capitalist Jack Massey. Massey had already made his fortune, building both Kentucky Fried Chicken. He bought the chain from founder Colonel Harlan Sanders for $2 million in 1964, and the Hospital Corporation of America, now the largest hospital chain in America. When a court ordered Tennessee to fix its overcrowded prisons by the end of 1985, CCA boldly offered to spend $250 million, including $150 million to build 2 new prisons, in exchange for exclusive rights to run the state system for 99 years. The company lost its bid, but brazen tactics like these would characterize the prison industry's rapid rise in the 1980s and 1990s. CCA ultimately won multiple contracts to run private prisons in Tennessee. Private facilities housed more than 1/3 of the state's inmates in 2021. Speculative prisons and pro-incarceration legislation. Perhaps the most outrageously aggressive scheme private prison companies used to facilitate their rise was so-called speculative prisons. Facilities that companies built without governmental participation and then tried to foist on states. Private providers or entrepreneurs looked at a state's fiscal problems, crime rate, and overcrowding problems, and determined that the state could use another prison, Price writes in Merchandising Prisoners. These companies targeted rural communities with high unemployment figures and convinced them private prisons were a great economic development tool to revitalize their community. The ploy often worked, according to Price. Many such speculative prisons led to multi-year sole source contracts because they were move-in ready and offered a quick fix to overwhelmed state corrections departments. This strategy was particularly successful in places like Texas, where the economy at the time was struggling. Rural counties under pressure to find jobs and sources of revenue lobbied desperately to have prisons sited in their jurisdictions. As time went on, communities became bolder and bolder, offering incentives like country club memberships for wardens and longhorn cattle to be raised on prison grounds, according to one account of Texas's prison privatization. There was an almost frenzied climate in these rural, impoverished areas to compete for prison beds regardless of the speculative nature of some of the prison construction. For-profit companies gladly jumped into the fray. They increased their lobbying efforts to persuade the Texas legislature and local counties that prison privatization would allow jurisdictions to build prisons faster, build them cheaper, and build them with private financing, operate them at a lower cost, and increase the level of services. write Gerald Gaze and colleagues in their book Measuring Prison Performance. Today, Texas still has one of the largest private prison populations in the United States, according to the Sentencing Project. As a result of this orgy of prison building, not just in Texas, but nationwide, the number of private prisoners surged 83% between 1999 and 2015. As of 2021, private prisons held 96,370 people, or about 8% of all inmates. And even as criminal justice reforms have reduced the overall number of individuals incarcerated, the share of private prisoners is still growing. Since 2000, says the Sentencing Project, the number of people housed in private prisons has grown about 10%. In addition to lobbying for more prisons, the industry has also pushed for laws to increase the supply of prisoners. As with the commercial bail industry and its efforts to tilt state laws in its favor, the conservative advocacy group ALEC was a key early ally. For instance, the organization advocated truth in sentencing laws, which required inmates to serve at least 85% of their sentence without possibility of early release, and 3 strikes laws mandating harsher sentences for repeat offenders. During the 1980s and 1990s, more than 25 states passed truth in sentencing laws, while 3 strikes legislation passed in at least 11 states. Diversification and expansion. The private prison industry today is nevertheless smaller than it used to be, the result of sentencing reforms and falling crime rates, but also because of the COVID pandemic, which encouraged states and localities to accelerate decarceration. But the industry is far from dead. Even before COVID, companies were taking steps to protect their revenue. Many contracts, for instance, include lockup quotas that require states to guarantee a minimum level of payment, even if beds are empty. In a 2013 study of 62 prison contracts obtained by the nonprofit group In the Public Interest, ITPI, nearly 2/3 included occupancy guarantees or required payments, what ITPI called a low crime tax. One contract to run Ohio's Lake Erie Correctional Institute involved a 20-year term and a 90% quota, while 3 prisons in Arizona were under 100% occupancy guarantees. These provisions guarantee prison companies a consistent and regular revenue stream, insulating them from ordinary business risks, said ITPI in its analysis. The financial risks are borne by the public, while the private corporations are guaranteed profits from taxpayer dollars. Core Civic and the GEO Group have also diversified their businesses to include electronic monitoring, private probation, and parole, so-called community corrections. They also run halfway houses and rehab centers. Core Civic, for example, owns and operates 26 residential reentry centers, with a total capacity of 5,000, according to its 2021 annual report. In 2010, GEO Group purchased Cornell Corrections, which at the time held 16% of for-profit reentry center contracts with the Federal Bureau of Prisons, or BOP. Before the merger, writes researcher Ann Lee, GEO had only 2 such contracts with BOP. After the merger, it had 11. In fiscal 2020, re-entry services brought in 14.4% of the company's revenues, about $309 million. To signal this diversification, both companies have rebranded themselves with new corporate identities and literally scrubbed the word corrections from their names, writes Jamal Zlarty of the Marshall Project. CCA became Core Civic in 2016 when the company started buying up halfway houses and other real estate, according to Larty, while GEO Group is on its way to becoming the nation's largest electronic monitoring company. Larty also points out that the company has changed how it describes the people it monitors, from offenders tracked to individuals under community supervision, in an effort to soften its image. Both companies now also have a booming business, housing immigrant detainees on behalf of Immigration and Customs Enforcement, or ICE, despite an executive order by President Joe Biden in 2021 to phase out the use of private prisons in the federal government. Biden's order exempted ICE detention facilities, a move that many advocates condemned as a violation of Biden's campaign promise to end the use of private prisons. The ICE exemption has in fact become a highly lucrative loophole for prison companies to exploit, especially after President Donald Trump's zero-tolerance policies on immigration resulted in an explosion of detainees. As of 2021, private prisons held nearly 80% of immigrant detainees, making the federal government one of the industry's biggest current customers. In fiscal 2021, for instance, CoreCivic earned 56% of its revenues in fiscal 2021 from federal agencies, according to its annual report, including $552 million from its contracts with ICE. The GEO Group, meanwhile, earned $662 million in revenue from ICE in 2020, or 28% of that year's overall revenue. Detention capacity is growing. In 2022, GEO entered an agreement with Charlton County, Georgia, to nearly quadruple the size of the ICE detention center in Folkestone, from 780 beds to 3,018, making it one of the nation's largest detention facilities. If all of those beds were filled, the number of ICE detainees held there would total more than half of Folkestone's population of about 4,400, the Atlanta Journal-Constitution reported. In a 2021 investigation, CNN reported that at least one federal prison ostensibly shuttered because of Biden's executive order. The Moshannon Valley Correctional Center in Pennsylvania reopened 6 months later as an immigration detention center. CNN's investigation calculated that the Biden administration was spending about $3 million per day on payments to private prison companies, compared to $2.2 million per day during the Obama administration and $2.9 million per day while Trump was in office. These payments also include $255 million to GEO Group subsidiary BI Incorporated in 2021 for ankle monitors. In keeping with the overall rise in electronic monitoring, BI has launched a home curfew program for immigrant detainees. Companies are evading Biden's order in other ways as well. In some instances, state and local governments are acting as middlemen, accepting federal money to house federal inmates but then outsourcing the work to prison companies. In Youngstown, Ohio, for example, the U.S. Marshals Service reportedly signed a contract with the Mahoning County Sheriff's Office to maintain a facility run by CoreCivic. The feds pay the county, then the county pays CoreCivic, CNN reported. Even though the jail is still run by a private company, the company never signs a contract directly with the federal government and avoids running afoul of Biden's order. CoreCivic's stock reportedly jumped 7.4% after the Wall Street Journal detailed these intergovernmental agreements between the federal government and localities. As a result of their aggressiveness and creativity, private prison companies are faring just fine, despite declining crime rates and continued interest in sentencing reform. In fiscal 2022, CoreCivic reported a total revenue of $1.84 billion, while GEO Group earned $2.4 billion. Together, the two companies controlled about 150,000 beds in roughly 150 facilities, though it's beyond the prison walls where they're likely to see the most growth. Prison industries, commissary sales, phone calls, and the exploitation of inmate labor. The prison economy supports myriad industries. Feeding prisoners means contracts for food and meal service. Prisons need furniture, linens, and clothing for inmates. Prison also needs to provide medical care, which means in-house clinics and medical staff. Every aspect of prison operations supports its own industry. Food service giant Aramark, for instance, is one of the prison economy's largest suppliers, in addition to the restaurants, convention centers, stadiums, and other industries it serves. The price of incarceration is highest for inmates and their families, who face a gauntlet of fines, fees, and extortionate charges in a system designed to strip them of their wealth as well as their dignity. The cash register rings right after arrest, as David Dayan wrote in a piece for Talking Points Memo. In Maryland's prison system, for example, just staying in touch with an incarcerated loved one can be exorbitantly expensive. Families who want to send a care package must use the state's designated provider, Access Secure Pack. This company boasts the most comprehensive custom package program in the correctional industry and is a subsidiary of the Keefe Group, one of the nation's largest suppliers in prison commissaries. Another Keefe subsidiary, Access Corrections, manages inmate banking and commissary accounts. This is in addition to the Connect network account for phone services that inmates must also maintain. According to the State of Maryland's website, friends and family can send money to an inmate's account for as low as $3.95 by phone or $2.95 by internet. There's also plenty of money to be made from the prisoners themselves, either through the sale of goods and services or as a source of inexpensive labor. For many inmates, prison is as expensive as it is demoralizing. Phone calls and video visits. Until a 20-year-long national campaign by justice reform advocates prompted regulatory and congressional action, prison phone companies made hay on predatory pricing. Although the worst abuses have ended, it's still expensive for inmates to stay in touch with their families. According to the Prison Policy Initiative, jails in some states once charged as much as $24.82 for an in-state 15-minute call. That was in addition to ancillary fees for services such as opening, funding, and maintaining a phone account, plus fees for money transfer services if an inmate's loved ones lacked a bank account to pay the bills. Companies like Western Union and MoneyGram charged $10 to $12 to transfer $25 into an inmate's phone account. In 2014, the Federal Trade Commission, or FTC, passed regulations capping the cost of an interstate call to $3.15 for 15 minutes. And in 2021, it cracked down on abusive ancillary fees. The maximum money transfer fee, for instance, is now $5.95. Congress also passed the Martha Wright Reed Just and Reasonable Communications Act in early 2023, which clarified the FTC's authority to regulate the cost of in-state phone calls as well as video calls, although it'll be at least a year or two until new rules take effect. Nevertheless, the average jail still charged $3 for a 15-minute phone call as of the end of 2022, according to the Prison Policy Initiative, while the cost of a 20-minute video call could be as much as $8, not including service fees. Moreover, many facilities are banning in-person visits, thereby forcing families to rely on expensive and often low-quality video visits if they want to communicate with incarcerated loved ones. Some video visitation companies even require jails to ban in-person visits as part of their contracts. The lion's share of the revenue goes to just two companies, GTL, Viapath, the company that serves Maryland's prisons, and Securus, the same company dominating the electronic monitoring industry as discussed in the preceding section. In fact, reports the Prison Policy Initiative, these two companies controlled 79% of the jail and prison phone market as of 2022. Both companies are also major players in the video visitation industry, along with companies like Florida-based JPay, which also offers money transfer and other inmate financial services. The St. Louis-based HomeWave, a smaller firm serving 89,000 inmates across 159 facilities as of 2023, according to its site. GTL's phone services, in contrast, reached 1.8 million inmates across 2,300 facilities. Commissary accounts, education, and digital content. Inmates spend at least $1.6 billion a year on commissary purchases, according to the Prison Policy Initiative, although the organization also cautions that the real amount is likely much higher. In 3 states the group surveyed, Illinois, Massachusetts, and Washington, prisoners spent an average of $947 a year for basic necessities like toothpaste, shampoo, toilet paper, and feminine hygiene products. Inmates in Massachusetts, for instance, collectively spent more than $250,000 on soap, a product that facilities are supposed to provide for free. Inmates also spend significant amounts of money on food, in part, the Prison Policy Initiative argues, to supplement meager and nutritionally inadequate prison meals. Unfortunately, most of what's for sale in prison commissaries and through affiliated care package services is junk food, like instant ramen, chips, and other ultra-processed items. The order form for Access Secure Pack's care packages, for instance, offers 4 kinds of sugary cereal: Cap'n Crunch, Apple Jacks, Fruit Loops, and Frosted Flakes, along with 7 kinds of cookies and a wide array of snacks typically found at highway rest stop vending machines. A 5-ounce Brushy Creek salami stick with beef and chicken, $2. Birthday cake-flavored Rice Krispie treats, 60 cents, limit 8. Fritos chili cheese corn chips, $2.80. Chattanooga strawberry double-decker moon pie, 65 cents, limit 8. The healthiest item is canned tuna, $2.90, and the vegetables category includes just one item: Idahoan instant mashed potatoes, 2-ounce packet for 85 cents, limit 7. Digital commissaries are also a growing market, with companies selling music, games, digital books, and educational materials. Connect Network, for example, offers a library of more than 12 million songs inmates can access, provided they rent a Connect Network tablet and open a Connect Network debit link account. The market for in-prison entertainment is apparently big enough that one company, Prison Music Kiosk, offers aspiring musicians a chance to sell their music to the prison market via its service. Artists must, however, buy the company's how-to guide for $300. Commissary sales are only part of the profit-making. Companies also charge significant fees for money transfers into inmates' accounts. Prisons typically award one company a monopoly on money transfer services, according to the CFPB, leaving incarcerated people and their families without choice and with potentially higher costs. At the Louisiana State Penitentiary, for instance, a $40 online transfer costs $6.50, or 16%. In New York City, the Comptroller's Office determined that Friends and Family transferred more than $17.5 million into city jail accounts in fiscal 2018, but at a cost of more than $2 million in transfer fees. Inmates in city and state facilities together spent more than $51 million in commissary purchases that year. The CFPB further reports that companies often pay commissions to correctional institutions that are based on the number of transfers completed, thereby encouraging commissary sales. In one contract cited by the agency, a company promised to pay the state $1 for the first 1,000 transfers, $1.50 for up to 4,999 transfers, and then $2 for each transfer thereafter. Money transfers cost $4.95 to $12.95 per transaction, which meant the state would receive 8 to 40% of each money transfer fee charged by the company. Many states are in fact fully complicit in gouging their prisoners. Nevada, for instance, reportedly marked up the prices in its prison commissaries by as much as 66%. In 2021, the state made more than $2.8 million in profits from prison commissary sales, according to the Nevada Independent. Room and board and health care. States also charge fees for room and board and health care, in addition to all the court costs discussed earlier that inmates must also pay. All but 2 states have so-called pay-to-stay laws that authorize jails and prisons to charge inmates for the cost of their incarceration. Connecticut, for example, charged prisoners $249 a day, leading many to owe thousands of dollars to the state upon their release. One Florida man was billed $54,750, $50 a day for his roughly 3-year stay in state prison. Many states also impose co-pays for infirmary visits, which can result in insurmountably steep medical debts. Pre-pandemic, according to the Prison Policy Initiative, prisons typically charged $2 to $5 per appointment, which is expensive enough for an indigent inmate to forego needed care. While most states suspended all co-pays during the height of the pandemic, those policies have since been rolled back, and some states, like Nevada, never suspended co-pays at all, even at the height of COVID. A 2022 state audit concluded that Nevada's Department of Correction overcharged its inmates for medical services, including through copays that were more than twice the national average, $8 a visit versus $3.47. The state also charged a frivolous man-down fee of $50 for inmates needing help to get to the infirmary. Prison labor. Adding insult to injury, governments and companies also profit from the value of prison labor, while inmates earn wages too low to afford their incarceration. In New York City, for instance, the comptroller's office found that most jail jobs pay less than 40 cents per hour, making it all but impossible for incarcerated individuals to support themselves within the correctional system economy. Skilled workers, such as cooks and electricians, made between 32 cents and 39 cents per hour in 2018, while unskilled housekeepers earned even less. In 2018, the city's Department of Correction paid just $5.9 million in total wages, or about $660 per person that year. Nationally, prison wages have in fact fallen over the past 2 decades, according to the CFPB, from 93 cents per day in 2001 to 86 cents in 2017. This is in nominal, not real dollars. At this rate, the CFPB finds, it would have taken a woman in a Colorado prison over 2 weeks to earn enough money for a box of tampons sold at the facility. At the same time, governments and companies profit mightily from prison labor, either by saving costs on personnel they don't have to hire, for example, by using prison cooks and electricians instead of outside staff, or by selling prison-made products. States and cities often garnish what little that inmates do earn, not just to settle commissary accounts, but also to pay for court fees, child support, and other debts. Among the biggest beneficiaries of prison labor is the federal government, which runs the nation's largest prison industry program, UNICOR, formerly Federal Prison Industries. First established in 1934 with the goal of rehabilitating inmates and teaching them job skills, UNICOR is now a highly efficient revenue machine. In 2017, according to the agency's website, UNICOR made $483.8 million in net sales, with a stunning array of products ranging from air filters to vehicle parts, beef cattle, body armor, and T-shirts. Inmates are paid between 23 cents and $1.15 an hour, half of which is contributed toward fines and fees, court debts, and other costs to the agency's Inmate Financial Responsibility Program. In 2017, the government collected more than $941,000 from inmates' wages, according to the UNICOR website. State and local jails and prisons can benefit from their inmate labor too, thanks to legislation passed by Congress in 1979 to encourage prison industries. Under the federal government's Prison Industry Enhancement, or PI certification program, state and local facilities meeting certain standards are exempt from federal restrictions on the sale of prisoner-produced goods across state lines. Certified programs can also make bulk sales to the federal government above $10,000. Among the nation's largest state-run prison program is Florida's Prison Rehabilitative Industries and Diversified Enterprises, Inc., or PRIDE, which advertises more than 3,000 products for sale, including furniture, clothing, stationery, and even dentures. In 2021, PRIDE generated $59 million in sales and paid its inmate workers between 20 and 95 cents an hour. The price of privatized injustice. The companies that benefit from mass incarceration have made it their business to maintain the status quo. They depend on a steady supply of detainees whose wealth they can extract and whose labor they can exploit. The benefits they return to the public are minimal, while the damage they inflict is incalculable. No evidence conclusively shows that privatized prisons save governments money. To the extent that savings did occur, it was at the expense of prison safety and services. Studies find, for instance, that private prisons cut costs in such areas as rehabilitative services for inmates, lower guard salaries, fewer benefits, and less training. Nor did prison building bring the economic development that companies promised. In fact, some research finds that private prisons actually impede job growth in some communities by depressing wages and diverting resources away from education and workforce development. A 2013 study by researchers at Washington State University found that private prison employees earned a median salary of just $28,790, far below the median of $38,850 earned by state employees and the median of $50,830 paid to federal correctional workers. Private prisons' low wages, high turnover, and understaffing also contribute to safety concerns and violence. In a 2016 audit of federal prisons, the Department of Justice's Office of the Inspector General concluded that private prisons incurred more safety and security incidents per capita than comparable prisons run by the Federal Bureau of Prisons. Contract prisons, for instance, reported 4.2 assaults per month, compared to 1.6 in government-run institutions. The private prisons also reported more contraband, more lockdowns, more inmate grievances, and more instances of inmates being disciplined. Research also shows that people who experience violence while incarcerated are more likely to recidivate than prisoners who don't. This could partly explain why some studies find higher recidivism rates among inmates in private facilities versus those in prisons that are government-run. One study of more than 3,500 Minnesota prisoners released between 2007 and 2009, for instance, showed that incarcerating a person in a private prison increased the chances of the person being rearrested by 13% and increased the chances of the person being reconvicted by 22%. The unfairest burden, however, is the debt that dogs former inmates. For commercial bail or pretrial home detention, for commissary purchases, medical copays, and other expenses incurred while incarcerated, for court costs, fines, and fees, and for post-release probation and parole. These obligations make it impossible for individuals to rebuild their lives once they re-enter society. Many of these debts would also likely not exist were it not for a profit-driven industry determined to exploit a broken system for its own gain. The exploitation of this literally captive market, as the National Consumer Law Center puts it, continues even after individuals exit the prison gates. People on parole or probation are often subject to fees for electronic monitoring, potentially by the same companies that might have monitored them pre-trial. Many individuals owe court costs, while others owe for debts racked up behind bars, such as copays on health care. Nevada's Department of Corrections, for instance, reportedly saddled one former inmate with $100,000 in medical debt after his release. Failure to pay can lead to re-incarceration, which begins the debt exploitation cycle anew. Among those who've experienced the weight of these invisible shackles are the men I met at Baltimore's Civic Work Center for Sustainable Careers, a nonprofit that helps residents formerly involved with the justice system to learn new job skills and rebuild their lives. The organization runs multiple training programs for high-demand green careers, like solar panel installation, home weatherization, and brownfields remediation. One of the city's most effective organizations, the center has placed more than 900 graduates since 2003, 80% of whom have stayed on the job for at least a year. One morning, pre-pandemic, I met half a dozen trainees enrolled in the center's weatherization program. They were learning how to blow insulation, seal up drafty windows, and maneuver in cramped attics. All the trainees I met were black men, ranging in age from early 20s through their 40s. All of them were returning citizens who'd paid their debts to society. They'd finished their time and been released. But the government still laid claim to their lives for fines and fees they still owed. The debts followed these men post-release, crippling their prospects for economic self-sufficiency. They owed court debts, restitution, and even parking tickets. One trainee, Arnold C., was facing $3,000 in impound fees after the police confiscated his car during a traffic stop. According to the Baltimore City Department of Transportation, towing charges are $130 to $140, plus an initial storage charge of $50, an administrative fee of $40, and impound charges of $15 a day. Arnold abandoned his car at the impound lot because he couldn't afford to get it out, but the city went after him anyway. He wanted to enter a payment plan, but was told the minimum initial payment was $675. "I can't pay $675 to start," he said. "It's crazy, because I have other things I have to try to accomplish. I'm trying to get my own place, so I've got to save this and save that. I still have to have gas money, and there's the phone bill and whole lot of little obstacles. These major fines end up hitting you on the head. When it comes to criminal justice, state and local governments can be just as rapacious as for-profit companies in their efforts to extract wealth from vulnerable constituents, often working in concert with private enterprise to generate fees and pursue debts. Governments like to call these public-private partnerships, but the effect is more like a conspiracy to rob low-income citizens of their wealth. The city of Baltimore, for instance, grants medallions to towing companies authorized to tow on behalf of police. Cars can be towed for blocking traffic if they are parked in violation of posted signs, involved in police arrest or towing, confirmed to be abandoned, or if the owner has just 3 or more unpaid parking tickets, what the city calls a scofflaw vehicle. Until 2022, towing companies were even allowed to collect fees from the victims of auto thefts, whose cars were later recovered. Until this policy was instituted, the city apparently collected as much as $250,000 a year from victims of auto theft. To collect its debts, the city of Baltimore formerly relied on Pennsylvania-based debt collection company Penn Credit Corporation. Residents who needed a payment plan to settle unpaid parking tickets had to negotiate directly with Penn Credit, according to the city's website. Drivers who owe more than $500 must pay 25% down and the remainder within 12 months, while debtors owing less than $500 must pay half down and the balance within 6 months. As of late 2023, the city no longer offers the option of a payment plan for delinquent parking tickets. The state of Maryland likewise relies on a private debt collector, the Chicago-based debt collection agency Harris & Harris. According to the state's request for proposal, or RFP, soliciting bids for a debt collection contractor, state agencies refer more than $98 million a year in unpaid debts to private debt collectors, who keep 6.95% of the sums they collect. Many states further coerce debtors by suspending their driver's licenses, although advocacy campaigns in recent years have successfully ended these practices in several states. In Baltimore, for instance, many of the trainees I met had lost their driver's licenses for failure to pay, which meant that transportation was yet another barrier for the men to overcome. Access to a reliable car is especially critical in Baltimore, where public transit is notoriously unreliable. One man who'd lost his license, George H., said he had to leave the house at 5:30 every morning with his then 5-year-old son to make it to the center on time. He took 2 buses and the subway to drop his son off at daycare before getting to class at 7:45. George had owed about $700 in unpaid traffic fines when he left prison, which was why his license had been suspended. The staff at Civic Works helped him work out a settlement, 35 hours of community service to erase $600 of tickets, which he had just completed. It was a weight on my shoulders for years, he said. Another trainee, Jimmy G., said his car insurance lapsed while he was in prison, subjecting him to fines that accrued into thousands of dollars by the time he was released. Every month I'm getting tickets and fines and parking violations while I'm incarcerated, he recalled. I'm in jail for 2 years, and it's getting piled and piled and piled. And then my car gets impounded, then sold, and all I come home to is a big fine. Uninsured cars are subject to a penalty of $150 after the first 30 days, according to the Maryland Motor Vehicle Administration, and then $7 a day thereafter. Even if he were to get another car and have his license reinstated, Jimmy said, he would be afraid to drive. I'm on probation right now, he said. 1 ticket and I go back to prison. It all depends on the probation officer and how much they care. Some of them won't violate you if you get a driving ticket, but most of them will violate you, and you gotta go back in. It's crazy that they think the solution to you not paying a fine is to make you pay more. The student Dominique J., who owed $2,000 before the center helped him get a court hearing to eliminate most of what he owed. If I don't have it, I don't have it. Until his license was restored, Dominic said he drove dirty for 6 months because he couldn't afford the fines he owed. I got pulled over 3 times, and each time they would take my car and take it to the impound, he said. It's a snowball effect. Once you get that first one, you get in a hole you can't get out of, because they keep piling stuff on. What can you do? And I'm not about to stop driving my car, because I've got to earn money. Not long after these conversations in 2020, the Maryland Assembly passed legislation ending driver's license suspensions for unpaid parking tickets and other minor traffic violations. It did not, however, end suspensions for unpaid court costs, insurance violations, back taxes, or child support, which account for the bulk of the debts faced by the organization's clients. To be honest, I haven't really seen much change in what it looks like for our students. Case manager Sarah Kennedy told me in 2022. That legislation passed, but I haven't felt the results of it very much on the ground. Kennedy says as many as half of the center's clients still come in with licenses suspended due to unpaid fines and fees, and she spends about a fourth of her time negotiating with government agencies to get these penalties reduced and licenses reinstated. Where it can, the center helps subsidize the cost of paying off these amounts, although funds are limited. Driver's licenses should not be a leverage point for debt collection, said the center's senior director, Eli Allen. It's just so counterproductive for people trying to take a step forward in life. But so long as there's money to be made, the justice system will be unwilling to loosen its grip on citizens and allow them to move on. 6. Sheltering profits, feeding industry. In 2019, pre-pandemic, the federal government spent $51 billion on rental assistance and other programs to help low-income Americans afford housing. That figure rose to $90 billion in 2021, with the addition of $33 billion in emergency rental assistance, plus other aid for people at risk of eviction during the COVID-induced recession. But despite all this spending, the national shortage of affordable housing is persistent and severe, and landlords hold the leverage. Many landlords make a handsome living from the federal government's Housing Choice Voucher Program, formerly Section 8 rental assistance, while tenants scramble for scarce vouchers and even scarcer available homes. Developers enjoy generous tax credits and subsidies for economic development. Current federal housing policy aims to incentivize the private sector development of affordable housing, rather than the government trying to build its own. Though these subsidies result in housing that wouldn't otherwise exist, they also create complexity, inefficiency, and fat profits for investors and middlemen. The federal government's largest tax incentive program, the Low-Income Housing Tax Credit, or LIHTC, produces about 110,000 affordable units per year, but at an annual cost of more than $10 billion. Private actors must, of course, supply basic goods like food and housing. Governments can't run grocery stores or build apartments, as the failure of public housing can attest. Meanwhile, government anti-poverty programs are essentially subsidizing some of the biggest companies in America. Given their own reliance on government largesse, these companies owe it to low-income Americans to deliver the best products they can, not simply maximize their own revenues. Building revenues. Lion Homes is a shabby complex of red brick townhouses and garden apartments in the Baltimore suburb of Dundalk, Maryland. Built in 1941, the complex offers 242 units, ranging from one-bedroom apartments to three-bedroom townhomes. Photos posted on apartments.com show bare gray walls and hardwood floors, Formica countertops, and dark brown particle board cabinets. But the rent here is just $760 for a one-bedroom apartment and $1,100 for a three-bedroom townhouse, and the landlords accept vouchers for federal rental assistance through the Housing Choice Voucher Program, what used to be called Section 8. As a result, the units are in high demand. The complex had no vacancies as of spring 2023. We currently have a 12-month wait list, the listing boasted. Baltimore spends than $260 million a year on affordable housing, according to the Baltimore City Department of Housing and Community Development. This includes $156 million on rental vouchers to subsidize tenants' rent, $25 million on the low-income housing tax credit to encourage new affordable housing development, nearly $33 million on repairs and improvements, plus a variety of smaller grants and subsidies. Yet the city's affordable housing shortage is still severe. More than 20% of Baltimore households spend at least half their income on housing, the department reports, and more than 3,000 people are homeless. Residents might spend years on the wait list for a rental assistance voucher, or years to land a unit like the ones at Lyon Homes. According to the Baltimore County Housing Authority's website, the wait list at Lyon Homes last opened in 2021, and only for households with a disabled member. In spring 2023, just 3 affordable housing complexes were adding potential tenants to their wait lists, but applicants had to be either 62 and older or have a disability. All other wait lists were closed, including the wait list for rental assistance vouchers. When that list opened for just 9 days at the end of October 2014, 10,000 people applied in the first few hours, and 58,000 applied in the first few days, according to Georgetown University researcher and author Eva Rosen in her book, The Voucher Promise. It's the same story across the country, where soaring housing costs have pushed the demand for rental assistance far beyond what's available. In 2019, roughly 4.5 million households received federal help with their rent, including about 2.1 million households participating in the Housing Choice Voucher Program. Yet the same year, more than 7.7 million households were living under what the government defines as worst-case housing needs. These are households with incomes at or below 50% of the area median, who receive no government housing assistance, and who spend more than half of their income on rent, live in severely inadequate conditions, or both. In 2019, according to government data, just 23.6% of households eligible for federal housing assistance actually received it. Families wait an average of 2.5 years for a rental voucher, according to the Center on Budget and Policy Priorities. And many families wait as long as 8 years, experiencing homelessness, eviction, and financial hardship in the meantime. Many wait lists, like the ones in Baltimore, aren't accepting new applicants at all. A 2016 survey by the National Low-Income Housing Coalition found that 53% of voucher waitlists nationwide were closed to newcomers, and nearly 2/3 of these had been closed for more than a year. In Prince George's County, Maryland, for instance, the Housing Authority's website indicated, as of November 2023, that the last waitlist application period for the Housing Choice Voucher Program was October 5th through October 16th, in 2015. These extreme shortages of both vouchers and housing mean a lopsided market, where low-income tenants have few options for finding a home, even if they're lucky enough to get federal help. Landlords, meanwhile, hold the power, along with plentiful opportunities to profit. The promise of vouchers, funding the people. With an annual price tag of about $19 billion, the Housing Choice Voucher Program is the nation's largest rental assistance program. It began as a pilot in the early 1970s as the experimental housing allowance program under President Richard Nixon. After early research showed promising results, Congress in 1983 added a federal voucher program to Section 8 of the Housing Act of 1937, hence the origin of Section 8 vouchers. In 1998, Congress passed the Quality Housing and Work Responsibility Act, which created the modern Housing Choice Voucher Program and made it the federal government's principal form of assistance to low-income renters. Under the current structure, the federal government allocates vouchers to local public housing authorities, which administer the program day to day. 75% of vouchers must go to households with extremely low incomes, households with incomes up to the poverty line, or 30% of the local median income, whichever is higher. In 2019, according to HUD, the median income among voucher holders was just $13,450. Voucher holders pay 30% of their monthly income toward rent, while the subsidy picks up the rest, up to a limit. A senior receiving $800 a month in Social Security, for instance, would pay $240 for a one-bedroom at Baltimore's Lyon Homes, while the voucher would cover the remainder of the $760 rent. The architect of the voucher program was Malcolm Mike Peabody, who served under Nixon as Deputy Assistant Secretary for Equal Opportunity in the Department of Housing and Urban Development, or HUD. Before he pitched a federal pilot to Nixon, he had already pioneered it in Massachusetts while working for his brother, then-Governor Endicott Peabody. The Peabodys were the quintessential Boston Brahmins. Their father was an Episcopal bishop, Their grandfather was the founder of the exclusive Groton School, and another ancestor was Massachusetts colonial governor John Endicott. Housing vouchers, Malcolm Peabody argued, solved the problems then plaguing traditional public housing: crime, concentrated poverty, and segregation. The public housing projects were getting bigger and bigger and bigger, and they were becoming just nests of crime, Peabody told me in a 2016 interview. By the 1970s, infamous projects included California's Jordan Downs development, epicenter of the Watts Rebellion in 1965, and Chicago's Cabrini Green, a 70-acre development press accounts described as a war zone. In 1972, the government demolished the troubled Pruitt-Igoe projects in St. Louis, designed by Minoru Yamasaki, a Japanese-American architect who would later design the World Trade Center towers. A 33-building complex with more than 2,800 units, Pruitt-Igoe became a symbol of urban dysfunction, governmental incompetence, and the failure of urban renewal. Besides the rampant crime, including drug dealing, prostitution, gang activity, and murder, heaters, toilets, garbage incinerators, and electricity all malfunctioned, and at one point, the faulty plumbing let loose floods of raw sewage through the hallways, The Guardian reported in a 2015 retrospective. Vouchers, Peabody argued, rescued families from that kind of misery. They took away the government's power to dictate where people lived and under what conditions, and gave tenants that control instead. Vouchers, he told me, put the money at the bottom with the people, rather than with the bureaucrats at the top. As he would write in a 1972 article for the Washington Monthly, funding the people would fulfill the deepest emotional need of the poor today, the need to have freedom of choice, to have the freedom to determine the course of their own lives. Moving to opportunity. That belief in tenant self-determination still animates the Housing Choice Voucher Program and accounts for its continued support among conservatives as well as liberals. For conservatives, vouchers embody a combination of two values held dear: market incentives and personal responsibility. For liberals, vouchers represent a promising and powerful mechanism for desegregating communities, breaking up concentrated poverty, and giving more low-income Americans the benefit of positive neighborhood effects. Perhaps the most famous studies about the program's potential benefits involve the Moving to Opportunity, or MTO project, a 10-year experiment begun in 1994 that gave 4,600 low-income families a chance to move out of high-poverty areas, where more than 30% of households live below the poverty line, through vouchers. Children who moved to low-poverty neighborhoods, where the poverty rate is under 10%, were more likely to go to college and earn more money, studies concluded, and adults reported better mental and physical health. In reality, however, vouchers have underperformed their potential, largely because tenants haven't had anywhere near the wealth of choices the program envisioned. For one thing, the shortage of affordable housing is so severe that many voucher holders can't find a unit to use their benefits. Tenants have 60 days from the receipt of their voucher to find housing, or risk having it expire. According to some studies, as many as 20% of voucher holders don't succeed in finding housing. In a 2021 report, HUD's Inspector General, or IG, found that 62% of local public housing authorities had unused voucher capacity, amounting to a total of about 80,000 vouchers nationwide. The IG's office blamed the lack of inventory as one reason for this result. When tenants do find housing, they often don't escape neighborhood poverty. While voucher recipients are indeed less likely to live in high-poverty neighborhoods, many voucher holders have not been able to find places to rent in mixed-income neighborhoods, the kind of move shown to have long-term positive impacts on health and economic well-being, writes Georgetown's Eva Rosen. Instead, she writes, a great many voucher holders are concentrating in poor neighborhoods. According to the Center on Budget and Policy Priorities, just 14% of families with children participating in the voucher program live in low-poverty neighborhoods. One Urban Institute study of Chicago voucher tenants found that 55% lived in mid- to high-poverty neighborhoods, and 63% lived in neighborhoods that were more than 90% black. An especially damaging consequence of this lack of mobility is lack of access to decent schools. In one troubling study by the Poverty and Race Research Action Council, or PRAC, researchers found that while voucher holders lived near better schools than people in public housing, their neighborhood schools were still typically worse than the majority of schools in their state, including schools that primarily serve children in poverty. On average, voucher holders with children lived near elementary schools ranked in the 26th percentile statewide, or roughly the bottom quarter. In Dundalk, Maryland, where the Lyon Homes complex is located, the nearest schools are Dundalk Elementary and Dundalk High. According to the state's report card, Dundalk Elementary ranked in the 10th percentile for Maryland schools in 2021 to 2022, while Dundalk High ranked in the 11th. Fewer than 5% of Dundalk High students scored proficient or higher on the state's standardized math test that year, while 34.7% were considered proficient in English. Section 8. Landlords. As with Medicaid, where the lack of high-quality providers is a persistent challenge, one of the housing voucher program's biggest problems is on the supply side, too, with landlords unwilling to accept subsidized tenants. This is why voucher tenants tend to concentrate in particular neighborhoods, in units managed by the subset of landlords who accept vouchers, and in many cases have made it their business. Some landlords are reluctant to deal with the bureaucracy of administering vouchers, and others don't want the hassle of inspections to qualify for the program. Others believe voucher payments are too low compared to what they can get on the open market. This is often not true. But many landlords also won't accept voucher tenants based on racist and classist stereotypes and preconceptions about their character and behavior. Some engage in blatant discrimination. In one 2018 study, researchers watched how landlords interacted with prospective clients. Landlords can list specific tools that they use to screen tenants, such as criminal background, residential history, and credit checks, but most admit that finding the right tenant comes down to a gut feeling. They base their opinion of a prospective tenant on how she dressed for the interview, whether or not she returned phone calls in a timely manner, how she parented her children, and the types of questions she asked or did not ask about the unit. In an extreme example, one landlord told us about his pet theory. The larger the dog, the worse the credit. Because if you think about it, anyone who has a large dog in a small apartment is irresponsible anyway. In 3 of 5 cities where researchers called landlords to gauge their willingness to accept vouchers, the denial rate was 67% or higher, with the highest rates of denial among landlords in low-poverty neighborhoods. In 2 cities where local regulations forbade discrimination against voucher tenants, the denial rate was lower, 31%. As of the end of 2022, 16 states, the District of Columbia, and 106 localities had passed so-called source of income laws, which prohibit landlords from discriminating against tenants based on their source of income, such as vouchers. Jurisdictions that have passed such laws, says the Urban Institute, have seen an increase in the share of voucher recipients living in lower poverty, less segregated neighborhoods. Opponents, however, have argued that these laws force landlords to participate in a program that's supposed to be voluntary. Some states, like Texas, have even passed legislation banning anti-discrimination ordinances, causing an affordable housing crisis in some areas. As many as 1 in 4 voucher holders can't find housing in Houston, according to the Texas Tribune, and many others are steered toward low-quality housing in high-poverty neighborhoods. Many landlords' reluctance to rent to voucher holders has, of course, prompted others to smell a profitable business opportunity, including the development of rental portfolios exclusively catering to voucher tenants. As Georgetown's Rosen points out, these landlords have learned that voucher payments provide a steady source of income that their otherwise financially precarious tenants may not be able to offer. In Baltimore, Rosen writes, landlords even compete for tenants, offering move-in incentives like new appliances or even cash bonuses. One landlord she interviewed was so desperate for the reliability of voucher tenants that he waited outside the voucher office to catch new recipients on their way out the door, offering them a ride up to see his vacant property in Park Heights, a struggling neighborhood in Baltimore. Many landlords, however, can get away with substandard properties and no perks. Although the Housing Choice Voucher Program requires units to pass routine quality inspections, standards are only as high as the ability of the local public housing authority to enforce them. And given the high demand for a limited supply of affordable housing, landlords have little incentive to do more than the bare minimum. The results can be horrific when oversight is poor. In Washington, D.C., for instance, a 2023 investigation by the Washington Post discovered that the D.C. Housing Authority was overpaying landlords by millions of dollars every year. In one case cited by the Post, the city was paying $2,467 a month on behalf of a 73-year-old tenant whose unit had no electricity, and in a neighborhood where the market rent was $1,613. At the same time, the paper reported, the city's wait list for rental vouchers was 30,000 people long, meaning that the city's overpayments were preventing many households from getting access to housing aid. Numerous YouTube instructional videos, real estate investment how-to guides, and get-rich-quick gurus extol the virtues of investing in voucher-subsidized housing. Profits accrue by investing as little as possible while maximizing the stream of government revenue. One such advocate is Peter Harris, a self-styled commercial real estate coach, author, and investor, whose website touts an audio program he recorded with Donald Trump. 3 Master Secrets of Real Estate Success. According to Amazon, the CD was published by Trump University Press in 2006 and out of print as of 2023. A former Silicon Valley engineer, according to his official site, Harris is also the author of the more legit Commercial Real Estate Investing for Dummies. In addition to his books and tutorials, Harris accepts applications for protégés, co-investors with whom he promises to share in the deal profits together. In a 2017 blog post, Harris echoes what Rosen's interviewees had discovered, that landlords can avoid many of the disadvantages of renting to low-income tenants by investing in Section 8. Among the perks Harris cites are on-time and convenient payments. You will get your rents specifically from the HUD each and every month as a check or direct deposit. Free access to a large amount of potential tenants. There is a long, verified wait list of Section 8 tenants accessible online you can use to discover potential tenants in your city. Higher rental rates. The rent you can get from a Section 8 tenant surpasses what you could get with a regular rental that is not in the best neighborhood. And short vacancies. Most urban areas have a long list of Section 8 members with vouchers who are looking for housing. In addition, Harris writes, Section 8 landlords get security from tenant financial hardships because the government pays the rent. In his blog post, he relates the story of a tenant, Marcy, who disappeared on me for a considerable length of time. Had she not been on Section 8, she no doubt would have been removed because of non-installment of her rent, he writes. But because of her voucher, I didn't need distress. Harris finishes out his post with investing tips for fellow potential voucher tenant landlords. Get rid of all ceiling fans, screen doors, garbage disposals, and storage areas, he advises. Having these things won't get you higher rents, yet they will cost you in maintenance. They are not necessities, and Section 8 does not mind whether you have them or not, so I would simply eliminate them. He also describes a point system for screening out potentially troublesome lessees and counsels landlords to train their voucher tenants. Train your tenant. Don't give them a chance to train you. Section 8 tenants are somewhat similar to youngsters. You should give structure and implement the standards, or you will wind up with unpleasant encounters. Continuously be proficient, and don't get candidly involved or fall into any psychological distractions. You are the parent, and they are the youngsters, so you should give them rules to abide by. The LIHTC, boon or boondoggle. Unless and until the federal government's housing voucher program solves the problem of supply, landlords like Harris will continue to dominate the low-income rental market. But, if anything, the shortage of quality, affordable housing is likely to worsen in the short term. Over the next decade, nearly 500,000 units built over the last 30 years with the help of the nation's largest subsidy for affordable housing development, the Federal Low-Income Housing Tax Credit, or LIHTC, will be free of restrictions requiring their affordability. Under the terms of the credit, first enacted in 1986, developers can take advantage of subsidies so long as a designated portion of the units they build are affordable for at least 15 years, and in many cases, 30. While the credit worked to bring in a rush of new affordable housing development in its early years during the late 1980s and early 1990s, the market now faces a 30-year problem as these affordability restrictions end and a flood of units potentially leave the market. For apartments located in desirable areas, the expiration of mandates will mean landlords can command market-rate rents, pricing out prior tenants and reducing the overall stock of affordable housing. About 9% of these expiring units are in areas that rank high or very high in both desirability and opportunity, according to a joint study by the National Low-Income Housing Coalition, NLIHC, and the Public and Affordable Housing Research Corporation, and most are held by for-profit developers. Rents for these units are likely to rise dramatically. Another 13% of units are in areas that rank high or very high in opportunity, meaning that they're ripe for gentrification. All told, the study calculates, 52,923 units in high or very high desirability neighborhoods with for-profit owners will have lost their affordability restrictions by 2029. Although the LIHTC is arguably still the nation's most effective affordable housing development program, as well as its largest, it's been an expensive and complex 30-year experiment that's also spawned an industry aimed at profiting from the program's inefficiency. Complex market incentives. In the same way that tax credits for solar panels and windmills promote green energy production, the LIHTC encourages affordable housing development by making its construction more financially attractive for builders. The credit doesn't subsidize production directly, but instead relies on a more complex mechanism to create the right market incentives. The LIHTC is not administered by HUD, but by the IRS, which allocates a set amount of tax credits to each state depending on its population. In 2022, for instance, Alabama received a LIHTC allocation of $12.8 billion, while California's was $105 billion. States in turn allocate credits to developers competing to get their projects subsidized. To qualify for the credit, developers must agree to ensure that a specified portion of a project's units will be affordable for at least 15 years, or 30 years for projects begun after 1990. Here's where even more complexity comes in. The LIHTC is an offset for tax liabilities, which developers typically don't have before a project is built, because there aren't yet rents coming in. So, developers sell their credits to investors in exchange for cash to build their proposed developments. Often, these investors are banks, which also get credit under the Community Reinvestment Act, or CRA, for participating in LIHTC projects. Because the law does not permit the actual sale of tax credits, developers and investors enter partnership agreements to cement their transactions. In theory, these arrangements ensure that projects go through because investors don't want to lose the value of the tax credits they've bought or lose credit under the CRA if a developer goes under or construction doesn't finish. LIHTC's cheerleaders argue this de facto oversight is one reason the program is effective, and proof of how much market mechanisms can help achieve important goals in social policy. And indeed, this structure has worked well enough to produce more than 3.5 million units of affordable housing since 1987. But it's still potentially more a boondoggle for developers than a boon for low-income tenants. In a 2017 joint investigation, NPR and PBS Frontline discovered that despite a 66% increase in federal spending, the LIHTC was producing far fewer units than it did 20 years ago. 77,000 units in 1997 versus 59,000 units in 2014. In fiscal 2022, the program cost $10.4 billion, according to the Joint Committee on Taxation. Industry officials told NPR Frontline that rising construction costs were to blame for the program's rising expenditures and lower returns, but it's impossible to tell if those claims are true, given the poor quality of state oversight. In a 2018 audit, The U.S. Government Accountability Office, GAO, cited weaknesses in data quality that made it difficult to assess the program's cost effectiveness. For example, the GAO reported, few agencies have requirements to help guard against misrepresentation of contractor costs, a known fraud risk. The complexity of the LIHTC creates plenty of opportunities for a variety of players to take their cut. Syndicators, for instance, act as middlemen between developers and investors and charge significant fees for their services. Syndicators collected more than $300 million in fees in 2016, according to the NPR Frontline investigation. The true amount could be much higher. The 2018 GAO audit found that housing agencies did not capture the full extent of the fees paid to syndicators, although the IRS requires this data to be collected. Of the 12 agencies the GAO examined, none collected data on total syndication costs, even though these fees potentially amounted to between 2% and 8% of the amount invested. For perspective, reported the GAO, the median investment in its analysis was $7.6 million, which would mean a syndication fee of $608,000 at 8%. Whatever the fees are, they're high enough to support a multitude of well-heeled firms. According to Multifamily Executive's list of 2021's top 10 syndicators, the nation's biggest LIHTC syndicator is Boston Financial Investment Management, which reported $15 billion of investments under management. Developers charge hefty fees for their work as well, which also often amount to millions of dollars per transaction. In Florida, for instance, developer fees total about 16% of development costs, or a median of $2.1 million per project, according to the GAO. The National Council of State Housing Agencies recommends a maximum developer fee of 15%, though states are free to set their own standards. The sum total of these fees can dramatically bring down the program's efficiency. A 2014 state audit of Missouri's LIHTC program found that just 42 cents of every tax dollar actually goes toward the construction of low-income housing. The remainder, said state auditors, was going to investors, syndicators, or back to the federal government as taxes. Moreover, the audit found, the program generated only 8 cents in state revenue for every dollar spent, and created just 63 new full-time jobs in the fiscal year examined. Since spending on the credit totaled $144 million that year, the program cost the state approximately $61,000 per unit of housing or $2.3 million per job. On top of it all, the credit itself is extraordinarily generous, meaning that investors don't need much prodding to participate in the LIHTC. The program offers 2 levels of credits, a 4% credit for those that use tax-exempt bonds, and a 9% credit for those that don't. Most projects opt for the 9% credit, which effectively amounts to a 70% subsidy. Here's how that works in practice, as Chris Edwards and Vanessa Brown-Calder write in a critique of the credit for the Cato Institute. Consider a housing project that costs $10 million to build and receives the 9% credit. Investors would get tax credits of $900,000 a year for 10 years, totaling $9 million. Those credits would be worth about $7 million on a present value basis, or about 70% of construction costs. The government essentially covers 70% of the costs of the project by allowing the investors to reduce their income taxes by a present value of $7 million. Developers in particular profit handsomely, argues American University professor Brandon M. Weiss, because they're using someone else's money, not their own, to finance their projects. Rarely does the developer contribute any significant equity during construction to cover developer costs, writes Weiss in the Harvard Law and Policy Review. In some cases, it is possible for a developer to finance a LIHTC project using little to none of its own capital, hence yielding close to infinite returns. All these costs and inefficiency might be tolerable if the evidence clearly showed how the LIHTC benefits low-income tenants. But again, it's difficult to gauge just how effective the LIHTC has been because there isn't enough reliable data to judge. The decentralized administration of the credit through the states has meant very little national-level comprehensive scrutiny. It wasn't until 1996, nearly 10 years after the credit's enactment, that the government even created a national database of LIHTC projects. A 2020 HUD report on the demographics of LIHTC tenants in 2017 complained of substantial data gaps, with many states and housing authorities unable to submit information for all active properties. Among the agencies that submitted no information, for instance, was New York City's Department of Housing Preservation and Development. Many states didn't report data on the race or ethnicity of LIHTC tenants, and household income information was also woefully incomplete. Oregon and Tennessee, for instance, reported no income data at all. This absence of data makes it impossible to know if the LIHTC is reaching underserved minority communities, or even if LIHTC properties are in fact affordable as required by the law. But what spotty evidence there is shows the program is flawed. Like the Housing Choice Voucher program, the LIHTC isn't helping to break up concentrated poverty. In fact, it might be adding to it. One 2020 study concluded that LIHTC units have been spatially clustered in socioeconomically disadvantaged neighborhoods over time, and that LIHTC developments tend to increase the concentration of households that have lower income than the average household income within a particular area. Likewise, an earlier study in 2011 found that LIHTC units tend to be highly clustered in urban areas, with high levels of poverty and racial segregation. Why this happens is that the LIHTC program does not provide any incentives to developers to generate mixed-income housing, as University of Kansas professor Kirk McClure testified to the Senate Finance Committee in 2017. At the same time, paradoxically, LIHTC units aren't actually affordable for many low-income households, and many LIHTC tenants are still severely rent-burdened. Unlike the housing voucher program, where the maximum rent a tenant pays is equal to 30% of their income, the maximum rent on a LIHTC unit is 30% of an area's median income. That means in places with high median incomes, rents can be exorbitant for many low-income residents. One national sample of LIHTC households found that nearly 40% of tenants with incomes less than half the area median were severely cost-burdened, devoting more than half of their income to housing costs. About 70% of the poorest LIHTC households, those with incomes under 30% of the area median, relied on additional assistance, such as vouchers, to help them pay the rent. And incidentally, this means a second source of subsidies for landlords. The looming expiration of affordability requirements will only add to tenants' burdens while padding developers' profits. As American University's Brandon Weiss writes, these back-end profits essentially amount to a massive windfall for private owners. It's a statement that could be true of the LIHTC as a whole. Snapping up profits. The federal government spends enormous sums to combat hunger and food insecurity. In 2022, the federal government spent $183 billion on food and nutrition assistance, including the Supplemental Nutrition Assistance Program, or SNAP, formerly food stamps, the Special Supplemental Nutrition Program for Women, Infants, and Children, WIC, as well as emergency pandemic assistance. The government also spends about $14 billion annually providing free and reduced price meals through the National School Lunch Program. These programs are a lifeline for millions of children who would otherwise go hungry, but they also prop up big box retailers, dollar stores, and food service conglomerates as much as they help ordinary households. Food stamp sales account for about 10% of dollar store revenues, according to one analysis, while Walmart reportedly takes in 18% of all food stamp purchases, according to Slate. These companies' profits also potentially come at the expense of consumers' nutrition and health. Dollar stores in low-income areas often fail to stock fresh produce, instead offering low-quality, low-nutrition processed foods. Big food companies churn out mass-manufactured school lunches high in fat and sodium, though they may technically meet the federal government's nutritional guidelines. During the worst of the coronavirus pandemic, in 2020 and 2021, Congress dramatically expanded the Supplemental Nutrition Assistance Program, or SNAP, to help American households cope with the economic shock of lockdown. The emergency aid increased the maximum benefit by about $90 per person on average, enough to keep 4.2 million Americans above the poverty line in the last quarter of 2021, according to the Center on Budget and Policy Priorities. In fiscal 2021, federal spending on SNAP totaled a historic high of $111 billion, nearly double the amount spent pre-pandemic in fiscal 2019. These additional benefits expired in March 2023, after COVID was declared to be no longer an emergency. But with inflation still running high and food prices spiking, the impact of these benefit cuts was immediate. At the Arlington, Virginia Food Bank, where I volunteer, the line for distribution stretched down the block, and the first families were in line an hour before the doors opened. The Washington Post reported a mile-long line at one Kentucky food pantry, where some families waited 9 hours for a few bags of desperately needed groceries. Households weren't the only ones to take a hit when pandemic SNAP benefits ended. The Wall Street Journal reported that discount supermarkets and dollar stores expected a major slide in 2023 revenues, according to industry analyses. Among the chains with the highest exposure to SNAP dollars were discounters like Grocery Outlet, along with Walmart, Dollar General, Family Dollar, Kroger, and BJ's Wholesale Club. According to a Goldman Sachs analysis the Journal cited, SNAP accounted for as much as 15% of Grocery Outlet's 2021 sales, and more than 10% of revenue for Walmart and other high-exposure chains. In lower-income areas, the Journal reported, SNAP paid for as much as 20% of all grocery sales. SNAP may well be among the largest hidden federal subsidies enjoyed by American companies. Though benefits nominally go to low-income families, 100% of those dollars pass through to grocery stores, dollar stores, convenience stores, and other retailers. Although the government doesn't release data on the specific outlets where SNAP benefits go, potentially an impossible task given the volume of transactions, a 2012 investigation by public health attorney and author Michelle Simon uncovered eye-popping instances of how much individual retailers gain. In 1 year, for instance, 9 Walmart supercenters in Massachusetts together received more than $33 million in SNAP dollars, over 4 times the SNAP money spent at farmers markets nationwide, Simon reported. In Oklahoma, Simon wrote, Walmart stores captured about half of the nearly $1 billion spent on SNAP benefits over 2 years. Like federal rental assistance, SNAP is also essentially a voucher program, except the benefits are spent on food. And like the Housing Choice Voucher Program, SNAP is intended to give recipients the freedom to choose where to spend their benefit. But as with housing, the choices available to low-income consumers can be severely limited and substandard. Supermarkets are scarce in many low-income neighborhoods, as is fresh produce. Though the USDA now approves farmers markets to accept SNAP benefits, the overwhelming majority still do not. As a result, too many SNAP dollars are flowing to businesses that are cementing disparities in access to healthy food by low-income consumers. It's a stunning example of how even the simplest of benefits for the most basic of necessities, nutrition assistance for poor families, can be distorted by private actors seeking profit. Given the tens of billions of dollars it spends on SNAP every year, the federal government should have enormous leverage to ensure that beneficiaries have adequate access to healthy food. And given the tens of billions in revenue that major retailers, grocery chains, and processed food makers collect from SNAP annually, the quality of the products they offer to low-income consumers deserves greater scrutiny. To its credit, Walmart offers a wide selection of fresh produce in its grocery departments. Walmart is, in fact, the nation's largest grocer, with grocery sales of $208 billion in 2021. But in many parts of America, especially in rural areas, the closest food store increasingly isn't a Walmart, but a discount chain like Dollar Tree or Dollar General, which often offers no fresh food at all. That's the case in Craigsville, Virginia, a tiny town of about 900 people, 3.5 hours southwest of Washington, D.C. 3 miles away is the Augusta Correctional Center, a medium-security state prison that's one of the town's principal employers. In 2021, 48% of residents were employed, according to Census Bureau data, and the poverty rate was 30%. The nearest Walmart is 25 miles away in Staunton, Virginia, but there's a Dollar General on State Road 42, Craig Street, which runs through the heart of town. Aside from a couple gas stations, it's the only town's significant retail store. Providing that convenience and proximity is what's propelled the chain's success against big retailers like Walmart. The company describes itself as a small box store that offers most necessities, such as basic packaged and refrigerated or frozen food and dairy products, cleaning supplies, paper products, health and beauty care items, basic apparel, housewares, hardware and automotive supplies, among others, according to its 2022 annual report. Its goal is to offer just enough basics that a 50-mile round trip to Walmart becomes unnecessary, a strategy that's been wildly successful. As of fall 2023, the chain operated more than 19,000 stores across the country, making it the nation's largest retailer by store count. Dollar General stores, in fact, significantly outnumber Walmart's, of which there were 4,616 in 2023. Dollar General even outpaces McDonald's by about 5,000 outlets. Dollar General also ranked 12th among the nation's largest grocers in fiscal 2021, ahead of well-known chains like Aldi and Trader Joe's, according to industry publication Supermarket News. Once again, its strategy has been to fill in the gaps traditional grocers have left by colonizing what would otherwise be food deserts in low-income urban and rural areas. We generally locate our stores and plan our merchandise selections to best serve the needs of our core customers, the low and fixed-income households often underserved by other retailers, including grocers, acknowledges the company's annual report. Nearly 24 million Americans live in low-income areas that are further than 1 mile from a large grocery store or supermarket, according to the federal government's Healthy People 2030 project. Likewise, a 2012 government study identified 1,519 limited supermarket access areas nationwide, where residents must travel significantly farther to reach a supermarket compared to residents in well-served areas. Predominantly Black and Hispanic neighborhoods are much less likely to have a supermarket than neighborhoods that are predominantly white. Conversely, Black Americans are more than twice as likely to live in limited supermarket areas than whites. Lack of access to healthy food, in turn, worsens racial and economic disparities in health outcomes, such as higher rates of obesity and diabetes, cardiovascular disease, and cancer. But Dollar General's arrival in low-income communities has hardly turned food deserts into oases. As essentially souped-up convenience stores, Dollar General and similar chains offer inventories heavily stocked with cheap, highly processed foods and scant availability of fresh produce. You could say their bread and butter are Tastykake and Parky. It might be great for the company's bottom line, but not for consumers' health. In Craigsville's Dollar General, for instance, an aisle labeled Good Choices offered only several brands of granola bars, along with Rice Krispie Treats and Cheese Puffs. I saw no fresh fruit or vegetables during my visit in the fall of 2022, but I did see a large sign by the register next to a display of Bic lighters. SNAP EBT accepted. EBT stands for Electronic Benefits Transfer. In 2021, just 1,300 of Dollar General's 18,000-plus stores offered any fresh produce, although the company pledged to grow that number to 10,000 over the next several years as part of a partnership with the nonprofit Feeding America. How extensive these fresh offerings will ultimately be, however, is an open question. The company's business model dictates a low-cost, no-frills building with limited maintenance capital, low operating costs, and a focused merchandise offering, according to its annual report, along with limited staff and limited space. The company is experimenting with a new type of store called DG Market, which will sell the top 20 fresh produce items sold by traditional grocery stores, including lettuce, tomatoes, onions, apples, strawberries, potatoes, sweet potatoes, lemons, limes, salad mixes, and more, according to an industry publication about the effort. The first DG Market store opened in Tennessee in 2021. That Dollar General is making these shifts at all is the result of years of advocacy by public health and consumer groups who've criticized dollar stores for their destructive impacts on low-income neighborhoods. A 2018 report by the Institute for Local Self-Reliance called dollar stores an invasive species in America's left-behind places. Organizations like the Center for Science and Public Interest have argued that dollar stores potentially worsen access to healthy food options by driving out competition. When dollar stores saturate a community's grocery market, full-service food stores are deterred from opening, and existing grocers are pushed out, the group wrote in a 2020 fact sheet. In some instances, existing grocery sales drop by as much as 30% when a dollar store moves into the neighborhood. Advocates also charged that dollar stores deliberately targeted low-income neighborhoods, and worst of all, counted on SNAP dollars to fuel their expansion into these areas. Between 2007 and 2017, the number of outlets accepting SNAP benefits grew from 162,000 to 250,000, driven largely by the growth in dollar stores. Congress, however, has largely ignored the dollar store phenomenon, even though the federal government has been the de facto financier of the industry's growth via SNAP. Instead, conservatives in Congress over the last several years have preferred to focus on toughening work requirements and further limiting who deserves aid. Some members want to eliminate SNAP benefits altogether for poor adults without children, while others want to raise the work hours demanded from able-bodied adults without dependents, or ABODs, though the law is already quite strict. These proposals, of course, miss the point. The SNAP beneficiaries who are in fact the least deserving are the companies that profit from the program without accountability for the damage they inflict. But it's still low-income Americans, and all too often children, who bear the toll of this lack of oversight, both with their health and as political pawns. Lunch money. Donna Martin is the director of nutrition for Burke County, Georgia Public Schools. She's everyone's dream lunch lady. When we spoke on a Monday in March 2022, she was readying the day's meal. Turkey tetrazzini, broccoli, carrot sticks with homemade ranch dressing, and made-from-scratch strawberry muffins. And we have fruit mallow, which is one of my favorites, Martin said. It's fruit cocktail, but it's got extra cherries and marshmallows, which the kids really like. The Friday before, she'd served barbecue chicken with collards sourced from a local farmer, and homemade rolls with local whole wheat flour. Yeah, we have amazing meals, she said. Even more remarkably, she and her staff produced these meals on the tightest of tight budgets. Her district is poor. More than 2/3 of her 3,600 students qualify for free or reduced price school lunch, and her cafeteria's principal source of funding is the federal government's National School Lunch Program. Martin starts work at the crack of dawn and scrounges for supplies all day. A pioneer of the farm-to-school movement, Martin is creative and endlessly inventive, so that not a scrap of food is wasted. Her meals are fresh and appealing, even to the pickiest of grade schoolers. But she's also a unicorn among school nutrition directors, rare enough that the First Lady Michelle Obama paid her a visit in 2016, and later invited her to the White House on multiple occasions for summits on child nutrition. Far more typical of school lunch programs is what gets served every day in Fairfax County, Virginia, to the district's more than 181,000 students, about a third of whom qualify for free lunch. The food comes not from cafeteria cooks, but from a contractor, Premier Inc. U.S. Foods, one of the nation's largest food service companies. Download a monthly menu for any of the county schools. I downloaded the March 2023 menu for Justice High School, and you'll see a dozen or so items in constant, monotonous rotation. Hamburgers and cheeseburgers alternate with baked chicken on bun and corn dog bites. The beef soft taco trades off with nachos, tortilla chips, taco meat, and nacho cheese sauce. The Italian line serves both cheese and pepperoni pizza every day, while the Asian line serves General Tso's or sweet and sour chicken. The mystifyingly named chopped cheese salad is also available daily, as is a yogurt biteable, Cheez-Its, and a spicy chicken wrap. Fruit and vegetable selections vary between broccoli, baby carrots, applesauce, canned peaches, and mandarin oranges. My teenage sons, who are Fairfax County students, described their cafeteria food with one word: brown. Though it nominally meets federal nutrition standards, the cheeseburger served at Fairfax County school lunch has more fat, calories, and sodium than a regular cheeseburger from McDonald's. According to the nutrition information provided by Fairfax County, a cheeseburger on bun packs 350 calories with 19 grams of fat and 820 milligrams of sodium. A McDonald's cheeseburger, in contrast, clocks in at 300 calories, 12 grams of fat, and 750 milligrams of sodium, which, of course, is still nowhere near healthy. Fairfax County's baked chicken on bun is comparably salty and fatty. 350 calories, 14 grams of fat, 630 milligrams of sodium, as is the healthier spicy chicken wrap. 350 calories, 18 grams of fat, 680 milligrams of sodium. The yogurt biteable, which includes string cheese and a soft pretzel, has significantly less fat, 7 grams, but makes up for it in sugar, 18 grams. Menus like these might help explain why half of U.S. children don't eat a fruit or vegetable every day, according to the Centers for Disease Control, or CDC, and why childhood obesity is rising. According to a 2015 study by researchers at the University of Illinois at Chicago, pizza is the second leading source of calories among children ages 12 to 19. As one result, more than 1 in 5 children ages 12 to 19 are obese, reports the CDC, and the rate of type 2 diabetes among teens has nearly doubled over the last 20 years. Nevertheless, the National School Lunch Program is one of the most important supports available to low-income children. Burke County's Martin says for many of her kids, the breakfasts, lunches, and even suppers she provides might be the only food they get. Pre-pandemic, the National School Lunch Program reached nearly 30 million children a day and served 4.9 billion lunches a year. In 2021 to 2022, nearly half of public school students, 48.6%, qualified for free or reduced price meals. Access to free meals reduces food insecurity and improves school performance. Free breakfast, in particular, reduces tardiness, absenteeism, and behavior problems triggered simply because a child is hungry. Yet despite the importance of these meal programs, school lunches are increasingly more likely to be what's served in Fairfax County. Mass-produced, marginally nutritious, and indifferently prepared. Current policies have made it tough for many school districts to emulate Donna Martin and her healthful, made-from-scratch meals. Contractors, meanwhile, have made it easy for districts to rely on them to feed their students. That's how big food is taking over school lunch. Unlike every other aspect of public school operations, cafeterias are largely expected to be self-sustaining. They typically get no money from their districts and must instead rely on federal reimbursements from the National School Lunch Program and revenue from cafeteria sales to pay for the food they serve. This financial imperative is what's helped drive many districts into the arms of big food. To cover costs, school cafeterias must maximize participation in the federal school lunch program in order to get reimbursements and persuade the students who can afford it to buy lunch full price. That, in turn, means offering what kids will eat: pizza, burgers, and chicken nuggets, and for the lowest cost possible. During the pandemic, Congress raised reimbursements for school meals by 40 cents per lunch and 15 cents per breakfast through June 2023, to a maximum reimbursement of $4.50 for lunch and $2.67 for breakfast for schools with the highest needs. Wealthier schools get lower reimbursements per meal, and reduced-price lunches are also reimbursed at lower rates. But more than half of nutrition directors surveyed for a 2023 report by the School Nutrition Association said these reimbursement rates failed to cover their costs, and nearly 9 in 10 said increasing costs were their top concern. Even Burke County's Martin said making ends meet has been a struggle. Staff got more expensive as the labor market tightened through 2022. Inflation sent her school costs spiraling by 25%. Costs are going up and up, but the money I get from the federal government is the money I get, she said. I'm not like a restaurant that can charge more to my customers. Rising costs aren't the only difficulty many school food programs face. For instance, finding skilled and willing staff has also been tough, especially since the start of the pandemic. In the School Nutrition Association's 2023 report, 59% of school nutrition directors called staff shortages a significant challenge. "Our jobs are really hard," said Martin. "When we do all this scratch cooking, you're making rolls, you're on your feet, you're lifting 50-pound bags of flour and sugar and cases of product. It's hard work. If you can go to Walmart and make $15 an hour as a cashier, people would take that in a heartbeat over the hard work in my kitchens." Even if they can find the workers, many schools have outdated kitchens that can make food preparation difficult. 55% of school kitchens needed infrastructure upgrades as of 2014, according to the Pew Trusts, and 88% needed at least one piece of kitchen equipment. Federal grants for kitchen equipment have likely since mitigated this problem to some extent. Federal nutrition standards are also complex, and the bureaucracy of compliance intimidating. The USDA's transitional standards for milk, whole grains, and sodium, for instance, is 39 pages long, and there's a 7-page policy memo on the appropriate formulation of smoothies. Food service management companies, however, promise to take all these hassles away, an irresistible proportion for many cash-strapped districts. Aramark is currently one of the nation's 3 largest school lunch food service programs, and as noted in Chapter 5, it's also the nation's largest provider of prison food services as well. Its website, for instance, lists multiple benefits of its services, including delivering meal programs that meet USDA requirements for nutritional standards, and delivering a financially viable food service program that minimizes use of general fund dollars to subsidize the food program or generates a surplus for reinvestment back into the district. Aramark also posts on its site a guide to help school leaders overcome community opposition to contracting out school lunch. Titled "Outsourcing is Not a Dirty Word," the pamphlet proposes talking points for overcoming objections, while including a sales pitch for the company. Explain how the outsourcing provider will work with existing employees, deliver more specialized training and development programs, and may even help create more jobs within the community, the guide counsels. In 1990, Education Week published a prescient piece titled "Food Service Companies Eye $5 Billion School Lunch Market." At the time, the article reported just 4% of schools participating in the National School Lunch Program used food service management companies to provide their meals. But executives interviewed in the piece projected growth rates of 15 to 20% a year. By 2022, the 3 biggest players in the K-12 market, Compass Group North America, through its subsidiary Chartwells, Sodexo Inc., and Aramark Corp., were posting an estimated $3.9 billion in combined sales, though this figure includes contracts with private schools too. These companies offer not just the outsourcing of a school's entire dining operation, but also ready-made foods and products that school staff can heat and serve, even if they lack all the amenities of a professional kitchen. Imagine thousands of pounds of chicken nuggets, pre-made burgers, and frozen waffles. For districts unwilling to go all in with a food service management company, big food companies are still happy to help in other ways by selling districts cheap, highly processed foods that are easy to prepare and popular with kids. In a 2015 analysis, the Physicians Committee for Responsible Medicine identified 20 companies advertising unhealthy meat and dairy products for school meals in the pages of the School Nutrition Association's School Nutrition magazine. These businesses included ConAgra Food Service, Chef Boyardee Beef Ravioli, Golardi Stuffed Crust Pepperoni Pizza, and Cheese-Filled Breadsticks, Advance Pierre Foods, Beef and Mushroom Patties, Foster Farms Food Service, Chicken Corn Dogs, and Sara Lee Food Service, Hot Dog, Corn Dog. In 2023, Kraft Heinz reportedly started marketing modified versions of Lunchables to school cafeterias. The fact that a processed packaged food meets school lunch standards is part of what needs to change in the National School Lunch Program. Katie Wilson of the Urban School Food Alliance told the Washington Post. Fast food companies also cater to school lunch programs. Domino's Pizza, for example, offers Smart Slice, which it advertises as locally made NSLP-compliant pizza. Likewise, Pizza Hut markets to schools with its A-plus pizza program, featuring pizza crusts made of 51% white whole wheat flour to comply with federal standards. Companies will even make processed foods to order for schools that participate in the USDA Foods program, which provides surplus meat and dairy to schools for free. Under the government's USDA Foods Further Processing program, a district can ship thousands of pounds of USDA chicken to a contractor who will convert them into nuggets for a fee. In school year 2017, districts processed $1.4 billion worth of food this way. The program arguably expands access to the USDA Foods program by providing a way for districts to convert raw or bulk foods they otherwise don't have the capacity to handle into a variety of convenient, ready-to-use end products, as the USDA puts it. But it also means districts are spending a lot of money to process whole foods into products that are much less healthy. One early critique by writer Lucy Commissar noted how the Michigan Department of Education was sending its contractors free raw USDA chicken worth $11.40 a case and paying $33.45 a case to get them back as nuggets. The savings promised to schools by big food companies are either often illusory or come at the price of sacrificing nutrition. By sheer dint of their size, food service companies do have the benefit of bulk purchasing power, which can advantage smaller school districts that lack the leverage to negotiate with suppliers. But the more common strategy for cost savings is by cutting corners, providing low-cost foods that are also lower in quality. Pizza is very, very, very cheap. As Burke County's Donna Martin points out, districts save money but shortchange students' health. And sometimes there are no savings at all. In Washington, D.C., for instance, the city's auditor released a 2016 report bluntly titled, "Contracting Out School Food Services Failed to Control Costs as Promised." The audit followed a $19.4 million settlement with Chartwell's in 2015, after allegations that the company had overcharged the district millions of dollars and delivered poor quality food that was sometimes spoiled. The complaint against the company also claimed that instead of buying food at the lowest possible price, as its contract required, Chartwell's used a corporate affiliate to purchase foods from companies that manufacture highly processed foods and charge higher prices, the Washington Post reported. In quantifying the extent of these overpayments, the auditor's office found that the district had spent an average of $3.90 per school meal, compared to $2.98 paid by schools in New York and $3.62 in Fairfax. Certainly, easing the financial constraints school food programs face could reduce the pressure to rely on big food. More generous reimbursements and help with infrastructure upgrades could encourage more school lunch programs to follow Donna Martin's lead in Burke County. But there are much more powerful forces at play that influence what kids want to eat, why schools might turn to outsourcing, and why big food companies control so much of the American diet. What's happened with the National School Lunch Program is emblematic of Poverty, Inc. The motive to profit can distort even the most well-intentioned programs with the noblest of aims, feeding hungry kids. Conclusion. Who's really fighting the war on poverty? Self-serving private interests have hijacked the war on poverty. Failures in governance and public policy have enabled predatory industries to thrive at the expense of low-income Americans and of taxpayer dollars. The complexity of the Earned Income Tax Credit, EITC, for instance, spawned tax-time profiteering. Welfare's work requirements support a multitude of for-profit training providers offering dubious credentials and few pathways to real employment. Flawed Medicaid payment policies encouraged fraudsters while hindering access to high-quality health care for the poor. Health disparities, in turn, prop up the revenues of industries like dialysis. Multi-billion-dollar conglomerates control the health, the financial security, and even the physical liberty of millions of low-income Americans, thanks to the abdication of government responsibility to contractors. All too often, these for-profit interests sabotage the effectiveness of the government programs to which they owe their livelihood, and they perpetuate the poverty that is the raw material of their business. Over the past 20 years, so-called double bottom line companies have become increasingly fashionable. The idea of doing well by doing good, pursuing both profit and social impact, has especially caught on in the consumer market, where there's a strong and growing demand for ethically sourced, environmentally responsible products. Companies boast of fair trade coffee, clean cosmetics, and green production methods. Certified fair trade coffee sales, for instance, have grown from about $43 million in 2017 to about $68 million in 2020, according to Fair Trade America. Simply labeling a coffee fair trade increases its sales by nearly 10%, according to one Stanford University study. Assuming the truth of their labeling, many companies are changing their practices and business models to respond to consumer pressures. And companies have incentive to do so because the U.S. consumer market is robust. There are plenty of shoppers with money to spend, which means plenty of competition for those dollars. But this is nothing like the market for social services, where there's a single-payer customer, the government, and a limited number of vendors where product quality is tough to measure, and the end consumers, or low-income Americans, have little to no leverage over the services they receive. As is clear throughout this book, contractors hold most of the power in these situations, leaving few choices for governments and often none for low-income Americans. Just a handful of companies control the market for TANF and Medicaid administration, for instance. And the same is true of private prisons, Job Corps contractors, etc. Privatization's purported goal was to harness the private sector's innovative impulse for the public good by spurring government to be more creative, effective, and efficient. What's happened is a perversion of that entrepreneurial energy. Companies have indeed been endlessly inventive, but in their strategies for exploiting government and the beneficiaries of government programs. Meanwhile, the competition and choice promised by privatization have been illusory. Policymakers must shed the idea that the market can deliver social services effectively, or at least in a way that benefits low-income Americans more than it does companies' own bottom line. The pursuit of profit is an uneasy fit for social policy, and it's a motive powerful enough to override even the best of intentions. A case in point: Salt Lake County, Utah's 2013 experiment with social impact bonds to finance preschool for disadvantaged children. As originally conceived, the Utah plan was brilliant, bold, and potentially revolutionary. To finance an expansion of Salt Lake County's early childhood program, Goldman Sachs and J.B. Pritzker agreed to lend the county and the United Way of Salt Lake $7 million over 5 years to reach an additional 3,500 children. The county would repay the loans, or the social impact bonds, only if the program met certain metrics for success, namely the avoidance of special education, which cost $2,470 per child per year. If all went well, Goldman Sachs and Pritzker would get 40% of the aggregate savings from these reduced expenditures as success fees, or about $1,040 per child per year. The effort began with much fanfare and high hopes. We want this pay-for-success model to be not only for Salt Lake County, but throughout the nation, Salt Lake County then-Mayor Ben McAdams told me in 2014. We want to get it to the point where you have a marketable investment that could attract private sector dollars for solving complex government programs in a more efficient way. In theory, the plan was a win-win-win, a return on their money for investors, an infusion of funds for the government, and more access to services for low-income children. 2 years into the program, Goldman Sachs announced its first results, that 109 at-risk kindergartners had successfully avoided special education, entitling the bank to its first payment of $260,000. But the effort immediately came under fire for potentially overstating its results, and thus overpaying its investors. In particular, experts told the New York Times, the program overcounted the number of children at risk for special education, meaning Goldman got its success fee for kids who may never have needed special education in the first place. Moreover, experts said, Goldman's investment in preschool, about $1,700 per child, was too small to produce the kinds of results reported. The most successful programs documented in research typically cost 4 to 5 times as much. More broadly, critics argued that the avoidance of special education as a measure of success encouraged officials to deny children needed services, especially those with disabilities. Documentarian Nadine Pequeneza, who spent 3 years studying a similar preschool initiative in Chicago, concluded in the Stanford Social Innovation Review that social impact bonds might be doing more harm than good. The Utah experiment illustrates the private sector's limited capabilities in social policy. For one thing, as Pequeneza points out, instruments like social impact bonds promote simplistic solutions to complex problems. It's impossible to solve a multifaceted problem like poverty with a narrow set of market incentives that private actors can be paid to act upon. By itself, better access to preschool won't set a child up for success in school, especially if the rest of their education is substandard and if they face a host of other challenges at home and in their communities. It's also difficult to determine what to measure, how to measure it, and how to prevent gaming of the system. For instance, if success in running a Medicaid program means lower costs, success is a simple matter of denying access to care, as some Medicaid contractors have done. In addition, effective human services require investment. They can't be done on the cheap. A high-quality preschool program, for instance, requires skilled and caring teachers, curricula tailored to each child's needs, and access to supportive services for families. This requires much more spending than $1,700 per child per year, or what Goldman purportedly invested in Utah. Unfortunately, the corporatization of U.S. social policy has been half a century in the making. Disentangling the private sector from the infrastructure of government, let alone undoing the damage, is a dauntingly large and expensive task. Governments have given away so much of their administrative capacity that reclaiming and rebuilding their capabilities would require a far bigger budget and far more political will than what's currently possible in our hyper-polarized, hyper-partisan environment. Nevertheless, Congress, federal agencies, and states can take any number of practical and politically feasible steps to rein in the destructive impacts of privatization and demand better performance from the companies entrusted to carry out governmental functions. Congress could, for instance, require more transparency from states about the share of federal dollars flowing to contractors for social services, and to which firms. One reason the corporate poverty complex has grown so big is that states and the federal government aren't collecting and synthesizing data about the size and reach of these businesses. At present, the most reliable data is what's gleaned from companies' annual reports, provided those firms are big enough to be publicly traded and required to disclose information to the U.S. Securities and Exchange Commission. Smaller companies that aren't public, or even large companies that are privately held, for example owned by private equity firms, can operate with relatively little transparency into their revenue, the number of contracts they hold, or the amount of government dollars they receive. Given that so many of the companies described in this book earn the lion's share of their revenue from government, it seems only fair that they be considered publicly funded, and therefore publicly accountable for their activities. More and better data could also lead to new strategies for increasing competition, breaking up provider monopolies, for example in Job Corps, or improving procurement practices, such as limiting the number of markets nationally in which a single company can serve. Governments can also tighten up their oversight of the contractors they hire and the dollars they spend. While many agencies have already embraced so-called performance-based contracting, officials too often pick the wrong measures of success. Job training contractors, for instance, might be paid for the number of enrollees they sign up, or the placements they make, but get no reward for longer-term job retention or wage gains among their trainees. The incentive then becomes to churn through trainees without regard for their long-term success or to cherry-pick enrollees who might be the easiest to place. Likewise, Medicaid contractors might be rewarded for keeping costs low per enrollee, but without regard to the health of beneficiaries. As discussed earlier in this book, This creates incentives to deny care, especially to the sickest patients. So long as contractors are in the mix, rethinking what's rewarded could help eliminate perverse incentives and improve the quality of services. Governments could also limit their contracting to ministerial tasks that might benefit from the efficiency of corporate infrastructure, but don't require administrative discretion in the benefits people receive. States could, for instance, hire companies to process benefit checks, but disallow them from deciding eligibility. Analogously, payroll processing companies cut paychecks, but they don't determine anyone's salary. Over time, governments could potentially claw back the power they've given away by narrowing the scope of future contracts. In a perfect world, the goal should be to expunge the parasitic industries dragging down U.S. anti-poverty efforts, and to eliminate the failures in policy that have allowed this kind of corporate opportunism. Getting there will require a fundamental re-examination of who is really running the machinery of U.S. social policy, and who, in fact, benefits most. To accomplish this task, policymakers should keep in mind the following 5 takeaways. 1. Government doesn't deliver anti-poverty programs. Private actors do. Much of the government's anti-poverty apparatus is not, in fact, in government hands. Often, the relationship between government and third parties involves the direct contracting out of services, such as running prisons, administering Medicaid, or managing a Job Corps center. In many other instances, however, third parties insert themselves between government and the beneficiaries of anti-poverty programs. Tax preparers essentially broker the EITC for low-income Americans. Section 8 landlords, Medicare dentists, and dollar stores are the intermediaries through which low-income households receive such basic benefits as housing, healthcare, and food. But when politicians and pundits talk about the efficacy of anti-poverty programs, they are almost always focused on the performance of government or the behavior of the poor. What's missing from the conversation is the performance and behavior of private interests acting on behalf of the government, or as middlemen to deliver services and benefits. The profit-seeking of these third-party players significantly diminishes the effectiveness of government programs, either by diverting resources from the intended beneficiaries, in the case of tax preparers skimming the EITC, or by providing poor quality products that undercut a program's purpose. For example, an unnecessary and painful baby root canal performed by an unscrupulous Medicaid dentist. To be fair, commercial tax prep firms and insurance companies aren't in business to fight poverty. Their goal is to make money, or to fulfill the narrow terms of a government contract. Moreover, the large public companies that dominate sectors like benefits administration are beholden first to their shareholders, not to the broader aims of U.S. social policy. Nevertheless, policymakers should fully consider the impacts of these third-party actors when they evaluate anti-poverty programs, and they should recalibrate U.S. social policy to reduce the drag created by unintended private sector intermediaries. Simplifying the tax code, for instance, would allow fewer low-income Americans to rely on commercial tax preparers to access the EITC. Source of income laws could help break the monopoly of Section 8 landlords and induce real competition. Reforms like these could be an important step toward making federal anti-poverty programs more effective. The starting point, however, should be a census to quantify the universe of contractors and their impact on policies and programs. This book covers the programs forming the core of federal anti-poverty policy, but it's far from an exhaustive review of for-profit involvement in social services. For-profit companies own 70% of the nation's nursing homes, for instance, while Medicaid pays the bills for nearly 2/3 of nursing home residents. Many states have also begun to privatize their foster care systems, leading to horrific consequences for at-risk children. For instance, a 2015 BuzzFeed investigation into the nation's largest for-profit foster care placement agency, National Mentor Holdings, uncovered a host of negligent practices that resulted in abuse and even deaths at the hands of foster parents. Long-term care and child welfare reform could easily fill their own volumes, which is one reason I could not give these topics justice here. The devolution of social services across multiple layers of government, federal, state, and local, has allowed the for-profit social services industry to operate in the shadows relatively unmolested and in disparate, fragmented service sectors. A big-picture assessment of the collective impact and damage these players have wrought would help achieve the accountability that should have been demanded all along. 2. Poverty persists, in part, because it benefits the industries that profit. For industries that depend on anti-poverty programs and low-income Americans to fuel their business, the end of poverty is an existential threat. Dollar stores benefit because hungry Americans rely on SNAP. Section 8 landlords profit because households need assistance to afford their rent. Private prisons feed off a criminal justice system that disproportionately targets the poor. Industries like these have embedded themselves into the daily lives of low-income Americans. They're entrenched in the infrastructure of poverty, and they have a vested interest in maintaining the status quo. Billions of dollars are at stake, which is why these industries have acted to protect their markets and block policy changes that could hurt their revenues. Some companies have sued the government or each other when they lose contracts, as has happened with Job Corps and Medicaid managed care. Others have lobbied to stop reforms that could damage their business. Commercial tax preparation companies, for instance, have successfully undermined free filing initiatives for low-income Americans in short-circuited efforts to provide the automatic filing of tax returns. Prison companies and the commercial bail industry have propped up state lawmakers' efforts to be tough on crime, thereby guaranteeing a steady supply of inmates for their businesses. Job Corps contractors have insulated themselves with local support from the areas where their centers are located. The aggregate impact of these efforts is to calcify the programmatic flaws and inefficiencies that helped birth these industries in the first place, for example, tax prep, and to trap low-income Americans into systems where these industries can continue to exploit their status. Tackling the systemic sources of poverty means confronting the institutions that have made poverty their business. One way to begin this task might be to require more disclosure from private sector interests about their financial interests in the policy positions they support. Another option might be to encourage legislative analyses about the financial impacts of proposed legislation on government contractors and other third-party stakeholders, like the fiscal analyses that the Congressional Budget Office and other agencies now perform to show a proposal's effect on the budget. Better understanding of the connection between policies and profit-making could help counteract poverty privateers' outsized influence. 3. Personal responsibility is a myth when the poverty industry controls people's choices. One of the most enduring debates about poverty's causes is the role of personal responsibility. Americans believe in the trope of rags to riches, that anyone can pull themselves up by their bootstraps to achieve the American dream. Conservatives have capitalized on these cherished notions to blame the poor for their circumstances and to enshrine a harshly punitive view toward the poor in the law. Welfare work requirements, for instance, reinforce the prejudice that recipients are lazy and promote the simplistic idea that all anyone needs to get out of poverty is a job, no matter how poorly paid. The choices people make do matter, of course. But what also matters, and might matter more, is the universe of choices available to individuals, depending on their zip code, race, and other factors outside their control. For many low-income Americans, the choices available to them are limited or non-existent, and all too often dictated by the industries that colonize low-income communities. Many people don't have access to affordable, healthy food, for instance, because dollar stores and bodegas control the food choices available in low-income neighborhoods. Willpower can't overcome a diet where the only options available and affordable, including at the school cafeteria, are processed foods high in fat and sodium. Another case in point is the Housing Choice Voucher Program, where Section 8 landlords have made a mockery of what this program is supposed to represent. A ticket to opportunity in a better neighborhood. As Chapter 6 describes, recipients can wait years to land a voucher, only to remain in a low-income neighborhood without decent schools or other amenities that could improve a household's prospects. Policymakers need to recognize the paucity of choices facing many low-income Americans, as well as the private sector's role in narrowing their options. With programs like housing vouchers, food stamps, and school lunch, Congress should consider how to use the federal government's considerable buying power as leverage for improving what's available to low-income households and making true choices possible. Tougher nutrition standards, for instance, could also at least result in healthier school lunches. Bigger subsidies for fresh fruits and vegetables and smaller subsidies for highly processed foods could mean the greater availability of produce. As tough as it is to shape the private sector's responses to public policy, policies should at least offer some reward for the companies that are doing the right thing. 4. We need better governance, and a lot more of it. The rise of the companies that control so much of U.S. social policy is also a reflection of the decline in governmental oversight and authority. Much of the malfeasance chronicled in this book is the result of someone in government dozing at the wheel. At the same time, government workers have been both outnumbered and outgunned, both by the hordes of contractors that have accumulated over decades of privatization and by the industries adjacent to the poverty economy that operate without accountability. As Chapter 2 noted, the shadow government of contractors and subcontractors throughout government is many multiples larger than the official federal headcount, especially in the delivery of human services. Public management experts like the University of Maryland's Don Kettle and New York University's Paul Light have sounded the alarm for years on the inadequacy of governmental efforts to manage the shadow workforce, enforce accountability, and measure performance. The ways in which poverty-related industries undermine governmental anti-poverty efforts should raise these alarms to a blaring crescendo. It's time for reinventing government 2.0. But this time with a focus on reclaiming governmental capacity for management, audit, and enforcement to bring the shadow workforce to heel. Liberals have generally been averse to embracing government reform, equating it, correctly for the most part, to budget cuts, privatization, and conservative sustained attack on federal authority. But progressives must disarm conservatives' anti-government strategy if they want to restore public trust in government and rebuild its authority. That means a genuine strategy to build back better, so to speak, not just bigger, with accountability as the central theme. 5. More funding for federal anti-poverty programs won't solve the problem of poverty, but it will feed the poverty industry. Many progressives have long argued that the biggest problem with the federal government's anti-poverty efforts has been the lack of adequate funding. Expanding federal benefits like SNAP and the EITC would lift more families out of poverty, advocates argue, while dramatically expanding the housing voucher program would help alleviate the problem of years-long wait lists for aid. Unquestionably, more money would help. But simply growing the funding for these programs would also mean more money lining the pockets of contractors and intermediaries that also depend on these programs for their profits. Yes, the benefits will trickle down to the Americans who need them, but only after a heavy tax is exacted by the poverty industry. Progressives should couple proposals for increased funding with ideas for programmatic reform, including better oversight and accountability by contractors and other intermediaries. This approach would not only have the substantive benefit of improving program performance, it would also help win political support for bigger investments in fighting poverty. Taxpayers need to know that their dollars are wisely spent, and government needs to offer proof of its commitment to accountability if they want taxpayers' trust. It's no coincidence that the governmental failings that have given rise to Poverty, Inc. are the result of conservative attacks, both on government and on the poor. Conservative anti-government ideology fueled Reagan's push for privatization. Conservatives' punitive views on the undeserving poor set up the failure of welfare to work. Conservative stinginess encouraged states to fall for the false promise of cost-cutting through privatization. The creation of Poverty, Inc. is a particularly destructive consequence of conservative victories in dictating U.S. social policy. For-profit industries are now mercenaries in conservatives' broader war against America's poor. Undoing the damage will require a frontal assault on the most egregious abuses. It will also mean defeating the conservative ideology that has dominated the politics and policies around poverty for at least the past 40 years. That task has never been more urgent. This concludes Poverty for Profit by Ann Kim.